that let's dive into the core principle of effective and secure credit management. At the heart of it, at the heart of it, there is something called, prudent credit management. You can see at the heart of it, there is something called prudent credit management, something every banker and every financial professional should master, right? So this prudent credit management ensure that loan are given wisely, risk are minimized, bank remain financially strong. But what are the key pillars that support this? So the first thing is, adequate security. What it means, just like a safety net, this ensure that loan is backed by asset, reducing the risk of default. The stronger the security, the safer the loan. The second is called safety of fund. So what is safety of fund? So bank don't just lend money, they need to ensure that they get it back. So this principle protect the invested capital and ensure its safe return. The third reason is justifiable purpose. Justifiable, right? And there's another point which is called profitability potential. These are the some key prudent case. So you can see profitability potential. What is the meaning of profitability potential? See, at the end of the day, bank are businesses. Every loan should have high probability of generating financial return, ensuring sustainability. And then finally we have liquidity, which means, ever heard the phrase cash is king? Have you ever heard cash is king? Right. So bank must maintain liquidity to meet financial obligation, ensuring they don't run out of fund. So each of these principles, remember these are the five principles, they play a super important role. So let me summarize the principle in just one pick. So you can see adequate security, safety of fund, justifiable purpose, profitable potential, liquidity. So each of these principles plays a vital role in building a secure and profitable credit system. Ignore any one of this and the entire structure can collapse. Now here is a quick question for you. Which of these five principles do you think is the most important for bank? Drop your thought in the comment below. So I have given you the five principles. Now to the next slide, and the next slide, as you can see, is related to the legal framework for Indian entity. Whether you are an entrepreneur, a finance professional, or just someone curious about business law, this is something you must know. In India, different types of entity operate under different legal framework. Let's break them one by one. So the first one is none but individual, as you can see, individual, right? So they are governed by the Indian Contract Act 1872, which define the rules for forming a valid contract, right? The second we have is partnership firm. So partnership firm, you must know that these follow the Indian Partnership Act in 1932, right? So this law define how partners share profit, responsibility and liability in a business. So this is about the partnership firm. Then we have something called LLP. What is LLP? Limited liability partnership. So these follow Indian Partnership Act. They follow they follow the LLP Act 2008. Right. So this structure offered the benefits of partnership but with limited liability. Then we have something called company. Right. So for company, which kind of act they follow. They are regulated by the Companies Act 2013. Right. They are regulated by the Companies Act 2013, and this law govern private and public company, ensuring transparency. And then you have, Hindu undivided family. So they are managed under Hindu Succession Act 1956, and this framework apply to family running a joint business, ensuring proper succession and management of asset. So each of these legal structure has its own rule, right? Each of this management structure has its own rule, right? And advantage, limitation, making it crucial to choose the right one for you. So tell me, which business structure do you think is the best for a startup? Please let me know in the comment section. Then let's look at some more, right? Besides, in addition to all these companies, individual, HUF, partnership firm, we have some more, right, for organization, as you can see. So friends, in this slide, we are diving into important topic, that is regulatory framework for organization in India. So whether you are a business owner, investor, finance enthusiast, understanding this framework is very essential for navigating the corporate world. First thing first, it's called a statutory corporation. These are government created organization governed by specific acts, right? For example, RBI, LIC, SEBI, they plays a crucial role in economic stability. Then we have something called cooperative society. You must know they are regulated under the Cooperative Society Act 1912, Multi-State Cooperative Society Act 2002, or a state specific law, and these organizations are formed to promote mutual benefit, especially in agriculture, banking, rural development. Then come trust and REIT. So what is REIT? Real Estate Investment Trust. So these are regulated by multiple trust act, including the Indian Trust Act, right? Including Indian Trust Act, Public Trust Act, Religious and Charitable Endowment Act, and the WAF Act. And yeah, club and association, right? So club association, so basically these organizations follow registration legislation, right? So basically, a club and association, if you talk about, so these organizations follow registration legislation to ensure compliance and accountability. So please tell me, which of these regulatory body do you think impact our daily life the most? So we have talked about some regulatory organization here: statutory, cooperative, trust and REIT, club and association, right? So friends, that's about the regulatory organization. Now let's switch our focus and let's come to the empowering economic growth through inclusive priority sector lending. So this is all about the priority sector lending. So let's focus our attention on this particular topic. So this is the we are unlocking the secret of inclusive economic growth. So banks are not just about business, they also play a crucial role in national building by lending to sector that drive economic progress. So which area benefit the most from PSL? The first area is agriculture. So you must know what are the things are included under PSL. The first is agriculture. So farmers are the backbone of our economy. PSL ensure that they get the financial support for farming activity, irrigation and agriculture development. Then we have MSME. MSME, this is called micro, small and medium enterprise. I think you know about it, right? So these business create jobs, boost innovation, strengthen local economy. So PSL provide them with much needed capital to grow and thrive. Then we have export credit. Okay, first of all, let's see the housing portion also. Here it is. Here you can see this is housing portion. So housing portion. So affordable housing is a key pillar of development. PSL help fund housing infrastructure, making home more accessible and affordable. Then we have education. Higher education should not be a privilege. PSL promote student loan financial assistance to ensure that education is within reach for all. And final thing is export credit. So that global trade is essential for economic progress. So PSL encourage export by providing credit to exporter. So without PSL, many critical sector will struggle for fund, slowing down development. So friends, I hope this makes sense to you. What are the sections which are included in the PSL? So friends, before moving forward, let me give you a detail about our crash course which I have just launched. So this is the crash course which I have launched from 15th March. And in this crash course, what I have done, I have prepared two separate folders, as you can see. One is the static folder and one is the daily updated folder. So this is daily updated folder, and in this folder you can see the schedule here, right? So schedule you can see from 15th March to 31st March AVM, then 1st April to 15th April AVFM. Similarly, the rest 3 subject. And you can see I have created a separate folder for AVM. Inside it, the first day target has been given. That I have just added the PDF, and then we will add the videos. Then we will add the quizzes. So on daily basis you will receive PDF, videos and quizzes. You just have to make sure that the content provided in this folder you have to do on daily basis. That's it. And the rest thing is taken care of by me. I guarantee you that the content which I provide you is sufficient to be covered in just one day by devoting just 1 hour to 2 hour of the time, because the video is just for 30 to 30 minutes to 40 minutes, right? And the rest time you have to devote to what practicing MCQs, practicing quizzes, which I will add in this particular folder. So if you want to get if you want to enroll in this particular course, you can get detail. It only costs rupees 700 after applying 30% discount, which is till today, right? So you can WhatsApp me on this particular number is provided on the screen, or in the description section you will see the link of the course. Friends, I guarantee you that if you are feeling short of the time, if you don't have much time to cover in the entire syllabus, then this course is very much beneficial for you. So now let's continue our discussion. Let's see the breakdown of PSL. So friends, let's see the breakdown of PSL, how it works. So let's get deeper into the PSL and how it supports various sector. So first thing is agriculture financing. I hope it is visible to you. Agriculture finance. So farmer need financial backing at every stage. So PSL cover crop loan, medium term loan and post harvest activity, right? So including transportation with funding up to 2 crore. So remember this 2 crore for agriculture financing. Up to 2 crore funding is provided under PSL. Then we have something called warehouse receipt. Warehouse receipt. So see, storage plays a vital role in the agriculture supply chain. So advance against, and you know what is NWR? NWR is called negotiable. NWR is called negotiable warehouse receipt, right? So advance against negotiable warehouse receipt qualify for PSL up to 75 lakh. Remember it. While for non NWR backed loan go up to 50 lakh. So for NWR 75 lakh, non NWR 50 lakh. Now what about cooperative society? So farmer and a small producer rely on cooperative society for financial assistance. So PSL provide loan to help them purchase, produce and sustain their livelihood. And then we have the next point, as you can see, is agriculture infrastructure. You can see here agriculture infrastructure. So friends, farmer producer company, that is called FPC, sometimes we call it FPC, farmer producer company engaged in farming, they can get loan up to 5 crore, right, while investment in agriculture infrastructure and food processing up to 100 crore. They remember these limits. Then for startups, so they can qualify for PSL, remember it. A startup that contribute to economic growth can avail PSL loan up to 50 crore, right? So this is very important. And then you have the last thing, MSME. You know what is MSME? Micro small medium enterprise. So this is the backbone of our economy. So PSL extend loan to MSME engaged in manufacturing, services, retail, wholesale trading, right? And including KPI, Khadi and village industry, irrespective of the size and location. So by supporting this sector, PSL boost entrepreneurship, enhance financial inclusion, and accelerate economic development. So please tell me, which sector do you think? So this is just a glimpse. Every content you will get in our crash course just like this, just like pictorial format. So at the end of suppose 5 days before the examination, you will just go through this PDF and everything will be in front of you. You can just revise it very quickly. This is the main motive of this crash course. Now, can you please tell me, which sector do you think benefit the most from PSL? I hope you can see. So I have given you the list of 6 sector, and can you tell me which sector is benefiting the most from PSL? Now let's switch our focus to the next PSL breakdown, as you can see in the slide. So friends, let's explore another crucial aspect of PSL, the different financial instrument and the segment it support. So you can think of PSL as the wheel of financial inclusion. So one thing, let me zoom a little bit so that the picture is visible to you clearly. Now the first thing is called general credit card, we call it GCC. You know that MSME often face financial hurdle. To support their specific need, PSL includes credit card designed exclusively for MSME borrower, that is called GCC, general credit card. Then comes the factoring transaction, as you can see here, right? Factoring transaction is also included in the PSL. So as you can see on the left side, that MSME depends on timely payment. PSL will cover factoring transaction, allowing business to manage their cash flow effectively. Then overdraft under Pradhan Mantri Jan Dhan Yojana. So financial inclusion start at the grassroots, right? So PSL provide overdraft facility to Pradhan Mantri Jan Dhan Yojana, right? So it starts at the grassroots, yeah, right? So PSL provide overdraft facility to the Pradhan Mantri Jan Dhan Yojana account holder, ensuring easy access to emergency fund. And then we have something called micro enterprise. So on the right you can see micro enterprise. So did you know that 7.5% of the total PSL is earmarked for micro enterprise? This ensures that a small business get the financial boost they need, right? That is, remember this limit, 7.5% of the total PSL is earmarked for micro enterprise. Then we have something called decentralized support system, the decentralized sector support. So a small scale industries and rural entrepreneur plays a vital role in the economic development. So PSL offer loan for decentralized industry support. And then finally we have MFI, that is called microfinance institution. So to empower a small business and self-employed individual, PSL facilitate funding through microfinance institution. So with this financial tool in place, PSL ensure that every sector from micro enterprise to rural industry get access to the fund they need to thrive. So please tell me, which PSL segment do you think make the biggest impact? Which PSL sector make the biggest impact? Now then we have something called housing finance loan limit. Remember, in this particular diagram we will understand how much housing finance loan is provided to the PSL. So let's decode another important category under priority sector, which is called housing finance. So home loan are a crucial part of financial inclusion, right? So as you can see here, metropolitan housing loan, right? The limit is 35 lakh. So remember, this data have been given in lakh, as you can see. So metropolitan, so loan for housing in metro city have a maximum cap of 35 lakh under PSL, right? So given the high cost of living, this help urban dwellers secure house finance. And now for metropolitan housing cost cap, so this is the cap, not, so 35 lakh is the right. For housing project in metro area, the total cost cap is 45 lakh. It cannot exceed this under PSL, right? So if you are taking maximum 45 lakh loan under PSL, this is the cap they have put you, right? And then other reason housing loan, right? For non-metropolitan area, housing loan are capped at 25 lakh, up to 25 lakh, and maximum it can go, right, is up to 30 lakh, right? So you can see for metropolitan 35, under 35 will be PSL, and maximum up to 45, right? And for other reasons 25 to 30. Then comes metropolitan repair cost. you know that for metropolitan repairing, if you are doing repairing works, so home loan repair in metro city also qualify for PSL loan with a limit of 10 lakh to help homeowner to maintain their property. And for other reason, a home repair loan, it is for 6 lakh, 6 lakh under, for non metro area the limit for home repair loan is 6 lakh. Then we have something called HFC. You know what is the meaning of HFC? This is called a house finance company. So housing finance company can avail refinancing loan. They can avail the refinancing loan, right, up to 20 lakh. This 20 lakh is under PSL, under the NHB guideline to extend affordable credit to home buyer. So I hope this makes sense, right? So what do you think? Is 35 lakh enough for metro housing? Drop your thought in the comment. Now let's see the breakdown of priority sector lending further. Education loan. So friends, up to 20 lakh education loan is under PSL. Remember this limit, 20 lakh, right? And for export credit, what about export credit? So export credit, Indian farmer and MSME are the backbone of our economy. Under PSL, export credit is provided to them. Then if we talk about the social infrastructure, then let's talk about the social infrastructure. So remember the limit. Remember the limit is 5 crore, right? Remember the limit is 5 crore per borrower. For social infrastructure, the limit is 5 crore per borrower. Imagine a world with better school, hospital, sanitation facility. So bank lend up to rupees 5 crore per borrower to fund essential infrastructure. Then we have renewable energy financing. So with the rise of sustainable energy, PSL also support non-conventional energy project like solar, wind, bioenergy, right? So that is the point. So I hope the sectors limit have been clear to you. Now let's switch our focus to some more sector. Like you can see, let me zoom a little bit here, so that you can see large scale loan, right? So as the world shift towards sustainable energy, financing plays a key role in making green project a reality. So first thing first, as you can see here, large scale loan. What does it mean? See, up to 30 crore. Remember, so up to 30 crore. Up to 30 crore, big project need big investment, right? Whether it is solar farm, wind park, hydro plant, bank offer loan up to 30 crore to support large scale renewable energy initiative. Then we have individual borrower loan. So want to install solar panel on your rooftop or set up a small biogas unit, you can get loan up to rupees 10 lakh for individual project. For a smaller loan, right? For a smaller loan, what happen? So a small group, communities or a startup can borrow up to rupees 1 lakh for renewable energy solution, making clean energy accessible for all. Why this is important? Because green energy means green future. So PSL make renewable energy more affordable. So I hope that makes sense to you, right? Let's look at the next classification, right? So now let's look at some more classification of this PSL. So friends, that did you know that even a small loan can make a big difference in people's life, right? Under PSL, bank offer a small loan to help individual and community grow financially. As you can see, the first point is a small loan to individual. That if you need a loan but worried about income limit, so bank provide loan up to rupees 1 lakh, right? For individuals and their self help group or JLG, joint liability group. Remember it, right? Now eligibility is that household income should be less than or equal to 1 lakh in rural area. Remember, your household income should be less than or equal to 1 lakh, or in non-rural area it should be less than or equal to 1.60 lakh. Then you will receive 1 lakh as a loan, right? So that is the point. And this thing is very important. For SHG and JLG loan up to 2 lakh can be given. So if it's an individual, then 1 lakh can be given, provided his income should not be greater than 1 lakh and 1.6 lakh in non-rural area. But for SHG and JLG loan, right, a small group working for non-agriculture and non-MSME activity can borrow up to 2 lakh for house repair, for toilet construction or common group activity, right? So that is the point. Now for distressed individual, let's talk about the distressed individual. So for distressed individual struggling with debt from informal lender, bank can help by providing loan up to 1 lakh to repay non-institutional debt, to repay non-institutional lender, right? So because financial access empower rural household, women-led business, and a small community, so paving the way for economic growth and self-reliance. Now let's see the bigger picture here. So friends, in this particular slide, did you know that different bank have a specific lending target under the PSL? So let's get started. So the first category you can see is a domestic commercial bank, excluding RRB and SFC. Total 40% target is there. How much? 40% target. So you can see, using this picture you can easily remember all the data. No need to go through those hectic tables. Now 40% target, this means these banks must allocate 40% of their ANBC, adjusted net bank credit, to priority sector like agriculture, MSME, housing and more. Now let's come to the next part. Foreign bank with 20 plus branches, so their limit is 40%, right? So they follow 40% lending criteria. For foreign bank, a foreign bank export credit, so out of this 40%, 32% must go toward export credit. Bank involved in export credit have slightly target at 32%, and remaining 8% should go to other sector. I hope this bifurcation is clear. Out of this entire, suppose this is entire 40%, so it says that it says that 32%, so this portion 32% should go to export credit, and remaining 8% to other sector. Now let's talk about the biggest priority sector contributor. As you can see this diagram, the biggest priority sector contributor is RRB and SFB, regional rural bank and a small finance bank, because they lead the way with a massive 75% target. And especially for this RRB and SFB, medium enterprise contribution should be 15%, right? Each of this sector gets 15%, social infrastructure 15%, right? And renewable energy 15%. So this bifurcation must be clear to you. Now let's switch our focus to our next chart. As you can see, this is micro enterprise. Okay, so this is minimum lending requirement. How much minimum lending is as per the PSL? So friends, ever wondered how bank decide whether to lend their money under the PSL? Well, there are specific target for different category. As you can see, the first term is agriculture lending. So bank must allocate at least 18% of their loan, A and BC, adjusted net bank credit, or CUB, whichever is lower, right? They should allocate at least 18% to agriculture. So this ensures that farmer loan to farmer and agri business get the necessary financial support to grow, right? So this is about agriculture lending. Now then, after agriculture lending, we have something called SMF. You know what is the meaning of SMF? SMF stands for small and marginal farmer, right? Small and marginal farmer is called SMF. So there is also 10% target for SMF. As you can see, for SMF also 10% target, right? Out of the total agriculture lending, 10% must go through specifically to a small and marginal farmer. Remember, out of this total agriculture, total 18%, 10% must go through a small and marginal farmer, right? So that is the point. So then we have micro enterprise. So remember, micro enterprise, the target is 7.5%, right? Except foreign bank with fewer than 20 branches. So this target is not for those foreign bank which have less than 20 branches. For rest everyone, this 7.5% target is there. Then we have weaker section except RRB. So bank need to allocate 12% of their loan of their A and BC, adjusted net bank credit, to the weaker section. Like I will tell you about weaker section later in this particular chapter. And for RRB, the target is 15% to the weaker sector, right? For regional rural bank, the requirement is slightly higher at 15%, ensuring better financial support for rural development, right? So do you think that PSL target should be increased for any category? So these are the target: agriculture 18%, SMF 10%, micro enterprise 7.5%, weaker section 12%, except RRB, and for RRB it is 15%. Right, now let's look at this for UCB, Urban Cooperative Bank. Let's look at the target. So friends, UCB is called Urban Cooperative Bank, and you can see March 2022, the target was 40%. So UCB were required to allocate 40% of their A and BC to the priority sector. Then 2023 March, 50%. By the next year, the target increased to 50%. Right. So as you can see, by the next year, the target increased to what? 15%, 50%. Right. And to support more sector in the need of financial inclusion. Then March 2024, the target increased to 75%. It was a significant jump, right? Then especially out of this, for micro enterprise 7.5%. So separate 7.5% of total lending must go to micro enterprise, and for weaker section as usual 12%, right? So this is for UCB, Urban Cooperative Bank. It increased in the phase manner, as you can see, maximum 75%. Now let's talk about the weaker section component. So I told you about weaker section. So as you can see here, some components of weaker section has been given. So what are the component? First component is a small and marginal farmer. So it may be asked, what is small and marginal farmer? So farmer with a small land holding eligible for loan with credit limit up to 1 lakh. Artisan, they are the part of the weaker section. Then cottage industry worker, government scheme beneficiary, a scheduled caste, a scheduled tribe, self-help group, distressed farmer, women beneficiary up to 1 lakh. So these are included in weaker section. Sometimes question is asked that which is not a part of weaker section. So you must know who are the part of weaker section, right? Please go through this particular diagram, this particular table. Everything will be crystal clear. Now let's switch our focus to MSME classification in India. Very, very important. So using this diagram, I will make you clear how MSME are classified in India. So friends, why does it matter? Because MSME are the backbone of our Indian economy, right? So first let's get started with the micro enterprise. So for micro enterprise, investment up to 1 crore and turnover up to 5 crore, right? So this is about investment and this is about the turnover, right? So up to 1 crore, up to 1 crore investment and multiply by 5, this is 5 crore. This comes under micro, this comes under micro. Okay, what about small enterprise? So investment up to 10 crore and multiply by 5 into 50 crore, and turnover up to 50 crore. So these business are a step ahead, scaling operation, expanding their reach. So that's what scale small enterprise. And what about medium enterprise? Investment up to 50 crore, investment up to 50 crore and turnover up to multiply by 5 to 50 crore, right? Just you can remember it like this. So these are large scale business that significantly contribute to the economy, right? So this classification is important because they help in getting subsidies, tax benefit, easier loan. That is why this classification is super important. So you must remember this limit. Just remember the top one, and bottom one you can remember by just multiplying by 5. 1, 10, 50 and then 5, 50 to 50. These are the limits, right? Investment and turnover. Based on this it has been classified. Now let's switch our focus to the comprehensive credit support review, right? So friends, in this particular slide, are you looking for financial support to grow your business? So India offer multiple credit scheme to help entrepreneur, especially in MSME sector. So the first one you can see is called GCC. What is GCC? GCC means General Credit Card. I told you earlier about this also. So it is a biometric smart card designed for non-farm entrepreneurial activity. Right? Remember the keyword here, non-farm entrepreneurial activity. I hope that makes sense to you. Then we have CLSS. CLSS is Credit Linked Subsidy Scheme. It supports technology upgradation, right, for businesses, and it offer a 15% subsidy up to 15 lakh, right? Up to 50 lakh, 15% subsidy on machinery investment up to 1 crore, right? Remember this CLSS scheme provide you basically technological upgradation scheme it is, and 15% subsidy it provide you, capped at maximum it can go up to 15 lakh for investment up to 1 crore in advanced machinery. So this limit should be clear. Then we have composite loan. So it is a single window loan covering both working capital and term loan. That is why it's called composite loan. Then we have GCC I have already talked about. So it boosts credit for non-farmer entrepreneurial activity. Then we have something called collateral free loan. So loan without collateral for MSE. MSE is micro and small enterprise, right? Remember, medium enterprise is not there, just micro and small enterprise. So loan without collateral for MSE, and it is available for business under PMEGP, Pradhan Mantri Employment Guarantee Program. So why this important? Because easy financing for a startup and a small business. So you must remember what is CLSS, what are the limits under CLSS, what is GCC, what is composite loan. If you go through book, everything is written line wise. It is very difficult to separate out, to filter out the main content, and that is what I have done in this crash course for you. Right, now let's look at the RBI LEF. LEF is called Large Exposure Framework. This is a super important topic. So what is LEF all about? Let's understand. So friends, that have you ever wondered how bank manage big loan without increasing financial risk? Enter the RBI LEF. So it is a crucial system to safeguard the banking sector. So first thing is sector concentration. The first thing is sector concentration. You know what it means. Bank lend money to different sector. But what if too much is given to one sector? So higher concentration, you must note it down that if concentration is higher, it means risk is higher. If concentration is higher, risk will be higher, right? So this framework ensures that a balanced lending approach. Then we have second thing, counterparty risk. You know about it. That ever wondered what happened if a big borrower failed to repay? Bank assess the risk of lending to large entity, ensuring that they don't put all their egg in one basket. Then we have something called exposure limit. Yes, very very important. Try to understand. A bank cannot lend too much to a single borrower. So if a bank exposure exceeds 10% of its tier 1 capital, it violates the RBI guideline. So suppose tier 1 capital is 100 crore. What is the 10%? 10 crore. So bank exposure to a counterparty or connected group equal or exceed 10% of the guys. So that is the point. That is the limits which have been placed. We will discuss the limit in the upcoming slide. And what is tier 1 capital? The core capital that bank must maintain to stay financially strong. The higher the tier 1 capital, the better the bank ability to absorb shock and handle the risk. I think you know about it. Now let's look at the limits for non-NBFC bank. right, for non-NBFC bank. So have you ever thought how much can a bank lend to a single borrower? Well, RBI has a strict exposure limit to prevent financial risk. So first thing, as you can see, for single counterparty, for first point you can say single counterparty, so it is 20%. For non-NBFC bank can lend up to 20%. It means that bank can lend up to 20% of their tier 1 capital to a single borrower. But wait, there is a flexibility. With board approval, it can be extendable by 5%. Remember, this is for non-NBFC. Non-NBFC means regular bank, right? And for group of connected counterparty, right? When multiple companies or entities are financially linked, they are considered a group of connected counterparty. And for them, the limit is 25%. So of their tier 1 capital, remember everything, every percentage is of the tier 1 capital, percentage of tier 1 capital, remember it. So bank cannot lend more than 25% of their tier 1 capital to such connected group. So it reduces the risk of default affecting the entire banking system. So remember these limits super important. Now let's look at for exposure limit for NBFC. Till now we were talking about non-NBFC bank, but what about NBFC? Have you ever wondered how much bank can legally lend to NBFC? That is called non-banking financial company. In this case also RBI has set a strict exposure limit. So as you can see, for single NBFC the exposure limit is how much? 25%. Sorry, so for single NBFC 20% of the tier 1 capital, and for connected NBFC, group of NBFC, 25% of the of their tier 1 capital. So it prevents over dependence of on NBFC for lending, right? That is the point. And it ensures that bank don't put all their egg in one basket. That is called LAF. Now let's talk about the RBI credit discipline. So friends, when it comes to lending, RBI has set a strict credit discipline to ensure financial stability. But what does it really mean? Let's break it down in the simple term. The first is called loan component. So RBI mandate that at least 60% of the working capital must for large borrower. So when I say large borrower, it means those borrower who have taken working capital of 150 crore and above. That is called large borrower. So RBI says that RBI mandate that at least 60% of the working capital for large borrower must be in the form of loan. So suppose a large borrower there who have taken 200 crore working capital. So at least 60% of that. What is 60% of 200 crore? It is 120 crore. It says that at least 120 crore must be in the form of loan. Right? This ensures that borrower don't over rely on short-term borrowing. Borrower don't over rely on short-term borrowing. This is called loan component. Then comes cash credit facility. So bank allow borrowing beyond the loan threshold through cash credit. So this 120 crore, that is at least 60%, minimum 60% should be in the form of loan, and beyond this 120 crore, suppose 80 crore, this can be in the form of cash credit, right? So but wait, there are limit to avoid excessive borrowing. These are the limit to avoid. And you know what are excluded? Export credit and inland sale bill. These are not included in the working capital limit. Remember it. So two things, export credit and inland sales bill are not included in the working capital limit. And there is something called commercial paper investment. If a company raises fund via commercial paper, it counts toward the loan limit. You know, this prevents business from bypassing credit discipline. So why does this matter? Because it prevents over leveraging. It promotes responsible borrowing. It ensures financial system stability. Now, using this diagram, I will break down the MCLR component. So friends, have you ever wondered how banks decide loan interest rate? It all comes down to the marginal cost of lending rate, fund-based lending rate. So the benchmark rate for all the loan. So MCLR has 4 key components, just like 4 sections of an umbrella. So the first thing, as you can see, is called marginal cost of fund. What does it mean? See, this is the cost of borrowing for bank. Simple you can say this is the cost of borrowing for the bank. It includes interest paid on deposit and borrowing from RBI or other source. Second is the negative carry on CRR. So you know, bank must maintain a cash reserve ratio with RBI without earning interest. So this increases their overall cost, known as negative carry. Then we have operating cost. It covers all kinds of administration cost, operational expense of bank. However, service related costs are excluded, like you know, loan processing fee from MCLR calculation. And tenure premium. A uniform premium is added for long term loan. The higher the loan tenure, the higher the risk. So obviously it's quite clear that if loan tenure increase, risk increase, right? This means premium increase. That is called tenure premium, right? So why is MCLR? This is all about MCLR. Why is MCLR important? Because it determines the loan interest rate. It ensures transparent pricing. The next thing is has the breakdown of MCLR publication requirement. So friends, have you ever noticed that loan interest rate change frequently? That's because bank update their MCLR at different interval. But how often? So MCLR has different tenor and each has its own publication timeline. So the first thing you can see is the overnight tenor. What does it mean? So this is shortest duration of MCLR used for ultra short term loan. Then 1 month tenor. Bank publish this every month. Then we have 3 month tenor. So updated quarterly. Then we have 6 month tenor, right? So it published twice a year. And then finally we have 1 year tenor. So you know that the most common MCLR benchmark is 1 year tenor for home loan and long term loan updated annually. So you must remember this tenor. Sometimes questions are asked based on this tenor. Now let's switch our focus to the pricing floating rate loan. Very very important. Ever wondered how bank decide interest rate on loan that keeps changing? So welcome to the world of floating rate loan. In short, we call FRL. So friends, there is a simple four-step process. Step number one is to identify the internal benchmark. So the bank first determine a benchmark rate. Think of it like the base rate from which your loan interest start. Then they add the spread component. So next, bank add a spread over the benchmark. This spread account for profit margin. It account for profit margin, right? And it account for credit risk. Obviously credit risk is there. It account for other cost, and they ensure minimum rate. What it means, that to protect the bank financial stability, the loan rate cannot go below the benchmark. This ensures minimum profitability. And then they state benchmark in the contract. So benchmark rate must be clearly mentioned in the loan contract, ensuring transparency, ensuring clarity for the borrower. I hope that makes sense to you. Now let's switch our focus to our next topic, which is none but stressed asset classification for term loan. Very very important. So friends, have you ever wondered what happens if a loan repayment is delayed, especially term loan? So bank have a structured way to classify loan based on overdue date. So let's step into the world of stressed asset classification. So there is something called SMA, which is called a special mention account. As you can see, a special mention account. So before a loan becoming a non-performing asset, it goes through different stress level. So these are called SMA. So first of all, SMA 0. SMA 0 means what? That if the loan is overdue from 0 to 30 days, right? This is called SMA 0. It enters SMA 0. Then comes SMA 1. If it is overdue for, especially we are talking about term loan, right? If it is overdue for 31 to 60 days, it becomes SMA 1, right? This is a signal for bank to stay alert. Then we have SMA 2. SMA 2, overdue period is 61 to 90 days. It enters SMA 2. This is the, if dues are not paid, this is the most critical stage. If the dues are not paid, right, for 61 to 90 days, the loan entered SMA 2, a serious warning sign of potential default. And then we have NPA. Sorry, if the loan become unpaid beyond 90 days, it officially become NPA. This means the borrower has defaulted and the bank may start recovering procedure. So why does this matter? So this is all. So let me show you this entire classification in the form pick. Friend, if you think that this video is helpful to you to understand the concept, please hit the like button, because it takes lots of effort to make such kind of slides for you for your better preparation. For the examination time, you just have to go through these important points and you will be able to remember all the fact, and this will specifically help you in your examination, right? So why does this matter? Because it helps bank identify problematic zone early. It gives borrower a chance to regularize payment before defaulting. Then we have something called breakdown of asset classification. Very very important, right? So let's talk about it. So friends, every bank hold different type of financial asset, but not all asset are the same. Some generate income while other cause financial stress. So there is something called performing asset. So these are like healthy asset. These are like the healthy asset for that generate regular income. Then we have NPA, non-performing asset. So when an asset stops generating income, it become NPA. But wait, not all NPA are same. Let's look at the different types of NPA. For term loan, you must remember, for term loan, if the interest or principal remain overdue for more than 90 days, right, the loan turn NPA. For overdraft or cash credit account, right, if the account are deemed out of order, they are called out of order. They are called out of order, right? When they are called out of order, means there is no sufficient balance or transaction, they become NPA, right? Then we have for bills. For bills, when a bill remain unpaid for more than 90 days, it become NPA. For agriculture loan, it is a special case. If a loan is overdue for 2 crop season, it become NPA. So for agriculture loan, it depends on the short term crop or long term crop. For short term crop, it is just one season. For long term crop, it is 2 season. For short term it is 2 season, for long term it is 1 season. What about the derivative transaction? So in this case, if there are unpaid receivable in the financial derivative deal, it become a problem for the bank. So this classification is super important. For every different kind of asset, we have different classification for NPA. Now let's look at the provisioning requirement. So this table I will tell you to remember using a trick, right? So this provisioning requirement is super important. Last year also one question was asked, one case study was asked. So let me give you a trick to remember this provisioning requirement. So you need not remember this table, just remember. So there are two kind of case. One is called normal provisioning, second is called accelerated provisioning. First of all, you must remember the normal provisioning. So what you will do, just write here secured and just write here unsecured. And in this side you write the type of asset you have, right? So you know a standard asset, I think you know about this standard asset, a standard asset, substandard asset, substandard asset, and inside it you know D1, D2, D3, right? So these are the different cases. So standard. So let's forget about a standard because standard has very small provisioning. Let's get started with the substandard, right? So suppose substandard asset is there, right? Then we have D1, D2, D3, and finally we have loss, right? D1, D2, D3, and finally we have loss. So loss, you know, loss has to, you have to give 100% provisioning for loss. So let's ignore loss also. Let's talk about D1, D2, D3, and substandard. That's it, right? So how will you remember it? How will you remember it easily? So first thing you do, you write here 100, right? You write here 100. So let me draw the table first. Let me draw the table first. So I hope the table is clear to you, right? Let me use different color plane. So I'm using this color. So 100, 100, 100. What about D1 substandard? What about D1 substandard? You know it. Okay, what about D1 substandard? I think it is also 100, right? For D1, you know, unsecured portion, secured. For D1 unsecured, yes, it is 100. So these 300 you have to just write as usual. These 300. Now for substandard secured, it is 1525, right? What it is 1525, right? So you just write here. You just write here 1525, right? You just write here 15, you just write here 25. You add both of them, it will become how much? So you just put this 25 here and you add both of them, it will become 40. So this is how you should remember this table, right? For substandard secured, provisioning is 15%. For substandard unsecured, provisioning is 25%. For D1 secured, provisioning is 25%, right? Again I am repeating it so that it become very clear to you, right? So first of all you have to draw this table, right? So this is substandard, this is D1, this is D2, this is D3, this is secured, this is unsecured, right? This is secured, this is unsecured, right? So first of all you write 100, 100, 100, 100. I hope this is clear. 15, 25. Just put 25 here and just add these two. This will give you 40. So this way you can remember the table. No need to remember this particular table. I hope this makes sense to you, right? And for accelerated provisioning only, you need to remember the provisioning value, right? We will do a separate. I will provide you a separate video on how to do the calculation, right? Because you know every year one case study they are asking based on this. So I will provide you a separate video in our crash course. Today only I will provide you. So that is the point. So that's all for this particular topic. If you cover this much, that is more than enough for this particular topic. I hope that makes sense to you. And the last slide you can see, these are the maximum extent of guarantee coverage for different category. As you can see, for micro enterprise where credit facility is up to 50 lakh, 85% guarantee coverage is there, right? When the credit facility from 5 lakh to 50 lakh, 75%. For MSE located in northeast region, it is 80%. For women entrepreneur, 85%. For rest of these you can see 85%, right? STSC, JDD, right? And other category of borrower, it is 75%. So these are the extent of guarantee cover, right? So this chart is also very important. Sometimes questions are asked based on it. So you must check of their financial health. Let's break it down into 5 essential components that form the backbone of financial statement. The first is called balance sheets. So friends, you know, think of this as the financial snapshot of a company. It shows what a company owes, that is called asset, and it shows what a company own, right? That is called, you know, so what a company own, that is called asset, and what a company owe, that is called, you know, liability, right? So at a given point of time, it shows the assets and liability of a company, that's called balance sheet.
The second kind of financial snapshot we have is called profit and loss account. So the ultimate performance tracker. This statement details revenue, right? It details expenses. It details your revenue. It details your expenses, right? Whether the business is making profit or whether it is making loss. The third statement we have is called cash flow statement. So it simply means money in, money in, money out, right? So this statement track movement of cash, ensuring business have a smooth liquidity to run smoothly. The next statement we have is the statement of change in equity. So ever wondered how ownership equity shift? So friends, this statement explain how the owner stake in the business changes over time due to profit. It explain how ownership stake changes over the time due to profit, due to losses, or due to investment. So how the ownership equity changes over the time due to profit, losses, and investment. And the last we have is the explanatory note, means the fine print that matters. These notes offer additional context, additional detail, helping investor and a stakeholder understand the number better. So each of these component is like a link in the chain, interconnected and crucial for financial decision making. Now I hope this five kind of components of financial statement is clear to you. Now the next thing we have to study is the role of financial statement. So friends, financial statement are more than just number. They impact key decision maker. So here we are talking about some key decision maker. Who are the key decision maker, right? So let's dive into their role. The first is lender. Lender is before granting loan, bank and financial institution analyze financial statement to assess the company financial health, right? So it based on company financial health. Second, is called creditor. So creditor is the supplier, creditor is the vendor. So whenever you see this word creditor, it simply means the supplier, it simply means the vendor, right? So they checks a company credit worthiness to decide whether to extend credit or demand upfront payment. The next is investor. Investor means investment is all about trust and potential. So whenever I say investment, it's about trust, it's about potential. So investor analyze financial report to determine if the business is worth funding. Then we have government body. So regulatory authority, they ensure financial compliance and transparency. So regulatory compliance means financial compliance and transparency. So they prevent fraud, they maintain economic stability. Then the next stakeholder we have is none but the rating agency. What is the role of rating agency? So friends, business rely on a strong credit rating. So every business rely on a strong credit rating, right, to attract funding, to maintain credibility in the financial market. Then we have customer. Customer, that stability always matter. So consumer prefer financially a strong company, ensuring trust and long-term reliability. Then we have employee. Job security and company culture are directly impacted by the firm financial standing. No one want to work for a company which is on a brink of collapse. And finally, analyst. Analyst, experts. So expert interpret financial data to provide valuable insight, guiding business and investor forward a smarter strategy. So financial statements are like the backbone of a business transparency, backbone of the business trust. They help business grow, right, and they help investor invest and economy thrive. So that is the importance of this financial statement. Now let's look at the foundation of the financial statement preparation. So friends, have you ever wondered how financial statement maintain accuracy, consistency, reliability? So they are built on a strong accounting principle that guide business toward transparent financial reporting. The first principle is called accrual and matching. Imagine recognizing revenue only when cash is received. Only when cash is received, right? So imagine you are doing that. So that would not reflect the true picture, right? The accrual and matching principle ensure that revenue and expense are recorded accurately when they occur, not when cash is exchanged. So whenever revenue and expenses occur, they have to be recorded only then. That is called accrual and matching. The second principle is called prudence and conservatism. So accounting is not about being optimistic, it's about being realistic. So this word realistic, let me write it down. This word realistic plays a dominant role, right? So this principle ensure that business prepare for possible losses while not overstating gain, promoting cautious financial reporting. The next point we have is called a stable monetary unit and accounting period. So to compare financial performance, consistency is the key. So here is the key word is consistency, right? So this principle ensure that financial statement use a stable currency and follow fixed reporting period, making analysis meaningful over the time. Then we have going concern and separate entity. So a business is assumed to operate indefinitely unless proven otherwise. Plus, a company finance are separate from its owner, ensuring business continuity. So it ensures business continuity, right, and independency in the financial record. Then we have consistency, cost, and finally money measurement. So financial reporting should follow uniform standards so that statements remain comparable across times and company. Costs should be recorded based on their actual value, avoiding misleading and inflation of asset. And then we have dual aspect, realization and full disclosure. So every financial transaction affect at least two account, right? One is called debit account, another is called credit account, right? Keeping balance intact. Moreover, full disclosure ensure that all relevant financial information is transparently reported, leaving no room for hidden surprises. So these are the accounting principles which are the backbone of financial statement and ensuring preparation, ensuring accuracy and transparency. So I hope it is clear. Now let's look at the breakdown of the financial structure. Ever wondered how a company financial structure is organized? Let's break it down into four key components, each playing a crucial role in the company financial health. The first is called shareholder fund. This is the backbone of company financial strength. Why? Because it includes share capital. It includes share capital, reserves, surplus, share warrant, all representing the owner stake in the business. All of these represent the owner stake in the business. The stronger the shareholder fund, the more financially stable the company is. Then the second part we have is the share application money. So before share are officially issued, investor deposit fund. What investor do? So investor deposit fund, right? So before the share are issued, before the share are officially issued, investor deposit fund, which are temporarily classified. So these funds are temporarily classified as share application money. This represent the commitment of potential shareholder before their ownership is finalized. Then we have something called non-current liability. So think of this as the company long-term financial obligation. It includes, non-current liability includes loans, it includes bonds, it includes other borrowing that the company must repay over several years. Managing them will ensure business sustainability. Then we have current liability, right? So these are the short-term obligation that a company need to settle within a year, so less than or equal to 1 year, right? From supplier payment to short-term loan, these liability must be managed efficiently to ensure smooth operation. So a well-balanced financial structure is essential for business success. Proper management of equity, security, liability ensure growth, stability, and investor confidence. So friends, this is how we are learning in our crash course. So basically I am providing you videos like this. After going through this video, which hardly take 20 to 30 minutes, you go to MCQ solving and quizzes solving. You devote maximum time there. You see your performance, whether you are able to get 60% marks or not. If not, you again read the topic, right? So this way you on daily basis you prepare and you basically become more confident. You check your strength, you make your strength, you convert your weakness into a strength, and this PDF will be available for download purpose. So at the time of revision you can just go through the main points and you are able to revise. So if you want to be part of this crash course, just WhatsApp me on this particular number and I will make sure that each and every concept is clearly understood to you, right? So now let's continue our discussion and let's talk about further topic. So the breakdown of company asset. So friends, every business rely on asset to operate smoothly, to grow, but not all assets are the same. Let's break them down into two components. The first is called non-current asset, the second is called current asset. So these non-current assets are the long-term resource. So as the name suggests, they are basically long-term resource that company hold to generate revenue over the time. So you can think of some example like land, like building, right, or machinery, or patent, right, or investment that won't be converted into cash anytime soon. So these assets provide stability and help the business grow. Then we have the second type, which is called current asset. So these are the short term resource. So if we talk about the current asset, these are the short term resource, right? So that a company expect to convert to cash soon. So basically these are the short term resource that company expect to convert to cash. This can be converted into cash soon. Example include cash, receivable. So let me give you some example of it. Cash, receivable, right? And there are some inventory is also an example of current asset. Short term investment. So the higher the current asset, the better a company can manage its daily operation. So a strong balance between current and non-current asset ensure financial stability. Now let's look at the purpose of comprehensive financial analysis. This question was asked in the December examination. So friends, a company financial analysis health is like a puzzle, and banker analyze every piece carefully before making lending decision. So first thing they do is to assess the performance. What does it mean? So the first step is evaluating the growth, evaluating the profitability, right, and overall financial health of the company. A strong performance means, a strong performance means a lower risk for lender. So try to understand this point. So if performance is strong, if performance is strong, it simply means that lower risk is lower, right? Then second thing we have is projecting the future earning. So banker forecast future financial outcome based on past trend, right? So this help predict future financial outcome based on past trend. Then the next thing is ensuring proper fund utilization. So it is crucial to monitoring how bank fund are being used. Are they failing growth or being mismanaged? Banker check this closely. Then evaluating the credit worthiness. So before approving a loan, bank gauge the company reliability, and risk factor. So a strong financial track record simply means higher chance of approval. Then we have detecting the financial distress. Early warning sign of financial trouble can prevent future loan default. So banker identify risk before they escalate. And the final point we have is verifying the financial accuracy, as you can see. So it means that number don't lie, right? So number don't lie, or do they? Banker cross check financial statement to ensure they are accurate, they are reliable. A single mistake can change everything. So a thorough financial analysis ensures safer lending, better investment, and a stronger financial system. So now let's look at the next point. Let's look at the balance sheet, how it look like. So friends, have you ever wondered how banker analyze a company financial position before approving loan? It's all start with a balance sheet, which is like a financial mirror of a business. A balance sheet summarize, assets and liability, helping credit officer determine the company's solvency, liquidity, and financial stability. What does liability mean? Liability means, the source of fund, and asset means the use of fund. So it includes, liability includes, short term liability, right, which includes working capital finance, or current liability, which is called OCL, other current liability, and it also includes long term liability, right? Short term liability is long term liability, right? So this thing must be clear to you. It includes short term liability, it includes long term liability, and also net worth. So you can see tangible net worth. So tangible net worth means company owned fund, including paid up capital, including capital reserve. So let me write it down. Owned fund includes paid up capital, plus capital reserves is there, plus surpluses are there. So these things are included in the tangible net worth. Now asset side represent how the fund are used. So asset represent usage of fund, right? So it simply represent usage of fund. So basically there are some short term use. So fund can be used for short term, like current asset, total current asset, which we call TCA, which includes cash, which includes receivable, right, which includes inventory. So these are the total current asset, you must know it. Cash, receivable, inventory, these are the part of the current asset. Then there is something called net working capital, NWC. So please look at this balance sheet, and I will make you understand each and every part. So the first part of the asset you can see is the total current asset, which includes cash, inventory, and just now we have talked about receivable. The second part is called NWC, net working capital, means the buffer between current asset and current liability is called net working capital. So we can say it is current asset minus current liability. The buffer is called net working capital. And then we have some long term use. You see the long term use. So the short term use, it includes two parts. Short term use includes total current asset and NWC, and long term use it includes fixed asset. So it investment in the fixed asset, investment in the non current asset, right, and so ensuring business growth. So in the liability side we have seen there is something called short term source of the fund there. So it includes working capital which you have availed, right, and other current liability, two part of the short term source. And the long term source we have two part, net worth, and we have total total long term liability, which is not a TL. So this is the proper bifurcation of this balance sheet. I hope it is clear. Short term use, long term use. Question may be asked, which of the following is a part of short term use? So you must answer. Which of the following is a part of short term source? You must answer, right? So this chart should be clear, this table should be clear, right? So it helps determine whether a company is financially sound and can repay loan without a stress. A balanced structure of assets and liability ensures sustainable business part. Now, any imbalance may signal financial distress, triggering red flag for lender. Now, let's look at this slide. Ever wondered how business evaluate their financial health? The right financial analysis method can uncover insight that can drive smart decision making. Let's explore the top 3 methods used by financial experts. The first method they use is called fund flow analysis. Tracking where the money comes from, where it goes. This method help in assessing liquidity. It help in assessing liquidity, right? And ensure a business has enough fund to operate smoothly. So the maxim is that no liquidity, it means that if there is no liquidity, it means no growth. That's it. So it assesses the liquidity, right? It assesses the liquidity and ensure that a business has enough fund to operate smoothly. This is called fund flow analysis. The second kind of analysis we have, is called the trend analysis. So pattern don't lie. So here the point is, pattern don't lie. This method help identify the financial trend over time, allowing business to predict future performance and make data driven decision. So the key point here is, data driven decision, right? A sharp decline means a time to act. And the third thing is called ratio analysis. Numbers tells a story. By comparing financial ratio, companies assess profitability, efficiency, stability. It's like a health checkup for a business. The right ratio means financial fitness. So these are the three method which we use for financial analysis. Now let's look at financial analysis overview. So friends, have you ever wondered how business decode their financial health? Let's break it down into 3 essential methods that help in decision making. The first, is called the common size statement. So number means nothing without context, right? So number, it means nothing without context. Context is very important. So this method standardizes financial data, making it easier to compare company of different size. Want to spot trend? Start here. There's something called trend analysis. I told you earlier, right? Financial pattern tell a story. This method help track movement over the time. So basically, it help track movement over a time, right? So it allow business to predict future performance, avoid surprise, a must have for smart decision making. And finally, we have fund flow analysis. Where is the money going? This method traces the inflow and outflow of fund, ensuring liquidity, ensuring stability. A business without cash flow is like a car without fuel, right? Now let's look at the next slide. So this is the financial analysis overview. Just now we have talked about. Let's look at the next slide. So ratio analysis. How do we do the financial health assessment? Through ratio analysis. So first thing first, that ratio analysis is not just about number. It's about understanding the financial heartbeat of a company, right? It's about understanding the financial heartbeat of a company, right? So where does your business stand? So let's break it down into 4 key financial positions that every business fall. So first, stable but unprofitable means what? It means a strong liquidity, right? A strong liquidity but low profitability. This means company is financially stable but not generating higher profit. So a business that plays it too safe might miss on big opportunity. Second is a strong financial position, high profitability, high stability. This is the dream scenario. A company with a strong profit and solid financial footing is set for long-term success and growth. Then we have financially strained, means low liquidity, low profitability. You see, low profitability, low liquidity, right? A business in this state struggle with both profit and stability. And finally, we have profitability but risky. So high profitability, low stability. So big profit might seem great, but without financial stability, it's like walking on a tight rope. One wrong move and the business could face serious trouble. So balancing risk and reward is the key, right? Now let's look at some ratios. So I hope the ratio analysis concept is very clear to you. What is the importance? Now let's look at some liquidity ratio first of all. So ever wondered how financially secure a company really is? So this liquidity ratio, it hold the answer. They help us understand whether a business has enough short-term asset to cover its liability. So whether a business have enough short-term asset to cover liability, that is what it answer. So friends, let's see 2 key ratios. The first ratio is called NWC ratio, net working capital ratio. So it measures long-term support for current asset. It simply measures long-term support for current asset, right? So it shows the margin over liability to assess financial strength, and the formula is quite simple: net working capital upon total current asset multiplied by 100, right? So one thing I want to show you, that this NWC and this TCA, one thing you must note, you look at this balance sheet. You please look at this balance sheet. So you can see this NWC and both TCA, both are the part of short-term liability. You see it, short-term uses, right? So a higher NWC ratio means the company has a strong financial cushion to handle its obligation. So it means that, it simply means that its NWC is higher, because this ratio put NWC in the numerator and TCA in the denominator, right? So if this ratio NWC is higher, it simply means this ratio will be higher. It means company has more working capital available to maintain its short-term obligation, right? And if the ratio is lower, that means that could signal a trouble ahead. So I hope this ratio is clear to you, right? You just remember this diagram, and TCA, current asset, NWC upon TCA, right? Net working capital upon total current asset. This is how we calculate the NWC ratio. This is called a solvency ratio. The second kind of ratio, this is liquidity ratio. The second kind of liquidity ratio is we have current ratio. I think you are familiar with it. It is nothing but current asset upon current liability, right? It indicates short-term liquidity strength, right? Total current asset upon total current liability. So if current ratio is higher, it simply means company can easily pay off short-term debt. But too high, it means holding excess cash instead of investing. And there is something called quick ratio. Quick ratio means quick asset upon current liability. And what is quick asset? Quick asset means current asset minus minus some inventory which you cannot convert it into quickly into cash, right? So you subtract those inventory, that will give you quick asset. So current asset, quick asset, current ratio, quick ratio. So this is all a part of the liquidity ratio, right? And understanding liquidity is very crucial. Whether you are a business owner, investor, finance student, making this ratio help, mastering this ratio help in better financial decision. Now let's look at some important ratios, profitability ratios. So friends, ever wondered how profitable a business truly is? So profitability ratio help us uncover this by analyzing revenue, cost, efficiency. So in this particular table, you will see a different kinds of profitability ratio we have. So let's get started with the first ratio we have, that is called raw material consumption ratio. Ever wondered so how you measure the impact of it measures the impact of raw material cost on total production expense. So the formula is quite simple. What is the value of raw material consumed? What is the cost of production multiplied by 100? Right. So if the cost of production is rupees 100 and raw material you have consumed is 120 rupees, for rupees 120, so 120 upon 100 into 100, that will give you percentage. Then we have the next ratio which we call PBT ratio, profit before tax ratio, right? Profit before tax. So it assesses profit before tax as a percentage of the net sale. So in denominator you will have net sale, in numerator you will have profit before tax. So a higher ratio means a strong earning before taxation. Then the next ratio we have is called PAT ratio. PAT means profit after tax. So it evaluates the profit after tax with respect to net sales, right? And then the next ratio we have EBITDA margin ratio. It gauges operating profit relative to the sales, right? So what it gauges, it gauges operating profit related to the sale. So EBITDA, what is EBITDA? Earning before interest, tax, depreciation and amortization, right? So it gauges your operating profit, operating performance. So if EBITDA is higher, it means better efficiency, better profitability. Then we have ROEC. What is ROEC? ROC means return on capital employed. So ROC simply means return on capital employed, right? So it measures how efficiently a company, right? It measures how efficiently a company uses its capital to generate earning. How efficiently a company uses its capital to generate earnings. So suppose this is the company, right? So friends, this is the capital. This is the capital. So how efficiently it is using a capital to generate earning. The formula is quite simple for ROCE. Earning is denoted by EBITDA, and capital is the total asset. Is the asset is the capital. So EBITDA upon total asset into 100. That is the formula for calculating ROCE. Return on capital employed means it is business is investing capital. How much earning it is generating? So earning is represented by this EBITDA. EBITDA you put in the numerator. You just write this EBITDA in the numerator. That represents your earning, and you just write the capital, which is the total asset which the company has, in the denominator, multiplied by 100. This will give you ROCE, return on capital employed. And then finally we have something called operating profit ratio. So it isolates core business profitability by excluding the non-operating expense. There are some non-operating expense. So it helps understand how will operation generate profit. So these profitability ratio are like an umbrella, right? They protect business from financial risk and guide them towards sustainable growth. So I hope this profitability ratio you will be able to remember. I have summarized all this thing in a single line, in a single page. If you think this was helpful, please hit the like button. Then we have the next kind of ratio which we call leverage ratio. In the world of finance, understanding leverage ratio is very crucial to understand company financial health and risk level. So the first kind of leverage ratio is called total outstanding liability to tangible net worth. So how to remember it? So I again bring your attention to this balance sheet. So please see this balance sheet which I have shown you earlier. So I am talking about this balance sheet, right? Let me show you, just wait a minute. So this is what we are talking about. So friends, you see what we are talking about, TOL, total outstanding liability, right, to the tangible net worth. So where tangible net worth is there, you see this tangible, this is the net worth, and that too tangible net worth. And total outstanding liability, right, total outstanding liability, so it includes all terms liability, all current liability, it is also included, current liability is also included, these two are also included. And tangible net worth represent net worth minus intangible asset. So from this net worth you subtract the intangible asset, this will give you the tangible net worth, right? So this is called TOL upon TNW. If this ratio is lower, it means a strong financial position. It simply means a strong financial position, right? TOL upon TNW is lower, means outstanding liability is lower, it means a strong financial position. So this is a kind of a leverage ratio, right? This is a kind of leverage ratio, TOL upon TNW. Please remember this ratio, very very important, right? Then and what is TNW? I told you. The next kind of ratio we have DER, debt equity ratio. So it shows how much debt a company used to compare to equity. So if this ratio, so it is simply debt upon equity. So if this ratio is higher, it means riskier financial structure, and if this ratio is lower, it means more stability, lower risk. Now there is something called DSCR. DSCR is called debt service coverage ratio. This from DSCR there is a numerical question asked every year, very very important. So the DSCR, there are two kind of DSCR, net DSCR and gross DSCR. If we talk about the net DSCR, it focus on cash accrual. So you will see in the numerator what is written, cash accrual is written. What is the meaning of this cash accrual? So cash accrual means net profit, cash accrual means net profit plus non-cash expense like depreciation. Depreciation is a kind of non-cash expense. It is an expense but non-cash expense. So cash accrual means net profit plus non-cash expense, right? And in the denominator, this is put in the numerator. In the denominator we write total installment due. So cash accrual divided by total installment, this will give you the net DSCR. And if we talk about the gross DSCR, it evaluates the true repayment ability, including interest payment. Interest payment is also included. So it add interest to both numerator as well as denominator. So you see cash accrual plus interest payment upon total installment plus interest payment. So interest payment is added to the both, right? So for a more accurate picture, so it is essential for credit analysis and lending decision. So you must know how to calculate DSCR, right? A strong leverage ratio and a healthy DSCR ensure financial stability and a smart borrowing decision, right? So that is the role of DSCR, and I hope it is clear, net DSCR and gross DSCR, and which gives you a better financial picture. I hope it is clear. Now let's talk about the so-called coverage ratio. So till now we have discussed liquidity ratio, we have covered what we called profitability ratio, we have covered leverage ratio. Right now let's cover the coverage ratio. So when it comes to assessing a company ability to manage its debt, so the key point is managing debt. A company is able to manage its debt or not. When it comes to assess the company ability to manage its debt, two key coverage ratio comes into play. But which one is more crucial? Let's break it down. The first kind of ratio is what we call, it is called Vanquish ratio. It tells us, it determines long-term debt repayment estimate, long-term debt repayment time. It tells us how many years it will take to clear long-term debt using EBITDA. Means how many years will it take to clear whatever long-term debt we have taken. How many years it will take to cover the long-term debt using EBITDA. Means it simply tells you that yes, this much year it will take. So the formula is quite simple. It says that you just write this long-term debt. We are just talking about the debt, not talking about the equity. You just write the long-term debt in the numerator, and you just write EBITDA in the denominator, right? So it gives you the Vanquish ratio. This question was asked frequently. Now let me give you the implication of it. See, if the ratio is lower, suppose the Vanquish ratio is lower, so what does it mean? It means that faster debt clearance. Yes, it means that if this ratio is lower, it means it will take less time. right? And if this ratio is higher, it simply means debt burden is heavy, right? Heavy. The second kind of ratio we have is called interest coverage ratio. It evaluates a company ability to pay interest on its borrowing. Yes, correct, try to understand. So interest on the borrowing, because the name itself suggests interest. So whenever you borrow money from bank, you have to pay interest. Similarly, a company has to pay interest. So how efficiently company is able to pay interest on the borrowing, it is measured by something we call ICR, interest coverage ratio. The formula is quite simple. We write EBITDA in the numerator, and you must remember that in the case of Vanquish ratio, what we have written in the numerator, long term debt, but in this case we are writing EBITDA in the numerator, and we divide it by interest expense. How much interest we are paying, right? So if this ratio is higher, it means a strong financial health, means that it can easily cover interest payment, right? And if this ratio is lower, it means there is a chance of default, means trouble in making interest payment, right? So the ratio can be higher, the ratio can be lower. Higher ratio means that in EBITDA is higher for per unit interest expense, right? So means a strong financial health, we can easily cover interest payment, because everything depends on earning. Obviously, if our earning is higher, we can easily cover our interest expense. So that is why this interest coverage ratio should be higher, and this Vanquish ratio should be lower, right? Vanquish ratio formula is long term debt upon EBITDA, and interest coverage ratio formula is EBITDA upon interest on all borrowing. So tell me, which ratio do you think is more important for financial stability? Is it Vanquish ratio, or is it interest coverage ratio? Now let's talk about the next kind of ratio. We have fixed asset coverage ratio and security margin coverage ratio. When assessing a company financial security, so here the key point is financial security. This is the key point. So while assessing financial security, two coverage ratio comes into play. The first is called fixed asset coverage ratio, FACR. It measures asset security for loan. Right? So tells us how many times fixed asset can cover outstanding term loan, right? How many times fixed asset can cover outstanding term loan? The formula is quite simple. You just find the WDV, written down value of fixed asset, right, under charge. What is the written down value of the fixed asset? There is something called written down value, right? And you divide it by the outstanding term loan. Obviously on that fixed asset you have taken a loan, so whatever outstanding term loan is there, you divide it by them. So basically it tells you how many times fixed asset can cover outstanding term loan, right? So if this ratio is higher, it means a strong asset backing, means loans are well secured. That means the written down value of the fixed asset is larger to cover the outstanding term loan. And if this ratio is lower, it means risky. Yes, asset may not be enough to cover the debt, right? So that is called, obviously, try to understand. Security, whenever bank give loan, it takes some collateral as a security, and this is nothing but a fixed asset. Like for house loan, it takes mortgage of the house, which is a kind of fixed asset. You know it very well, right? So if this WDV is higher, it means this ratio is higher, it means we have sufficient asset to cover the outstanding term loan, right? So if there is a strong asset backing, it means loans are well secured. And if this ratio is lower, it means this is a risky situation, means asset may not be enough to cover the debt. The second kind of ratio we have is called security market coverage ratio. You know what it is? It assesses the financial cushion available, right? And the formula is quite simple. You write down the WDV of fixed asset, you subtract the term loan. Let me write down the formula. This is very important. You write down the WDV of fixed asset, you subtract the term loan outstanding, and you divide it by WDV of fixed asset. So basically, sorry friends, we are comparing term loan outstanding with respect to WDV. So if this ratio is higher, it means more financial stability, means greater asset coverage ratio after debt. And if this ratio is lower, it means limited buffer, higher financial risk. So both the ratio, either we call it FACR or we call it security margin, because this word is margin. What is the meaning of margin? This way you can remember. See, there is something called WDV of written down value of fixed asset, and there is something called, so this is the security which we have taken, and there is something called outstanding term loan. Like for housing loan, whatever term loan is outstanding. So the difference is called margin, right? So if this margin is larger, it means this ratio will be larger, right? So that is why, so if this ratio is higher, it means we have more margin, more financially stable we have. The WDV of financial asset is more, right? And with the margin is lower, it means we are in a risky position, right? So I hope this makes sense to you. Now let's switch our focus to the next kind of ratio we have. There is something called raw material holding ratio. Try to understand it very clearly. So efficient inventory management is very crucial for business success. So let's break down raw material holding ratio and its key component. So the first component is called the day of stock coverage. Indicates how long the current stock will last. So obviously if longer coverage is there, if long coverage is there, it means smooth operation without supply issue, and if short coverage is there, it means risk of stock out. Then the second part aspect of it is called raw material average stock. It represents the average inventory held over the time. Average stock held over the time. It helps in tracking stock efficiency and minimizing the waste. So after analyzing both of these, the third part we have is the raw material consumed, right? So basically measure the total raw material used. So finally we have the ratio that is called material holding ratio, raw material holding ratio. So right, so it represents the average inventory held over the time. So in the numerator you will see the raw material average stock, in the denominator you will see how many raw material consumed in the period into 365. So right, so a fine balance between holding too much stock, right? If we hold too much stock, what will happen? Cost will be higher. And holding too little, so if we hold too little, production will get delays, right? So the balance between holding too much stock and holding too little is the key to the business efficiency. So optimizing this raw material holding ratio ensure cost control, steady production and efficient operation. You see the numerator. Numerator means how much stock we are holding, right? So if you are holding too much stock, our cost will be higher. And the numerator you will see raw material consumed in this period means this is called how much how much consumption is there. So this holding ratio is very important, right? This is called raw material holding ratio, RM holding ratio. The second kind of ratio we have is called SIP holding ratio and FG holding ratio. Let's understand these two. So which inventory ratio should you focus on for operational efficiency? So efficient inventory management is key to a smooth production and sales growth. There is something called SIP. What is the meaning of SIP? SIP simply means a stock in process. Stock in process holding ratio. It measures average time raw material stay in production before turning into fixed goods. And the formula is quite simple, that you write a stock in average stock, stock in process SIP average stock in the numerator, you write cost of production in the period in the denominator multiplied by 365. So it helps optimize production time management, it reduces bottleneck in the manufacturing process, and it ensures that a steady flow of good to meet the demand. Now there is something called finished good. FG means FG means finished good. So finished good holding ratio. It evaluates how long finished product remain in inventory before they are sold. So you write finished good average stock in the numerator, cost of sales of period in the denominator multiplied by 365. So it improves sale efficiency and inventory turnover. It helps avoid overstocking or stock out. It keeps cash flow healthy. So for a business, both ratio are very crucial. If this SIP holding ratio is higher, if this ratio is high, so it means slower production and there is a possible delay. And if this FG ratio is higher, it means slow moving stock, potential loss. So balancing both ensure efficient production and a faster sale, right? So we have discussed three kind of ratio here: efficient inventory management, raw material holding ratio, SIP holding ratio, and FG holding ratio. Now there is something called receivable holding ratio. Managing receivable efficiently is the key to managing cash flow and financially stable. What is the meaning of receivable? Suppose you have a company, right? Suppose you have a company, right? And you have given a product just on credit to someone. You have not received the amount yet, and that is called receivable, right? So how long do you stay unpaid? That is called receivable. How long your sale stay unpaid? So managing receivable efficiently is key to managing cash flow. So how do we measure it? There is something called receivable holding ratio, average sundry debtor. So it represents the average amount owed by the customer, how much average amount they are owing by the debtor. So high debtor means slower collection. So simple it is high debtor. So debtor increase, it means collection will be slower, and this will be cash crunch risk will rise. There is something called gross sale. Gross sale means total revenue before deduction. You have not deducted anything. The total amount you have received, total sale you have received, called gross sale. Higher sale don't always means better cash flow if payment are not collected on time. So suppose your sales are higher, your gross sale is very high. So it does not mean that you have a better revenue, better cash flow if payment are not collected on time. And there is something called time frame. It indicates how many days sale remain unpaid. If there is a longer duration, it means there is a risk of bad debt and liquidity issue. Shorter duration, it means faster cash flow. So the formula for receivable holding ratio is quite simple. You must remember the formula. You write average sundry debtor, means average level of sundry debtor in the numerator, means average amount which is owed by the debtor, and you write the gross sale of the period, means how much sale you have in the denominator. You multiply it by 365 to convert it into, right, ratio. You multiply it by 365, right? Why we multiply it by 365? Because to find the gross sale per day. That is the point, right? So this tells us number of day. So basically after doing this, what you will receive? You will receive number of day. This tells us number of days, right, it takes to collect payment from the customer. How much amount they have taken, you have written in the numerator, right? And how much is the sales, that is called gross sale of the period, right? So how many number of days, it tells you the number of days it will take, right? So it just give you number of days it will take to collect a payment from the customer, right? So that is called understanding receivable holding ratio. So a lower receivable holding ratio means faster collection and a healthier cash flow, means it takes lower number of days. And if the higher receivable ratio, it is time to improve credit policy and the follow up. So this is all about the receivable collection, right? Receivable holding ratio. Then we have payable holding ratio and inventory turnover ratio. So friends, how long you hold on to supplier payment versus how fast you sell inventory. So on one side we have the payable holding ratio, means average level of sundry creditor. Now suppose you have taken something on credit and you have not paid yet, right? So this tells us how long we take to pay our supplier. So just we write the average level of supply creditor, sundry creditor, and you just write purchase during the period multiplied by 365. So if the longer credit period is there, it means greater for cash flow, but delayed payment may affect supplier relation. And if the shorter credit period is there, it ensures goodwill but can put pressure on working capital, right? On the other hand, we have inventory turnover ratio, which simply means that net sales divided by average turnover, average inventory during the same period. It indicates how quickly the inventory is sold, right? So we write net sales divided by average inventory, right? So if this ratio is higher inventory turnover, it simply means that your inventory move fast, right, reducing holding cost. Simply you can see, if average inventory increase, this ratio will decrease, and if average inventory decrease, its ratio will increase, right? So if this ratio is higher, it means your inventory is being sold in quickly, and if the low turnover, it means risk of unsold stock leading to cash being stuck in the inventory, right? Because this ratio will be lower only when inventory will be higher. That is why denominator we have inventory, right? So the key point is that delay payment smartly but not damage supplier trust. Move inventory efficiently to maintain a healthy cash flow. That is the point. So I hope every aspect is clear. So now that we have understood each and every ratio, please hit the like button if you have understood every part of it, because in the small amount of time I have covered major ratio. Now let's look at the limitation of ratio analysis. Very important. So ratios are widely used to assess financial health, but relying on them blindly can be misleading. There is something called time discrepancy. This is one of the major limitation. So first thing is that ratio often require average to give a true picture. Using a single data can be deceptive. There is something called fiscal period versus single day. What does it mean? So a company financial health fluctuate. So analyzing just one point in time may not be reflect reality. Second limitation is the lack of context. So overlooking the cyclical variation. Business ups and downs are not always captured in ratio. A booming quarter does not mean long-term success. We ignore the seasonal trend. What does it mean? That retailer earn more during festive season. You know it very well. So ratio might not account for such kind of trend. So this is what this ratio analysis ignore. So two drawback we have already told: time discrepancy, lack of context. The third drawback is data manipulation. So there is something called inflating asset. Company may overstate asset value to appear stronger. Deflating liability. So lowering reported liability can artificially boost financial ratio, making business look risky. There is something called methodological flaws. So year-end sale spike. Some firms push sale at the year end just to improve their ratio. Does that really affect performance? No. Inherent ratio limitation. Ratio are just indicator, not absolute truth. They should always be analyzed alongside other financial data. So ratio help us analyze financial statement, but context is everything, right? Always look beyond the number to understand the real financial picture. So we have discussed every aspect of it, advantage, disadvantage. Now there is something called related party transaction. Money matters, but so do relationship. In business, financial transactions don't happen in isolation. They often involve related party. Who exactly are this related party? Let's break it down. The first point is control. When one entity has full control or full authority to govern policy, it holds control over the other. Think of a parent company dictating operation of its subsidiary. Second is called joint control. Sometimes control is shared under an agreement. Imagine two companies jointly owning a venture. Neither can make decision alone. Third point is called significant influence. This means an entity has the power to participate in decision even without direct control. For example, suppose a company holding 20% plus stake, 20% plus stake in another can influence its policy. Fourth is called key management personnel. These are the strategic decision maker, like CEO, like CFO, like director, right? So their decision can save the company future. And there are some entities in the same group, so that business under common ownership or control fall here. A parent company and its subsidiary are the classic example. Then we have something called associate. What is the meaning of associate? That company that are not fully controlled but have significant influence are called associate. Joint venture, this is called collaborative entity with shared control, where two or more companies work together but retain their independence. And finally, we have post-employment benefit plan. Not all related party, are companies. Employee benefit plan set up for worker also fall in this category. Now let's look at some example of this related party. So identifying related party is very crucial, right, for transparency in financial transaction. Not all entity involved in business dealing qualify as related party. So you can see some example given here, right? So you can see customer, right? Customer and supplier, despite their regular interaction, remain independent unless influence or control is established, right? So customer or supplier is not a considered a related party. Remember it. A second point, there is something called trade union, right? Trade union, or we call it utilities, public utilities, government agencies, finance provider, right? Finance provider. So these people, right, and even common director do not automatically fall into this category unless they exert control or they hold significant influence. Unless they exert control or hold significant influence, they not a part called as related party. Similarly, joint venture, right? Similarly, joint venture are only considered related party if joint control exists. So understanding this distinction. So let's get started. So friends, think of working capital as a fuel that keeps your business engine running smoothly, and this fuel has three key ingredients. The first ingredient is called fixed asset. That these are the essential tools like furniture, equipments, machine. They form the backbone of your business setup. Next we have the current asset. So these are your everyday lifeline. Like if you talk about the current asset, like raw materials or your finished goods, right? So raw material, finished goods, these are like current asset. So they keep your operation moving forward and help you meet the demand. And the third kind we have is called business operation. So this is where the magic happen. It's about how efficiently and how sustainably your business run day to day. That is called business operation. So three aspects we have talked: fixed asset, current asset, and business operation. So when these three work in harmony, your working capital become a powerhouse during a business success, driving a business success, right? So now I hope this will clear. The three component is clear: fixed asset, current asset, and business operation. Now friends, let's dive deeper into how working capital actually flow inside a business. So now let's deep dive into how this working capital cycle is called working capital cycle. So welcome to the working capital cycle. How this working capital actually flow inside a business. So imagine your business has a cycle, right? A continuous loop that keeps your operation active and thriving. So step number one, what you do? You purchase a raw material. This is the step number one. You purchase raw material. So it all begins here. With acquiring the raw material, you need to kickstart production. Step number two, you have to process the material, which means that we transform those raw material into finished goods, so ready to meet the customer demand. The third step is to selling the good. That then it's so time you sell those finished goods to your customer, and then you receive the payment. Okay, so let me show you the payment receiving. Here you can see payment, receive payment. So it means that once the goods are sold, the money flow back to your business as payment from your customer, and then you reinvest in material. So finally you reinvest that money to purchase even more raw material, restarting the cycle. And that is how the working capital cycle fuel continuously growth, keeping your business in motion day after day. So I hope this is clear how what are the steps involved in the working capital cycle, right? Now let's move forward and let's discuss bank finance assessment process. So friends, now let's walk through a process that bank follow before financing a business, and this is called the bank finance assessment process. Let's understand it step by step. So it's like a checklist that bank tick off to make sure your business is financially healthy and ready for credit.
First of all, they determine the turnover. You know what is the meaning of turnover? So bank analyze your business turnover based on past performance or industry benchmark. This set the stage for everything that follow. Then they assess the working capital. You know that they evaluate your total working capital, looking closely at things like inventory, looking closely at things like receivable. So they analyze your total working capital, including inventory, including your receivables. Then the next step they do is to estimate the inventory level. You know, bank estimate how much inventory your business need, factoring in supplier availability and the lead time, right? So they factor in the lead time and supplier availability. They estimate the inventory requirement. So bank estimate how much inventory your business need. Then they evaluate the receivable, right? So evaluating receivable means, you know, the bank assess how fast you collect money from your customer based on a standard market practice. This is that is called receivable. Inventory level, you know it very well. And they also estimate the other current asset, OCA. You know that finally they ensure that you have enough current asset beyond just inventory and receivable to support your financing need. So turnover, how much sales you have done. They assess your working capital, they assess your inventory level, they assess your receivable, and finally other current asset. So this step by step process help bank make a smarter lending decision while ensuring your business stay financially fit, right? So I hope this is clear. Now let's discuss the next point, how to meet working capital requirement. So friends, you know that let's now explore a key question every business face, that how do we meet the working capital requirement. Think of a working capital like fuel. I told you earlier, right? You can think of this working capital like, you know, you can think of this like a fuel for your business engine. It keep operation running smoothly, and here is how you can source that fuel. The first source can be your bank finance. You know, you can approach bank for loan to fill any remaining gap in your working capital. If there is any remaining gap in the working capital, you can approach your bank for loan. That is called bank finance. So this is a common route, especially when internal fund falls short. Then bank finance is one source. The second source can be the supplier credit. You know what it means? That you can leverage supplier credit. By negotiating favorable credit term with supplier, you can improve liquidity without immediate cash outflow. That is called supplier credit. What you do, that you negotiate favorable credit term with the supplier, right? You can improve liquidity without immediate cash outflow, right? Then we have current liability. This is another source of funding. So another option is to utilize the current liability. And what is the current liability? Like suppose you have some outstanding salary, right? Or suppose you have some customer advance, you have taken advance from customer, right? So you can use this customer advance or outstanding salary to temporarily support your capital need. So supplier credit is one thing, current liability is another thing, and the third way is the on fund. And of course don't forget your on reserve. Using retained earning, using surplus fund from the past balance sheet can strengthen your working capital position. So in short, a small combination of these options help business stay financially agile and ready to tackle day-to-day operation effectively. So friends, if the concept is clear, please hit the like button. This will motivate me to make more such content, because you know everything in this chapter is very much engaging, because it helps you retain the concept for a long time, because everything has been represented pictorially, right? In book you will see it word line by line, and you have to underline what is important, what is not important. But in this case I have filtered out every not important thing and just providing what is important from examination point of view. So please hit the like button. Now let's see the next point. Now let's discuss bank finance lending method. So friends, now let's dive into how bank decide the lending method for financing working capital. So there are three methods. Right, so let's discuss the three method. This is also called MPVF, maximum permissible bank finance. You will heard this word MPVF method. Maximum permissible bank finance. So there are three methods. So let's discuss each and every method. So the journey starts with choosing the right lending approach based on the business need and financial health. Right. So method one, which is basically, you know, gap based approach. So in the first method, bank expect the net working capital. Bank expect the net working capital to cover 25% of the working capital gap. See, suppose this is WCG. Suppose this is working capital gap. So bank expect that at least 25%, right? 25% of this WCG should be covered with the NWC, net working capital, right? So once this gap is identified, financing is provided accordingly, right? So here the main point is that, and net working capital is 25% of the working capital gap, right? Now you may ask me, what is working capital gap, what is WCG? So current asset minus current liability other than bank borrowing, right? This is called working capital gap. So basically this and you know net working capital is current asset minus current liability. So basically you have to find the WCG, and at least 1/4 of that should be covered by the NWC. That is called method MPBF number 1. So net working capital should cover 1/4 of the, and the rest portion will be financed by the bank. So on the basis of this method we calculate the bank financing. I will provide you a separate video for the numerical portion. So first of all, understand the basic concept. Now the second method we have is the current asset approach. We have the current asset. In this case we calculate WCG, but in the second case we just look at the current asset. So what you do in method number 2 is required that bank require 25% of the current asset to be funded by the enterprise itself. So you know there is something called margin, right? There is something called margin, borrower margin, means something that borrower should provide. And method number 2 say that this margin should be 1/4 or 25% of the current asset. Means the business should finance 1/4 of the current asset itself, and the rest portion will be financed by the bank, right? So this is called bank require 25% of the total current asset to be funded by the enterprise. So this ensures that a minimum current ratio of 1:1.33 is maintained. You know what is the meaning of current ratio? Current ratio means current asset upon current liability. So this is 1.33. This is an ideal ratio. And method number 3 says that this focus on the core asset. So there is the key point here is core asset. So here bank mandate 100% funding of the core asset through NWC, which result in a higher current ratio and a strong liquidity position. So each method offer a unique balance of risk and liquidity, right? Helping both business make informed financial decision, right? So first method is all about WCG, second method deals with CA, current asset, and the third method deals with the core asset. So bank finance 100% of the 100% NWC for the core asset, net working capital for the core asset, right? So please remember these three methods. I will provide you a separate lecture in the crash course in which I will provide you the case studies based question based on it, right? Now let's see the understanding the cash budget method. So let's now break down the cash budget method, which is a very powerful tool for managing business liquidity. First of all, we have something called cash inflow. You know, this is the heartbeat of any business. It is the money flowing in from sales, service, and day-to-day operation. From sales, service, and operation, cash inflow. Then we have cash outflow. So here is where your money exit the door. Payment for raw material, salary, utility, other essential business expense. This is called cash outflow. Then we have, you know, short-term bank finance. When inflow does not meet this outflow, right, short-term loan steps in to bridge the cash shortfall, keeping the business running smoothly. So suppose that cash inflow like money received, so cash inflow is less and cash outflow is more. So obviously there is an imbalance, and this imbalance is supported by the short-term bank finance. Some finance is provided by the bank, right? So when inflow don't meet outflow, short-term bank loan steps in to bridge the cash shortfall, keeping the business running smoothly. And finally we have cash flow projection. So think of it as your financial crystal ball, forecasting your future cash flow position based on expected inflow, expected outflow. So based on your expected inflow and outflow, it project your future projection. So mastering the cash budget method is all about balance, making sure your inflow and financing cover outflow while planning ahead for the road ahead. So this is how the cash budget method works. Now let's switch our attention to the next method we have, that is called Tandon committee method, right? That is called projected turnover method, also called Tandon committee method. So let's understand how it works. So friends, let's now dive into how working capital financing work for micro and small enterprise. Yes, micro and small enterprise using the projected turnover method. So first of all, you calculate your working capital, right? Working capital need. So this is where it all begins. Assessing how much capital is required to smoothly run the day-to-day business, right? You first find the working capital need. So under this approach, now comes the projected turnover method. Under this approach, we estimate your turnover. That means bank estimate the turnover for the coming year to determine your working capital requirement. That is what the bank do. So bank decide what will be the turnover, right? What will be the turnover of the business for the coming year? For the coming year, bank decide the turnover of the business, right, to determine your working capital requirement. And then the bank steps in, right? So bank finance up to 20%. Yes, bank can fund 20% of your projected turnover to meet your working capital need, right? But the enterprise must also contribute 5%, right? So turnover, suppose it's 100 crore. So for that 20% will be financed by the bank, right? So projected turnover 20% financed by the bank and 5% is financed by the enterprise, right? Enterprise, you know that business has a skin in the game by committing a small portion from its own resource, and this is backed by RBI mandate for MSE. That a regulatory framework that ensures fairness and structure in lending. But here is the key question: is your working capital cycle longer than 3 months? This is the question to ask. If your working capital cycle is longer than 3 months, right? So if yes, then apply the holding norms. This means maintaining inventory or receivable for extended period will require stricter financial discipline, and if no, for shorter cycle, bank will ensure you have sufficient liquidity without tying up too much capital. So with the projected turnover method, MSE can secure the right balance of bank support and self contribution to power their growth, right? So I hope this is clear now. So you must understand this Tandon committee method or working projected turnover method, both means the same. Now let's look at this particular table. So friends, let's now break down the comparison of working capital assessment and credit limit between digital and non-digital business, right? So let's understand. So first let's look at the digital business. So when we assess working capital need for digital business, they are typically pegged at 37.5%, but when it comes to actual credit limit sanctioned by bank, this figure drops to 30%, right? So this is the credit limit sanctioned by the bank. Now shifting to non-digital business. So the assessment here is slightly lower at 31.25, right, percent, reflecting a more traditional business model. However, the credit limit allocated is ever more conservative, standing at just 25%. So both digital and non-digital enterprise see a clear gap between assessed working capital need and the credit actually sanctioned. You can see this is the working capital need assessed is this much and credit sanctioning is this much for digital. For non-digital, working capital assessed is this much and credit sanctioning is this much, right? So the key takeaway is that the digital business tend to receive a slightly better credit margin compared to non-digital business, thanks to their faster cycle and their leaner operation. So this highlight how banks are cautious yet supportive, tailoring credit limit based on the business type and operational efficiency. So I hope this makes sense to you. Digital and non-digital business comparison we have just done, right? This question may be asked. Now let's move forward and let's see which working I told you the three finance method. The first method I told you remember, was the maximum permissible bank finance method. Second method I told you cash budget method. Third method I told you projected turnover method. Now which working capital finance method should be used? So which financial method is right for your business? Let's decode the three major method simply and clearly. So first method we have is called the cash budget method. So this method is perfectly fit for business with fluctuating operations. Remember this word with fluctuating operations. So those business which have fluctuating operation, for them this cash budget method is the best. Think seasonal industry, like you can think of tourism, like you can think of agriculture, you can think of fashion retail, right? Fashion retail. So it focus on estimating future cash inflow, future cash outflow, making it ideal for business with uneven cash flow pattern. So those business which are having uneven cash flow pattern, right? Uneven cash flow pattern, for them this cash budget method work the best. Now let's look at the turnover method. For a small enterprise with limited financial record, this is the go-to method as per the RBI guideline, especially for MSME with credit need up to 5 crore. Remember that. MSME with credit limit up to 5 crore. Remember, bank assess their working capital based on projected turnover. It is simple, it is quick, and it is efficient, right? And the third method which we have just discussed is the holding method, right? So basically that the holding method suits business with a stable operation. It is detailed, it is precise for regular production cycle, but may not be the best choice for seasonal industry. So choosing the right method can make or break your working capital management, always aligning with the business type, season, a small scale, or stability to ensure a smooth financing operation. So I hope that makes sense to you. Now let's look at the next point, working capital assessment process. So friends, let's break down the working capital assessment. If your business is seeking up to 2 crore, the bank will assess your working capital need based on just 20% of your projected turnover. So up to 2 crore, just I told you earlier, for a small business, we apply this projected turnover method, PTM, or something I call it, it is Nayak committee. Tandon committee is different. It is Nayak committee. So PTM, projected turnover method. So projected turnover method, 20% of your projected turnover. It's quick, straightforward method designed mainly for a small business. For 2 crore to 10 crore, if your requirement fall between 2 to 10 crore, bank will typically apply the cash budget method. So this means your working capital is assessed based on monthly cash flow need, perfect for business with varying cash cycle. And if it is 10 crore and above, right? So when you are talking about 10 crore or more, it get a bit more structured. Here business must comply with the loan system guideline involving detailed assessment and stricter norm to ensure financial discipline. So the bigger your funding need, the more comprehensive the assessment process become. So always be prepared with the right financial data. That is the point. So this is how the working capital financial assessment is done based on your turnover, right? Now let's look at the next point. So sales through bill of exchange, very very important. So friends, let's now explore how sales through bill of exchange actually work. So friends, first of all, first thing is that when goods are sold using a bill of exchange, the first question is the credit being provided to the buyer? The first question to ask is the credit being provided? Is the credit being provided to buyer? Right. So if no credit is provided, right, then what happen? If no credit is offered, we issue a demand bill, right? We issue a demand bill. What we do? We issue a demand bill, and the seller send it to the bank collection. Seller send it for bank collection or purchase, right? So demand bill is issued. If no credit is provided, demand bill is issued, and seller send it for bank collection or purchase. And once that is done, the bank provide an immediate credit to the seller, right? So bank provide immediate credit to the seller, giving the seller instant fund. Afterward, transport document are handed over to the buyer, and it is recorded as book debt. So remember, if there is no credit is provided, then it is recorded as demand bill. And demand bill, what happened? That the seller send this demand bill for bank collection or purchase. And once the bank collection and purchase is done, the bank provide an immediate credit to the seller, giving the seller instant fund. Afterward, transport document are handed over to the buyer, and it is recorded as a book debt. Remember it. And the second case, if it is but if the credit is provided, we issue a usance bill which the purchaser accept. So it is accepted by the purchaser, right? Usance bill accepted by the purchaser. If it is then recorded in the seller book as bill receivable. It is recorded in the seller book as bill receivable. Yes, this bill has to be received, ready for further action. To speed up cash flow, the seller might approach to the bank for bill discounting. An added benefit is that the transaction now enjoy legal protection under the Negotiable Instrument Act. So whether it is instant payment or credit term, bill of exchange streamline trade financing while reducing risk for both buyer and seller. So remember these two difference. I have drawn in the pictorial format so that you can remember the important point. And this PDF will surely help you for the last revision. So if you want to be the part of this crash course, feel free to WhatsApp me on this particular number. I will provide you the detail how to access the course. Now let's switch our focus to our next topic, which is understanding the bill finance. So friends, basically let's decode bill finance in the simplest and easiest ways possible. What is bill finance? It's all about how bank help business manage short-term funding by handling their bill. So first of all, the thing is called purchase. First of all, we have purchase where bank buy demand bill, right? Where bank buy demand bill directly from the seller, and the seller get instant cash. Next is the discount. This is where bank discount the usance bill. I told you when demand bill is there, when usance bill is there. So discounting is done for the usance bill. So these are the bill payable at a future date, but the seller get early fund from discounting. Then we have negotiation. So here bank negotiate letter of credit on the behalf of exporter, ensuring faster access to fund while reducing the risk. What about accounting? So that for the business, all these bill become the part of their current asset. So all these bill, usance bill, demand bill, they become part of their current asset, right? Basically cash inflow expected soon. And for bank, though these are marked at contingent liability, meaning bank are at risk only if the buyer default. So bill finance is a powerful tool that smooth cash flow for seller and ensure global trade happen smoothly. Now let's look at the TREDS, very very important point from examination point of view. So let's break down the magic of TREDS, which is the game changer for MSME. On December 3rd, 2014, 3rd December, RBI introduced TREDS, a digital platform designed to support MSME by solving one big pain point, that is delayed payment. What was the big pain for the MSME? The big pain was the delayed payment, and this was solved by RBI. How? The MSME submit receivable. What they do? That MSME upload their trade receivable, basically invoices, onto the TREDS platform, making them ready for action. Step number 3, corporate buyer accept receivable. So the next move, that corporate buyer verify and accept this receivable, confirming that the goods and service have been delivered, have been approved. And the next step, financier discount receivable. So now the financier steps in. Financier, they steps in, right? And the banks and financial institutions discount this receivable, turning pending payment into instant liquidity for MSME. And finally, MSME receive liquid fund, and finally MSME get their hand on the liquid fund, instantly improving their cash flow and powering their business growth. So TRDS makes sure MSME don't just survive but thrive, right? So if you want to know how this impact working capital, stick around and I will discuss it just now, that how this TRDS impact the working capital. Now let's look at screen based factoring system. So let's uncover the engine behind a screen based factoring system where every player has a crucial role. It all begins with MSME, right? A small and medium enterprise hustling to sell their goods or services and keep the economy buzzing. Then we have something called corporate buyer. I told you earlier also. So corporate buyer step in next. These are the big player purchasing goods and services from MSME, keeping the supply chain rolling. Then we have the bank. So bank provide vital financing support, offering credit and services to grease the wheel of business. Then we have NBFC factor. So you know, this called non-banking finance company is specialized in factoring, helping MSME get early payment against receivable. So NBFC factor help this MSME get early payment against their receivable. And then we have something called financial institutions, right? So basically financial institutions like bank, NBFC offer the money muscle, providing liquidity exactly when it is needed the most. And then we have digital transaction. You know, everything happen fast, smooth, thanks to the digital transaction. Invoices and bill get processed electronically. And then we have the collaboration with the technology provider. So take partner ensure that platform is seamless and secure, right? So this is how it is done. And RBI collaboration is also there. So this is called factoring method. Step by step I told you. Now structure of bank guarantee in India. So let's break down the structure of bank guarantee in India, where every block fit perfect to safeguard trust. The first is the government directive. You see this government directive. So at the top we have the government directive setting a standardized format and laying the groundwork for mutual agreement between all parties involved. This ensures that there is no room for ambiguity. The third is the bank rule. You know, see, this is the pivotal bank rule where bank clearly mention who the beneficiary is and the exact purpose of the guarantee. This defines the core commitment in black and white. And finally we have the beneficiary requirement, means where the beneficiary verify the guarantee authenticity with the issuing bank, ensuring complete confidence and trust the transaction. And there you have it, a clear robust structure where every player know their part in ensuring secure credible bank guarantee in India, right? So this is how the bank guarantee, government directive, bank role, and you know, beneficiary requirement, every stakeholder are there. Now let's look at the bank guarantee process for DGS&D contract, very important. So let's walk through the step by step bank guarantee process for DGS&D contract. So first the bank steps in and issue a guarantee specifically for DGS&D contract. So this is the starting point, ensuring the contract is backed by a financial promise. Now the bank offer, you know, bank provide officer detail for verification purpose. That this add a layer of accountability and transparency to the process. Then you know, let me zoom a little bit. Then you know, authenticity confirmation. So you know, the beneficiary then verify the guarantee authenticity directly with the issuing bank. This step help ensure that there is no room for fraud, no room for error. Then we have initial validity. So the guarantee usually comes with an initial validity period, typically 6 months. So initial validity period is 6 months, right? Beyond the actual delivery period. So this ensures that obligations are covered even after project completion. Then we have automatic extension. You know, to further safeguard both parties, there is an automatic extension clause that kicks in, preventing complication from unexpected delays. And then we have tender condition. The guarantee also ties in with the tender condition, making sure that any extension requests are only processed with mutual consent. And finally, we have non-judicial stamp, right? So all documents are issued on non-judicial stamp paper, making them legally binding and enforceable. So this is how a DGS&D bank guarantee work behind the scene, systematic, secure, compliant at every step, right? So this is how it works. Now let's switch our attention to the component of bank guarantee in brokerage. So friends, you know, let's break down the essential component of bank guarantee in the world of brokerage, a key mechanism behind secure and smooth financial transaction. First of all, security deposit. These deposits act like a substitute for cash or other asset when broker enter into transaction, keeping liquidity intact. Then we have margin requirement. We have you know, a broker must meet a minimum financial threshold, typically a 50% margin, right? Typically a 50% margin is required, and at least 25% of this must be maintained in the cash. This ensures that brokers stay financially sound during their trades. Then we have exchange regulation. So you know, rules laid down by market platform like NCDEX, MCX, designed to maintain transparency and order in the market. Then we have applicant evaluation. Bank also carry out an applicant evaluation. This is where they assess the broker profile and a specific requirement before issuing a guarantee. And then we have something called safeguard. safeguard are then put in place to protect the bank and the market from the potential financial risk, a vital step in the whole process. And finally, we have the exposure limit. So basically these are caps packed placed on how much financial risk a bank can take while supporting brokerage option. So these six components form the backbone of bank guarantee in the brokerage space, working together to make trust, to maintain the trust, to maintain safety, to maintain efficiency in the financial market. Again, I am repeating: margin requirement, security deposit, exchange regulation, applicant evaluation, right, and safeguard and exposure limits. Remember this six part. Then we have letter of credit process. So friends, let's dive into the most trusted instrument in the international trade, the letter of credit. First of all, the journey starts with, the buyer approaches their bank to request a LC. This request kicks off the entire process by signaling the buyer commitment to pay. The bank issue the LC. There is an issuing bank, right, which issue the LC. So the bank then evaluate the buyer credential and issue the letter of credit. And this document acts like a formal guarantee that the seller will receive payment once the goods are delivered as agreed. Now seller receive LC. So the seller get notified of the issued LC. This give the seller confidence to proceed. Seller supply the goods. Obviously there are some more bank like negotiating bank, advising bank, confirming bank, reimbursing bank. We will discuss in detail. We have already covered that in BFM. So just now I am giving you the brief knowledge, right? So the seller get notified of the issued LC. This give the seller confidence to proceed, knowing that the bank backed assurance is now in place. Seller supply the good. With LC in hand, the seller ship the goods according to the contract. Every step here is monitored to meet the LC outline, to meet the term outline in the LC. Then bank guarantee the payment. So bank step into guarantee payment to the seller, providing all agreed conditions are met. Finally, once delivery is confirmed, the bank release payment to the seller and transaction is complete. And then tell me what happened. After the bank, issuing bank plays a very important role, right? After the bank pay to the seller, right, the same payment is collected from the issuer, from the issuer, right? The same payment, is collected from the issuer, right, when the due date. So there are two kind of things: usance bill and demand bill. So if it is a usance kind of thing, then there is a due date. So before the due date, bank collect payment from whom? From the issuer, right? From the applicant, or we call it applicant also, both means the same. So issuer, or we can also call it the importer, right? So bank collect payment from the importer. This is how it is done. So friends, LC transaction, there is a separate chapter in your BFM book regarding this LC transaction. So this is how it is done. Now let's see the next part. Then determining the letter of credit limit. From this question is asked every year, and I will explain using simple example that how do you determine the letter of credit limit, how this limit is determined. So there is a step-by-step process. Let's get into detail of it. First of all, you calculate the EOQ. You know what is the meaning of EOQ? EOQ means economic order quantity, right? So first of all, you decide the EOQ, how much optimal order you have to make. Then you assess the lead time. So lead time, the time it takes to receive the goods is called the lead time. How much time it will take to receive the goods, this is called the lead time. And then after that, you evaluate the transit limit, means how much time it will take transportation duration. And then you determine the usance period, means the credit period for payment. And then you establish number and value. So let me give you an example to make it more clear. Suppose the lead time is 10 day. Let me write down. Suppose lead time is 10 day, right? And suppose transit is 20 days, right? And suppose usance period is 6 months, right? Usance period is given 6 months. Okay, so tell me the total time for which LC will remain outstanding will be how much? So it is nothing but 10 day plus 20 day plus 6 months. So this is nothing but for 7 months, LC will remain outstanding, right? So this is the LC outstanding time. And suppose the consumption of good is 6 crore per year. So consumption of, so how much good is consumed? Say 6 crore per year, and economic order quantity is 1 crore, means at one time we are ordering goods for 1 crore. So so please tell me, in a year there are 12 months, right? And for every 2 month, in every 2 month, one lot is getting consumed. So how many lot we have to be there? 6 lot will be there. So the frequency of LC opening is every 2 months. Why? Because consumption, you see the consumption, it is 6 crore per year, means in 1 year 6 crore of the goods get consumed. 6 crore worth 6 crore of the goods get consumed. and in every order we order for 1 crore of worth of goods. So in a year we have to order 6 times, and in a year, you know, there are 12 months are there. So every 2 month we have to order one time. So frequency of ordering is 2 month. It means at any point of time, how many LC will be outstanding? So tell me, how many LC will be outstanding? You see, it takes 7 months. LC total outstanding LC will remain outstanding in 7 months, right? So at any given point of time, just divide this 7 by 2. So it almost 3.5 at any given point of time. You know, rounding off, it will be 4, right? 4 crore. So at any given point of time, there will be 4 LC outstanding, and as the amount of each LC is 1 crore, right? Because you know, amount EOQ is given 1 crore, means it in every order we are just ordering 1 crore. So just multiply number of LC outstanding with 1. This will give you the LC limit, right? This will give you the LC limit. So let me summarize the process. What you have to do, you have to add the lead time, you have to add the transit time, and then you have to add the Ujans period, right? Ujans period. So this will give you the total time. Suppose it is T, right? Then what you have to do, you have to see the consumption, right? What is the consumption of goods per year, right? So this consumption of goods, suppose it is C, right? So this consumption of goods, based on this you have to decide what is the frequency of opening LC, right? And you have to decide that how number of LC outstanding. You have to decide how many LC will remain outstanding at any given point of time. How to determine that a number of LC outstanding? So what you will do to decide that this T, right, to decide how many LC will outstanding at a given point of time. So this T you have to keep in the numerator, and you have to divide that T by, you know, the frequency of opening LC. So T divided by frequency of LC opening. So this will give you number of LC outstanding at a given point of time. How to get this frequency of LC opening? So you have to see the consumption, right? So what you do, you just divide 12 by the consumption, right? So this will give you the frequency of LC opening. So suppose consumption is 6 crore per year, and 12 months are there in a year, you know. So a number of frequency of opening LC is every 2 months, right? So every 2 months, and economic order quantity is also, you have to see 1 crore, right? So 6 crore is total we are ordering. 1 crore is one time ordering. So you know, number of order will be how much? 6 times. The number of order will be 6 times, right? So number of order divided by basically number of order, just write it like this. So once you know the frequency, you just put in here get number of LC outstanding, and multiply the number of LC outstanding with what? Multiply the number of LC outstanding with EOQ, economic order quantity. This will give you the LC limit. So question will ask you to calculate the LC limit. So this is the process. So let me again tell you what are the process. What you have to do, first of all, you calculate the T. From T you get number of LC outstanding, and you have to also calculate the frequency of LC. So frequency of LC, once you know, then you can get the number of LC outstanding, and once you know the number of LC outstanding, you can calculate the LC by multiplying it by EOQ, right? So don't remember the formula, rather go through the basics thing which I have just discussed now. So I hope this will help you understand the concept. Now let's switch our focus and let's see the factoring transaction. Factoring, how it works, how it happened in India. So friends, you know, in this slide, factoring is a powerful tool for business to improve cash flow by selling their receivable to a factor, right? By selling their receivable. So you know, they sell their receivable to the factor, right? So it all started with the business receivable, the payment due from customer. Receivable means, you know, receivable means the payment which is due from the customer. So it all started with the business receivable. So business can sell the receivable as factor to a factor, unlocking immediate cash. Now comes a crucial decision: with or without recourse. Here you can see, with recourse or without recourse. So with recourse means what? The business remain accountable, business remain liable if the customer does not pay. And without recourse means what? The factor bear the risk, which is ideal for business wanting complete risk transfer. So without recourse, factor bear the risk, and with recourse means the business become liable if customer don't pay, right? So suppose the bank is involved. The next step is to determine the upfront payment, right? So what will be the upfront payment amount? So with recourse, who is liable? Business is liable. Without recourse, factor bear the risk. And now if the bank is involved, the next step is determining an upfront payment, means how much the business receive immediately. Upfront payment means how much the business will receive immediately. Then we have export factoring. You know, for export factoring, a key player enter, which is the AD category 1 bank. right? So these banks facilitate non-recourse export factoring. Non-recourse export factoring, that means what is the meaning of non-recourse? That factor bear the risk, right? Complete risk transfer. So these banks facilitate non-recourse export for factoring, ensuring a smoother in international trade transaction. But there is a checkpoint. Are all these conditions met? Are all these conditions met? If yes, then the process must move forward with coordination between bank and factor, and if not, then review. Finally, a report is filed in EDPMS, Export Data Processing System. So basically, factoring help business manage cash flow, reduce credit risk, and streamline the operation. This is how the factoring help. Now the next point we have forfeiting and rupee denominated trade credit process. So let's talk about the forfeiting. Using this diagram, you can understand it easily. If you want instant cash for your export receivable, then enter forfeiting. So this structured process help exporter receive upfront payment by selling their trade receivable. So they sell their trade receivable to receive an upfront payment. So first of all, exporter issue a bill. You see. So the exporter create a bill of exchange or promissory note, ensuring the buyer commit to payment at a later date. Then what happen? Then the financier discount the bill, which means that instead of waiting, the exporter sell this bill to financier at a discount, right? Getting immediate cash, no more cash flow worry. And then the RBI guideline, RBI guideline, Exim Bank and the AD Category 1 bank, RBI allow Exim Bank and AD Category 1 bank, right, to handle forfeiting transaction, ensuring a smooth operation. Then AD Category 1 bank is there. So AD Category 1 bank approval, you can see it written here, AD Category 1 bank approval. So what it means, that that bank oversees transaction, right, approving deals of up to $20 million per transaction, helping business scale big. And there is something called rupee denominated credit. What is the meaning of this rupee denominated credit? So Indian importer can raise fund in Indian rupees under a specific condition. This facility cover most export except gold. Most import except gold. Gold is not included, right? With credit period of 1 year for non-capital good and 5 year for capital good. There are two kind of goods: non-capital goods, capital good. For non-capital good, the credit period is 1 year, and for capital good, the credit period is 5 year. So Indian importer can raise fund in INR under a specific condition. This is called rupee denominated credit. So question is, why this important? Why this rupee denominated credit important? Because exporter get quick cash without waiting for buyer to pay, and eliminate credit risk and boost liquidity and business growth. So Indian importer gets this credit and exporter gets instant payment. Bank approved transaction up to $20 million per transaction. So that is the limit. Now let's look at the receivable financing process involving receivable. So friends, business thrive on sales, but what if payment are delayed? That is where financing process involved receivable comes in. So there is step-by-step process. The first step is the credit sale. So when a business sell on credit, receivable are created. The buyer get the goods now but pay later. Now receivable is recorded. So these receivable are documented in the book as asset, waiting to be collected. Remember always that receivable are recorded in the book as asset, that it is means waiting to be collected. Bank assessment. So bank assess the business financial health by evaluating its drawing power. That is called DP. DP means drawing power. Drawing power means how much credit it can get, how much credit the bank can get. That is called drawing power. After deducting the margin, yes, margin is always deducted while calculating the drawing power, means the borrower contribution. You just have to deduct that. That is called drawing power. Then to get immediate payment, a demand bill is issued. This is a formal request for the buyer to pay now, and the bank steps in, right, buying the demand bill and crediting the seller instantly. So this helps the business maintain cash flow, right? And then instead of immediate payment, a usance bill is issued, allowing extended credit term for the buyer. And if the seller need a cash before the bill due date, then bank discount it, providing immediate finance while deducting interest. So converting receivable into immediate cash, this is the first benefit, reducing financial strain on business and keeping the economy moving smoothly. So these are the three benefits of the receivable. Now let's talk about understanding bill transaction in finance. So friends, ever wondered how business manage their bill in finance? So whether it is buying, selling, or treating them as asset, let's break it down in the simple term. So friends, first of all, things is purchase of bill. So bank or financial institution buy demand bill from business. This means a business get immediate cash instead of waiting for payment from the customer. So this is one case, that immediate purchase, right? So this means the business get immediate cash instead of waiting for payment from the customer. So bank purchase the demand bill. Second thing, bank discount. So suppose if what if the business has usance bill? So this work based when a business has usance bill, means a bill payable at a later date. In the case of usance bill, so suppose the business has a usance bill but need cash immediately, so the bank discount it, providing instant money after deducting interest. The third is called negotiation. So when international trade is involved, bill are often negotiated under letter of credit. So this ensures secure transaction between buyer and seller across border. And finally, we have asset treatment. So in the end, business record bill properly in their financial statement, ensuring transparency in cash flow and profitability. This is important because it ensures steady cash flow, it reduces payment risk, and it helps in managing working capital efficiently. When should a business be offered a working capital term loan? Well, it usually comes down to two key situations. The first is when enterprise face liquidity needs, right? In simple word, when they need a smooth cash flow to keep daily operation running smoothly, right? So that is the liquidity need. Liquidity need means when they need smooth cash flow, means the enterprise need smooth cash flow to keep daily operation running effortlessly. That is when a WCTL is ideal. Second, during financial struggle, right? When a business is finding it tough to manage its net working capital, this loan act like a financial cushion. So two condition I have told you, that when should a business be offered a working capital term loan. The first is liquidity need. Whenever enterprise face liquidity need, that means when they need a smooth cash flow to keep daily operation running effortlessly, or when during financial struggle, which means when the business is finding it tough to manage its net working capital. So but that is not at all. Let's compare term loan and working capital loan, two critical tool in strategic financial planning. So in the next slide, we will see what is the difference between term loan and working capital loan. In the left side, you will see term loan. In the right side, you will see working capital loan. So friends, on one hand, term loan are your go for a structured repayment schedule, long-term financial planning, and acquiring fixed asset like machinery or property. So this is how term loan is provided, for which so you have a structured repayment schedule. It is basically for long-term planning, and here you acquire fixed asset, acquiring fixed asset like machinery or property. On the other hand, if we talk about the working capital loan, it brings on demand repayment. It has short-term flexibility, and it has the power to sustain current asset like inventory or receivable. It has the power to sustain current asset like inventory or receivable. So these are called current asset, right? So these are working capital loan. So working capital loan on demand repayment, short term flexibility, it is for short term, remember, and it has a power to sustain current asset like inventory or receivable. So the next time you advise a business, make sure you match the loan type to their specific need, be it long term growth or short term survival. If it is a long term growth, term loan is basically needful, and if it is short term growth, then working capital loan is basically. And there is a special kind of working capital loan which we call working capital term loan, which is called WCTL, and it is provided during liquidity needs, right? It is provided during liquidity needs, which means ensure enterprise liquidity for a smooth operation, and you should provide WCTL when enterprise struggle with net working capital, right? So these are the three kinds of loan which are provided: term loan, working capital loan, and working capital term loan. Now let's move forward and let's see understanding loan repayment structure. So friends, let's talk about something crucial in the world of lending, that is called loan repayment structure. So when structuring a loan, understanding how repayment will happen is the key. So let's break it down into simple terms. First of all, we have something called DSCR. What is DSCR? DSCR is called debt service coverage ratio. So friends, you know that this is the vital metric that tells us if a business can comfortably pay back a term loan. Think of it like financial health check. So you can think of it like financial health check, right? So DSCR, what is DSCR? Basically, this is a metric that tells us if a business can comfortably pay back a term loan. If the business can comfortably pay back a term loan, its DSCR will be good, right? This is a very key metric. I will tell you the formula to calculate DSCR short a while. Just wait for a few minutes. I will tell you. For first of all, you should know that DSCR is like a financial health check, right? Then we have something called liquidity ratio. I think you are familiar with it. We have talked about it in unit number 19, right? So current ratio, quick ratio, these are the liquidity ratio. So basically this is perfect for evaluating working capital term loan. Working capital loan basically. For working capital loan, liquidity ratio plays a very important role, and DSCR plays a role for term loan, right? So it means can the business comfortably pay back a term loan? So for term loan assessment, DSCR is a very good metric, and for working capital loan, liquidity ratio is a very good metric. So the liquidity ratio help us know how easily a business can meet its short-term obligation. Now moving to something familiar, that is called EMI based repayment. So this is the most common repayment style for salaried individual, fixed amount paid monthly. And for the agriculture sector, for the agriculture sector there is something called crop cycle alignment. So this crop cycle alignment works for the agriculture sector, right? So this is called crop cycle alignment. So we are discussing different kind of structured repayment. So crop cycle alignment means what? Repayment sync with farming season. In this case, what happened? The repayment is synchronized with the farming season. Farming season, right? So it is all about matching cash flow with nature's calendar. And then we have something called installment payment. So basically this is widely used by industrial enterprise, breaking the total loan into regular small payment. And then we have bullet repayment, which means this is a one shot lump sum payment at the end of the loan term, often used for short term financial need. So these are the different kinds of financial structure. So whether it is a business loan, personal loan, sector specific financing, picking the right repayment structure makes all the difference. So we have discussed all the kinds of repayment structure: bullet repayment, installment repayment, crop cycle alignment, EMI based repayment, liquidity ratio, debt service coverage ratio. These are the different kinds of repayment structure we have. Now let's move forward and let's see the next concept we have. Whenever a bank or lender looks at a project proposal for a term loan, whenever a bank or whenever a lender look at a project proposal for term loan, they don't just glance at the number, they go deep. Let's explore how professional evaluate project proposal step by step. First of all, we start with the legal compliance. The first thing to note is the legal compliance. You know that with making sure that the proposal align with all the regulatory guideline and banking risk policy. So it means that your proposal, it should align with it should align with all the regulatory guidelines. So proposal should align with all the regulatory guideline and banking risk policy. So no shortcuts here. This is called legal compliance. Second is something called management capability, which means are the people running the show competent enough? Their experience and leadership skill matter. So when I talk about management capability, it means are the people running the show competent enough? That means their experience, their leadership skill matter. Then comes technical soundness, which means is the project technically feasible? Does it have the right foundation to stay tall? And finally we have market feasibility, which means it also plays a big role, which means will this project actually succeed in the market? Is there a demand of it? This is where the bank look at the business potential. But that is not all. Bank also assess the borrower credibility before lending a single rupee. Let's dive into that funnel. So let's talk about establishing borrower credibility. So first of all, we have character evaluation. Character evaluation means what? Is the borrower trustworthy? Is the borrower reliable? Integrity is the key. So here the keyword is the integrity, right? Integrity is the key. Is the borrower trustworthy? Is he reliable? So integrity is the key. Then we have capacity assessment. Capacity assessment means what? Can the borrower actually repay the loan? That means is he able to repay the loan? Can the borrower actually repay the loan? Their financial health is reviewed. This is called capacity assessment. Then we have capital verification. Means what in their wallet? Do they have enough financial backing? That is called capital verification. Then we have collateral review. Means what asset can they place to secure the loan? So review the asset that they can secure the loan. And finally we have condition analysis. Means finally bank look at the loan terms and environment around it. Is this the right time? Are external factor favorable? So only when all these boxes are checked does a project move ahead. So character evaluation, capacity assessment means can the borrower actually repay the loan? Capital verification means what is in their wallet, and collateral review, which means what asset can they place to secure the loan. Condition analysis,
So that is how bank balance risk and reward, right? So I hope that makes sense to you. How to establish borrower credibility. So these are like, check mark. So once the bank is concerned about all this, once bank feel that yes, all this check box have been ticked, then only they give the loan, right? Now let's look at how to evaluate the project comprehensively. So friends, when it's come to evaluating a project thoroughly, bank don't just look at a single factor, they take a 360-degree approach. So what they take? They take a 360-degree approach. What is the meaning of this so-called 360-degree approach? See, so how do they evaluate a project comprehensively? Let's break it down. First, they do the environmental appraisal, which means this check how the project impact its surrounding. Is it eco-friendly? Is it following environmental regulation? It's all about balancing development with sustainability. Then we have, moving on, there is something called economic appraisal. What is the meaning of economic appraisal? You know that this look at the broader economic condition and check how resilient the industry is. It check the resilience of the industry, right? It check how resilient the industry is. Is the economy supportive of this venture? Will it survive market fluctuation? So this is called economic appraisal. Finally, we have technical appraisal. You know what is the meaning of technical appraisal? See, technical appraisal means where the nuts and bolts are examined. Does the project have the right technology, right infrastructure, and the resources to make it work? Together, these four and market appraisal, I think we have left. Yes, market appraisal is also there. So here, bank analyze demand and supply dynamic. Right. In market appraisal, bank analyze the demand and supply dynamic. Is the market ready for the project? Will it be viable in the long run? So these are the different kind of appraisal. In what we do in environmental appraisal, it is eco-friendly. What we do in market appraisal is we analyze the demand and supply dynamic. What we do in economic appraisal, that it look at the broader economic condition and check how resilient the industry is. Is the economy supportive of this venture? Will it survive market fluctuation? And technical appraisal is all about the nut bolts. That is how together these four appraisal help bank make a smart informed lending decision, and that is how the big picture is created before any fund are disbursed. So these are the four methods. Now let's look at understanding break-even analysis. Very important. From this numerical is always asked. So let's simplify one of the most powerful tool in business, that is called break-even analysis. So what exactly help a business figure out when it start making real profit? Let's break it down step by step. The first thing we have is called fixed cost, right? The first thing is called the fixed cost. You know what it means? That these are the expenses that never change no matter how much you produce. So you can think of the rent, you can think of the salaries, right? You can think of the insurance, right? So this rent, this salary, this insurance, right, they stay constant whether you make 1 unit or you make 1,000 unit. So whether you make 1 unit or whether you make 1,000 unit, these factor like rent, salary and insurance, they stay constant. Then the second thing is we have is the variable cost. What is the meaning of variable cost? So these changes based on how much you produce. More production means more raw material and utilities. In short, costs that move with the production line are called variable cost. So first we have fixed cost, second we have variable cost, and third we have the total cost. Total cost is the simple math. Add up all your fixed and variable cost and boom, you have your total cost. Now contribution. What is the meaning of contribution? Let's understand. What is the meaning of contribution? So this is where profit start peeking through. Contribution is your sales price minus the variable cost. Try to understand this picture. So suppose this is your entire sales. This is your entire sales, right? And sales, some part of the sales is contributed by the variable cost. So this portion is your VC, that is called variable cost. And the left amount is called contribution. Left amount is called contribution, and generally contribution is represented per unit. So sales per unit, variable cost per unit, so contribution per unit. So the formula for calculating contribution is nothing but sales per unit minus variable cost per unit. This will give you contribution per unit. Okay, is it okay? Is it clear now? Now then we know the contribution. So it tells you how much each unit contribute toward covering the fixed cost and generating profit. So inside the contribution you will see two parts. One part is the fixed cost, another part is the profit, right? So these are the two parts inside the contribution. So contribution tells you that how much each unit generate toward fixed cost and toward profit, right? Now what happened at the break even? This is the golden point, that this is the golden moment when your revenue perfectly match your cost. So at break even, what happened, that revenue is equal to cost, and since revenue is equal to cost, it means profit will be equal to 0. So since profit is equal to 0, so this entire, so let us draw this figure again. So this entire, this one contribution will be just made up of fixed cost, right? It will made of the fixed cost. So now how to derive the formula for break even point? It's quite simple. So let me do it for you here. How to derive the formula for you did not remember anything, right? So it's quite simple. So you can say break even point means what? Number of units. It means basically number of units that you need to sold so that your profit will become 0 or loss will become 0, right? So in this case, what we are saying, that our contribution is equal to fixed cost. So contribution per unit, which is noted by C, multiplied by N, which is noted by number of units, is equal to fixed cost. So we can write N is equal to FC upon C. So this is the formula for calculating the break even point. Means you write fixed cost in the numerator, you write contribution per unit in the denominator, and you will get fixed cost. Now you may ask me that how to get this contribution per unit. So to get contribution per unit, you have to apply this formula. You have to write sales per unit, you have to subtract the variable cost per unit from sales per unit, you will get contribution per unit, and then you will use this formula to calculate break even point. So let me again summarize the fact for you, right? First of all, sales per unit, let's denote by small s. So small s minus VC is equal to your contribution per unit, right? And so this way you get contribution per unit, and you write fixed cost in the numerator, you write contribution per unit in the denominator. This will give you N, and this small n is what we call number of units. This is called break even point. That means the number of unit which you sold, so that your total profit is 0, your total loss is 0, or your revenue is equal to cost. So please remember this formula. This will help you calculate the numerical question based on the formula which is asked frequently, right? So this tool help business plan smartly and know exactly where they will cross into the profitability. Now let's move forward and let's discuss financial break-even hierarchy. So there are some more terminology here. So friends, let's level up your understanding of how business stay financially sound. So we are diving into the financial break-even hierarchy and risk calculation. So there is something called margin of safety. You may be asked to calculate the margin of safety. What is the margin of safety? So this is your cushion, right? You can call it, this is just like your cushion. You know what it means? It is the extra sale you make over your break even point. So the extra sale you make over the break even point is called margin of safety. So in simple term, how far are you from hitting zero profit? So the formula is actual utilization minus break even point, right? So bigger the margin, the safer you are. Quite simple to understand. So margin formula is quite simple. Actual utilization, right? Actual utilization you write in the numerator and subtract that from BEP, break even point. This will give you the margin, right? So margin of safety is equal to actual utilization minus break even point. The second thing we have is called capacity utilization. You know what it means, capacity utilization? So are you using your factory, machine or team to their full potential? So this capacity utilization tells you how much of your production power is actually being used. That means production of the percentage of the production capacity used. That are you using your factory, machine or team to their full potential? So this is gauged by capacity utilization. So suppose someone asked you to calculate margin of safety. How will you calculate it? So you first of all see what is the break even point. You see the number of unit which we have to produce to get the break even point, and basically this the sales we are talking about, and actual utilization and minus break even point. This gives you, so access actual sale over break even sale. This is the formula. So you calculate the actual sale, you get the break even sale, and just subtract both of them, you will get the margin of safety. Similarly, capacity utilization is there. Now what about the break even point? You know, the magic number where your revenue is equal to your cost. I told you early, the bad break even point, what happened? That your revenue is equal to cost. So no gain, no loss, just even ground. And remember, this is found by adding your fixed cost to your contribution per unit. No, sorry, dividing. So I told you early that you divide the fixed cost by contribution per unit. This will give you the break even point. And now the last point is contribution per unit. How to get the contribution per unit? Already I told you that you subtract revenue and variable cost. This will give you contribution per unit, right? So every time you sell one product, how much is left after covering variable cost? That is called contribution per unit. That is your contribution toward covering the big fixed bill. And fixed cost, you know, these are your non-negotiable cost like rent and salary that stay steady no matter how much you produce. And here is where things get interesting. Let's talk about risk factor.
So here is the risk categorization by percentage. This is very important. So suppose you have calculated the break even point. Now what does it tells us? So what does the percentage tells us? So depending on how far you are from your break even point, your risk change. So suppose it is 50%. So break even point is 50%. It means very healthy, means smooth sailing. You are financially stable and carrying low risk. If it is 65%, it means again low risk, right? You are doing fine with only minor financial concern. And suppose now it is 70%, right? So it means medium risk. 70% means medium risk, which means things are getting tighter, right? The time to be cautious. If it is break even point is 85%, it means red flag are waving, you are close to danger zone, high cautious needed. And if it is 100%, it simply means that you are at the critical point, extreme caution is a must to avoid financial trouble. So always aim to stay on the green side of the chart to keep your business safe, right, and growing. So I hope that makes every concept clear, right? So that is how we will do it. Now let's look at the next point, financial ratio sequence. This is very important thing which we are going to discuss now. So friends, let's navigate the financial roadmap step by step. Imagine you are about to take a journey to assess your business or project financial health, especially when dealing with loans and repayment. So here is your guide. First of all, you identify the break even point. First thing to do is to identify the break even point. Means this is your first checkpoint. Determine at what sales level your business neither make a profit or not a loss, just a stable ground. This is very crucial for financial stability. Then you determine the moratorium period. You know that they think of this as a breathing space. It is a period beyond before you actually start repaying your loan, right? Obviously some moratorium period is provided. It is a period before you start actually repaying your loan. Understanding the moratorium period gives you time to prepare the cash flow. Then you calculate the DSCR, debt service coverage ratio. Basically, you know, here you assess your ability to service debt using your cash flow. So how much able you are to service your debt using your cash flow, this is assessed by DSCR, right? So the higher your DSCR, the safer you are in covering debt payment, the safely, because you know your cash flow is self sufficient to cover the debt. And the higher the DSCR, the more safer you are in covering the debt payment. Then you calculate GDSCR. See, one thing is GSCR and you just add G before it, that means gross DSCR. So what it means, that this step zooms out to evaluate the total debt servicing ability, covering all your loan obligation, not just a specific one. It is a broader view. And then you calculate net DSCR, which is called NDSCR. Now we go deeper, right? So calculate how well your net cash flow can cover loan installment and interest payment across the time. And let me tell you the formula to calculate the net DSCR. You write total cash accrual in the numerator. So you write total cash accrual in the numerator, and you add, you know, interest on all term loan. You add interest on all term loan. Interest has also to be added, and you divide that by, you right, and you divide that by so total cash accrual plus interest on term loan over the year, divide that by total term loan installment, total installment you are paying, plus interest on term loan. So interest is added on the both the side. You see, interest is added here also, it is added here also. In the numerator we write cash accrual, in the denominator we write installment, right? So obviously if this portion is higher, means you are capable enough, to pay your installment and interest using your cash accrual, right? So this portion is common, interest is common. So interest has been added on the both the side. So interest on all the term loan over the year, and denominator also interest on all the term over the year. But in the numerator we have total cash accrual, in the denominator we have installment. So this ratio is called NDSCR, net debt service coverage ratio, right? So basically it calculates how well your net cash flow can cover loan installment. So this ratio is a key signal to lender about your repayment capacity. Yes. So they will see your total cash accrual and they will see your total installment you have to pay, and on the basis of this ratio they decide your repayment capability, and they calculate the average GDSCR. So lastly they average it out. By calculating the average GDSCR over the year, you smooth out the peaks and valley to see the bigger financial picture. So but we are not done yet. Let's move to the next biggest funnel. So I hope this step is clear. How do they assess the lender capacity? Now let's look at the next point, which is understanding IRR. You know what is IRR? So let's break down how investors make a smart decision. First of all, you calculate the future cash flow. Estimate what financial return you expect from this project or investment, what it will bring in the future. You calculate the net present value, NPV. So calculate the present value of all those future cash flows. So suppose you have invested. So let us try to understand what is happening here. Suppose you have invested 10,000 rupees in a project. Just suppose 1 lakh rupees, and suppose you are getting 10,000 over next 5 years. So these are the future cash flow which you are receiving, which you are expected to receive. Then you calculate their NPV. What is the net present value of these future cash flow in today's date? And you calculate it by discounting. You know the discounting factor is there, 1 upon 1 plus r whole to the power n. By using this discounting factor, you calculate their present value, and you add all of them to get the net present value, right? And then after calculating NPV, you identify the IRR. What is the meaning of IRR? IRR is called internal rate of return. This is called internal rate of return. So what is the definition of IRR? Means this is the golden number. Why it is called the golden number? Because the discount rate where NPV is equal to 0. So we equate the NPV to 0. First of all, you see the future cash flow, then you calculate the NPV, you equate NPV to 0. The corresponding discount rate is called IRR, right? So the higher the IRR, the more attractive the project is. And finally, the step number 4 is to assess the investor interest. Means finally gauge if the investor are on board. Their interest is often based on whether the IRR beats their expectation. So the next time, whenever you are analyzing financial or pitching an investment, follow this flow to make confident data-backed decision, right? So what we do basically, what is the formula for calculating IRR? So this is the formula. You see, future cash inflow minus initial investment divided by 1 plus discount rate to the power time period. So let me write it on. Future cash flow minus initial investment, and you divide it by 1 plus r to the power time period. So this will give you IRR, right? So and there is a term which is called WACC, weighted average cost of capital. You can use this WACC at a discount rate. Now you may ask me, what is this weighted average cost of capital? So obviously I can tell you that this WACC is calculated by taking a weighting average. The capital structure, you have talked about the capital structure, either it can be debt or it can be equity, right? So there is a different discussion, we will discuss it later. So this WACC, weighted average cost of capital, it can be used as a discount rate. And IRR is also called discounted cash flow rate of return, right? Or simply rate of return. So these are the different name of IRR. You must note it down. So friends, then we have something called sensitivity analysis. So let's talk about the sensitivity analysis in the next slide. So here we are. So how to assess the financial viability and the security? How do you truly assess the financial viability and security of a loan proposal? So step number 1, you conduct the sensitivity analysis. There are 3 steps. We will discuss it step by step. So start by stress testing your proposal. What you do? You stress test. I think you are familiar with this term, stress test. Basically, we evaluate how key financial metrics hold up under tough condition. So what we do? Imagine running 4 separate what if scenario. We run 4 separate what if scenario. What if cost rise? What if sales drop? What if interest rate spike? And then we create a 5th scenario where all these adverse factors hit at once. So the 5th scenario we create when all these adverse factors, just now we have talked about the adverse factor, rising cost, rising interest rate, or interest rate spike, sales drop. So fifth case where we consider when all these adverse factors hit at once. This is the 5th case, hit at once, right? So basically, if the proposal still stands strong and the financial indicators stay healthy, we can confidently say yes, the project is viable, right? I'm again repeating. How do you conduct sensitivity analysis? So we imagine running 4 separate what if scenario. What if cost rise? What if sales drop? What if interest rate spike? And then we create a fifth what if scenario. Then we create a 5th scenario where all these adverse factors hit at once. Means sales is also dropping, cost is also rising, and profit is also decreasing. So all the factors have been happening at the same time, and we check whether our project still stands strong. If it is staying strong, then it means our project is viable, right? This is called sensitivity analysis. The second thing we have is to assess the security margin. We look for the safety net for lender. This step ensures that in case of a borrower default, there is a solid fallback, be it asset, be it guarantee, so the lender can recover the loan smoothly. It's all about minimizing the risk. So whenever I say security margin, what it means, basically, in case suppose the borrower default, or suppose there is a solid fallback, right? So be it asset, be it guarantee, so the lender can recover the loan smoothly. That is the point. That is called security margin. And finally, we assess something called FACR. Now you may ask me, what is this FACR? FACR stands for fixed asset coverage ratio. So friends, lastly, this is a step number 3 way that we do. We check if there are enough fixed asset. What is the meaning of fixed asset? You know it very well. We check whether there are enough property. We check whether there are enough machinery, right? Or we check whether there are enough equipment, right, to fully cover the loan amount. A strong coverage ratio means the loan is well secured through tangible asset, right? So if you are evaluating a project or if you are evaluating a loan proposal, make sure to walk through these 3 pillars. They will help you balance risk, security and financial strength. So basically this is all about risk, this is all about security, and this is about the financial strength, right? So these are the, so the question was the question that how to assess the financial viability and security of a loan proposal. You have to conduct the sensitivity analysis, you can access the security margin, and you can evaluate the FACR, right? You must know it. Now let's look at the type of bank financing for infrastructure project. Very important thing. So this is the peculiarity of our crash course, that everything we provide in the form of this picture, right? And this picture help you retain this concept for a longer time. So friends, let's unlock another key concept: types of bank financing for infrastructure project. When it comes to funding infrastructure, bank provide a variety of financing options tailored to their specific needs. Let's break them down. First of all, we have something called working capital finance. I think you are familiar with it. So this type of finance takes care of your day-to-day operational need, right? Your operational need is taken care of, whether it is to manage cash flow or to meet short-term business goal, right? To manage cash flow or to meet short-term business goal, working capital finance is the go-to solution to keep the project running smoothly. Then we have the term loan. I think we know it very well, that these are the classic loan meant for long-term project. They fund big ticket items like capital expenditure. You might have heard of capex, right? Helping you build, expand or modernize infrastructure. Think of it as a financial fill for your long term. Next, we have something called project loan. What is the meaning of project loan? So these are tailor made for infrastructure development. Project loan address project specific needs, from highway to power plant. This loan category ensure the large scale infrastructure dreams become reality. Then we have something called bond debenture subscription. Bond bank also invest in debt security. So these are called debt security, right? Basically offering opportunity through bonds and debenture subscription. So these instruments provide alternative financing route while offering bank solid investment returns, right? Bank invest in this kind of instrument, debt security. Then we have final technique that's called takeout financing, and the question is frequently asked from it. This is the strategic partnership model. So in simple way we can say that yes, it is a partnership model. It is a kind of partnership model, often seen in collaboration with institutions like IDFC. In partnership with IDFC, it helps bank offload long-term project risk by transferring them to a specialized financial institution after a certain period. So how does it help? Let me again explain. It helps bank offload long-term project risk. So risk offloading, which kind of risk offloading? So long-term project risk, right? So it helps bank offload the long-term project risk by transferring them to a specialized financial institution after a certain period. I will take in detail about this takeout financing because this question is frequently asked. So we have just summarized the type of bank financing for infrastructure project, right? These are the various kind which is possible. Now, so friends, so depending on the project nature, whether it is short term, long term, operational, developmental, banks have a financing solution for every stage. So if it is short term, go for working capital finance. If it is a long term, go for term finance. If it is a project type nature, then go for project loan. Or if it is partnership model, right, then go for this takeout financing. So these are the different steps available. Now let's discuss our next topic, that how to approach the infrastructure financing. So friends, how exactly do we approach infrastructure financing? There are two key pathways bank follow to make infrastructure project a reality. What are these two key pathways? The first is called inter-institutional guarantee. Inter-institutional guarantee. So what it does? What is the meaning of this inter-institutional guarantee? Do you know about it? Let me explain. So this enable bank to issue guarantee with at least 5% funded share, right? So what it means, that bank issue guarantee. This is bank. So this bank is issuing guarantee with at least 5% funded share, right? Backed by thorough due diligence. Yes, due diligence is always there, right? So in simple term, bank can support project by offering guarantee when a specific funding and risk assessment criteria are met. So if due diligence is there, means conditions are met, specific funding are met, then bank can give guarantee for the project. It is a smart way to reduce direct exposure while still supporting infrastructure development. Yes, bank is not directly exposed because it is giving a guarantee, but this is a way to support infrastructure development. And the second method is called financing promoter security.
So bank help promoter acquire share of the existing company, right? So this is a bank, right? And they are helping whom? They are helping the promoter. How they are helping the promoter? They are helping the promoter to acquire share of the existing company, to acquire share of existing company, right? So but here is the catch, but under a strict RBI guideline. So the catch is that the borrower must have a significant skin in the game, their own stake, while the bank finance up to 50% of the acquisition cost. You can see bank finance capped at 50% of that. So this is the maximum that bank can finance, right? Remember it. So plus the loan must be secured against solid asset. Yes, security should be there against the solid asset. Plus obviously this ensures that promoter is fully invested, right? Promoter is fully invested literally and figuratively. So this is called financing promoter security. Again I am repeating what is happening here, that bank help promoter acquire share of the existing company. Suppose there is an existing company, so bank help promoter to acquire share of the company, right? But under a strict RBI guideline, the catch is that borrower must have a significant skin in the game, and their own stake which should be at least 50%. So bank can maximum finance up to 50% of the acquisition cost, right? So let's shift gear and dive into the loan approval process. So how to approach infrastructure financing? Two way are there, either through interinstitutional guarantee, but the minimum 5% funded share, right? That is a point. And second is financial promoter security, financing promoter security. So these are the two techniques to approach infrastructure financing. Remember these two techniques. Remember the limit 5% funded share for interinstitutional guarantee, or 50% limit, 50% finance they can provide for financing promoter security. Now let's look at the loan approval process. So friends, because financing is not just about handing over the fund, it's a step by step journey. So first of all, what the bank do? The bank do the risk assessment. You know what it means? A thorough evaluation of all potential risk involved in the project. Bank want to make sure that loan won't turn into a liability later. Yes, this they want to ensure that this loan should not turn into a liability, right? Second is called margin maintenance. What it means? That bank ensure financial margin are maintained, acting as a buffer against unexpected challenges. Think of it as keeping a safety net in place. Then we have DER limitation. You know about the debt equity ratio limitation. So bank check that the borrower DER does not exceed 3:1. Yes, very very important. Borrower DER should be less than or equal to, right, 3:1, right? Sorry, just wait a minute. Should be less than or equal to 3:1. Why? Because to ensure there is a healthy balance between borrowed fund and the promoter's own investment. Because when I say DER is 3:1, it means for every 1 unit of equity, the borrower has taken 3 times the debt. And if they are taking more debt, it means they can't it may be possible that they can't repay their loan because they are more exposed to the debt borrowing. So that is why bank ensure that DER should not exceed 3:1. And there's something called tenor and compliance check. So the bank now verify that the project loan duration or tenor is within limit and fully compliant with the regulatory norm. No counter cutting is allowed. And finally we have something called board approval. Finally before the green light is given, the bank board must review and formally approve the loan. Only after this stamp of approval does financing move forward. So from a strategic funding option to a multi-layered approval process, bank ensure that infrastructure financing is secure, smart and sustainable. So this is how the loan approval process is done, right? The things which can taken care of. Now let's discuss takeout financing. I told you this is a very important financing method. Let's discuss step by step. So let's explore the step-by-step journey of takeout financing and liquidity support process. You see, this is a pictorial format, and everything can be made easily understand by this pictorial format. So friends, the step number 1 is that bank extend a long-term loan. Bank extend long-term loan. This is called LTL. What does it mean? See, this is a key mechanism, right, that help bank manage long-term infrastructure loan smoothly. It all starts when a bank provide a long-term loan to fund large infrastructure project like highway or power plant. This is where the foundation is laid, right? Then we have transfer of loan to financial institution. So soon after, these loan can be transferred to a specialized financial institution such as IDFC or SBI, right? So loan is transferred to the specialized. So there are some specialized financial institution like IDFC or SBI. So reducing the bank long-term exposure and freeing up fund for other project. So when the bank transfer the loan, obviously it will get the fund. So it will have more fund available to fund other projects, right? Then what happened? Then this IDFC SBI develop model agreement. They develop something called model agreement. Institutions like IDFC or SBI work together to create a flexible financing model agreement. They create something called flexible financing model agreement that benefits both the bank and the borrower. Think of it like customizing the blueprint.
right? Basically what they are doing, this model agreement is just like, you know, customizing the blueprint. That's it. Now after doing that, there is something called liquidity support from IDFC. What it means, this is step number 4. So IDFC steps in to offer liquidity support to bank, helping them manage their cash flow and maintain healthy operation while the project progress. So this is called liquidity support from IDFC, right? So IDFC steps in to provide liquidity support to whom? Bank, right? IDFC provide liquidity support to the bank, helping them manage their cash flow and maintain healthy operation while the project progress. And then the bank secure refinance commitment. The bank that secure a firm refinancing commitment from IDFC or similar institution, this ensure that once the initial loan mature, there are already a plan in place to refinance it. And IDFC agreed to refinance loan. At an agreed future date, IDFC formally agreed to refinance the loan. This is the key milestone that takes the burden of the original lender, right? And then what happened? Bank retain the credit risk. Yes. However, even after refinancing, the bank may continue to bear the credit risk of the loan. This means the bank remain responsible for assessing the managing the borrower's repayment ability. Yes, responsibility does not shift. The bank still remain responsible for the credit risk. And finally, interest rate based on risk perception. Finally, the interest rate for the refinance loan is set based on IDFC risk perception. The higher the risk, the higher the rate, and vice versa. So, at which rate this IDFC will provide the return, it is based on the risk perception, right? So, the project ensures that bank can confidently fund large infrastructure project while managing their liquidity and risk exposure effectively. So, this is how this particular, you know, these are the steps. Again, I am repeating. First of all, bank extend long-term loan, transfer the loan to financial institution. IDFC SBI develop model agreement. IDFC provide the liquidity support to bank. Bank secure refinance commitment, and IDFC agreed to refinance after a set period, and this is how it is done. Now let's look at the financing cost overrun in project. Very, very important. So friends, let's look at how we handle a financing cost overrun in project, a very real challenge in infrastructure financing. Especially, basically, we are talking about something called infrastructure financing, and you know that this kind of thing is very challenging in infrastructure financing. So step number 1 is to have a standby credit facility provided, you know, to safeguard against unexpected cost overrun. So this is point, this is called cost overrun. So to safeguard against this cost overrun, you know, lender provide a standby credit facility at the time of financial closure. So when the financial closure is happening, lender provide a standby credit facility. So think of it as a financial cushion ready to step in when things goes beyond the budget. Then we have facility factored into credit assessment. So this standby facility is not just sitting idle, it is carefully factored into credit assessment. Lender consider this backup funding while evaluating the project financial health. And then we have financial ratios are maintained, you know, that think of, thanks to this facility, the key financial ratio of the project, like, you know, DER, debt equity ratio, and you know, interest coverage ratio, ICR. So these are the key financial ratio. They stay stable even if the cost rise. It's like balancing on a tightrope with a safety net underneath. And finally, repayment terms align with the base loan. So the repayment terms of this standby credit facility align with the term of the base loan, keeping things simple and structured for the borrower. So you know, this process help project stay financially sound and attractive to investor even when the budget go off the track. So this is called cost overrun. Sometimes what happen that, you know, cost exceed. So what they do, so then a standby letter of credit, standby credit facility is provided. Right. Again, I am repeating the step. So to safeguard against unexpected cost overrun, lender provide a standby credit facility at the time of financial closure. Right. And you know, this standby facility is not sitting idle. Rather, they are carefully factored into credit assessment. And thanks to the facility of ratio maintaining, that the key financial ratio. Basically, this facility, what is the facility? A standby credit facility. Thanks to this standby credit facility, that the financial ratios are maintained as it is. They stay stable even if the cost rises. Right. And finally, the repayment term align with the base loan. So repayment term of the standby credit facility align with the term of the base loan, keeping things simple. And then the final thing which we have to study in this particular chapter is, now we have just I'm looking for presenting in front of you, you know, DCCO, very, very important. So friends, you know that let's talk about a crucial safeguard in project financing, which is called handling cost overrun. I just told you that how to handle the cost overrun, right? So sometimes project exceed their planned budget, but here is how bank step in smartly. So there is something called pre-approved standby facility. I just talked about it now. So if the standby facility was already pre-approved during financial closure, bank are ready to fund the cost overrun without any hurdle. It's like having a financial parachute packed in advance. No pre-approval is required, right? You can see if not pre-approved, right? No worry.
Even if there was not a standby facility pre-approved, bank can still finance overrun caused by DCCO extension. Try to understand. This question is most frequently asked. Right? Bank can still fund overrun caused by DCCO extension. You know what is the meaning of DCCO? Right? Basically, up to 2 years for infrastructure project and up to 1 year for non-infrastructure project. So because of this DCCO extension, what happened? Sometimes some extra cost is required, and bank can finance. Even if no pre-approved, no standby facility is pre-approved, bank can still overrun fund overruns, cost overrun, all without classifying the loan as restructured. Right? They have not to classify the loan as restructured, provided certain conditions are met. But there are conditions. What are the conditions? The condition, let's understand the condition. Condition is that bank must fund interest during construction. Bank must fund interest during construction, which is called IDC. Right? That is called interest during construction. Second point, it can cover cost overrun up to 10% of the original project cost. Suppose original project cost was 1 crore. What is 10%? 10 lakh. So this is the maximum that the bank can finance. Cost overrun can happen, and they should maintain that original debt equity ratio. And they ensure that promoter bring their share first. Yes, this is very important. And finally and importantly, keep loan term unchanged or even more favorable to the bank. So the key takeaway is that this 10% overrun ceiling or overrun cap apply to everything, including cost hike from current fluctuation linked to DCCO extension. So friends, now you can see. So let's break down the loan document execution process step by step. First of all, it all starts with the borrower. Right? So basically, borrower who signed the essential loan document, this kick start the entire lending process. Next, the guarantor steps in. So basically, by signing the document, the guarantor agreed to share the liability, standing shoulder to shoulder with the borrower. Then, once these signatures are in place, the charge is created over the primary security. As you can see, it means that this charge legally secures the lender interest in the borrower asset. Moving forward, the owner of the collateral. So owner of the collateral sign. So if it is someone other than the borrower, also sign all the relevant document to formalize the collateral agreement. Interestingly, if the collateral owner is not the borrower, they not become a guarantor. If the collateral owner is not a borrower, then they become a guarantor by default, adding an extra layer of assurance for the lender. Finally, everything is wrapped up by following a standard legal documentation. Right? A standard legal documentation, the usual set of paper which is used for most loan. So each step ensures that loan is legally sound, secure, and ready to be disbursed. So that is the meaning of loan document execution process. Now let's move to the next slide. Let's look at the credit document processing sequence. So friends, let's explore the credit document process sequence, a crucial path that ensures a smooth credit documentation. Step number 1, as you can see, is ensure proper stamping. So before everything else, verify that all documents are properly stamped. This is a legal must do before moving ahead with execution. So first of all, you do the stamping. After doing the stamping, then you do the execution. That is the first point. Now, with the step number 2 is to verify the authority to sign, which means check if the people signing the documents have the legal authority and the capacity to contract. This step safeguard against unauthorized commitment. And step number 3 is to complete document before signing. So before putting pen to the paper, make sure every section of the document is fully completed, no blank, no missing information. And then you have to register the charges with the ROC. That means ensure that all documents are registered with the sub registrar within the legal prescribed time frame to make them enforceable. So this is the point. So ROC within 30 days. So register any necessary charge with ROC within 30 days. So remember this deadline 30 days is very, very important, and complete registration of the document with sub registrar within the time frame. So each step matter. It's about making the document legally valid and protecting all the parties who are involved in this particular legal transaction. Now then we move forward to the next topic, which is the asset registration overview. So in this particular diagram, you will be able to understand, basically we will able to clear look at the asset registration overview, a key step in securing asset legally. At the heart of this process, we have various type of asset registration, each protecting a different category. So the first kind of charge you can see is called the mortgage charge. So basically, mortgage charge need to be registered with CAIIB. I think you know CAIIB. That is the Central Registry of Securitization, Asset Reconstruction and Security Interest of India. So remember, mortgage charge has to be registered with CAIIB. Then we have something called security interest. So again, beyond mortgage, other security interests are also registered with CAIIB, ensuring transparency and legal enforcement. What about the vehicle charge? Try to understand. When it comes to vehicle, registration of the charge is done through the Vahan portal. So there is a site which we call Vahan. Through this site, registration of vehicle is done, which is an India National Vehicle Registry. Then what about aircraft? So aircraft, yes, even aircraft charges are registered, but this time with the DGCA, right? So the Directorate General of Civil Aviation. What about the ships? So friends, finally for the ship, these are the assets. So the asset for ships, registration happen with the Mercantile Marine Department, right? Securing the lender interest in the maritime asset. So all the registration work like an umbrella, offering legal protection to lender and stakeholder across various industry. So I hope that makes sense. Different kinds of asset registration, I have made it clear to you. Please hit that like button if you really think that this concept is helpful to you. And friends, if you want such type of content for each and every unit, you can enroll in our CIB crash course program, which I have just launched, and this will help you cover the entire syllabus, all the important part of the syllabus in a very small amount of time, right? So to get more detail, you can WhatsApp me on this particular number, because the video you are seeing is just a part. The entire video is available in the crash course program. Now let's move to the next part. The next part that we have, let me show you. So this is the next part. Should personal guarantee be required for loan security? So this is the question. Now let's address a critical question in the world of lending. Should personal guarantee be required for loan security? On one hand, personal guarantee are often required for a company where promoter, director or trustee have limited or no liability. Often what is happening, that on one hand personal guarantee are required. Yes, personal guarantees are required for those company where promoter, where director, where trustee have limited or no liability. In such cases, bank insists on personal guarantee to make sure these individuals are held jointly and severely responsible. It is a way to safeguard the bank interest when corporate liability is limited. So again I am repeating, yes, personal guarantee is required for loan security in those cases where promoter, director, and for those company and entity where promoter, director or trustee have limited or no liability, right? So in this case, bank insists on personal guarantee to make sure these individuals are held jointly and severely responsible, right? But on the other hand, personal guarantee may not be necessary in the case of sole proprietorship, partnership, right? Because owner already have unlimited liability, meaning their personal asset can be attached directly, right? So in this company cases, they were having limited liability, but in this case, they have unlimited liability, like proprietorship, partnership, personal guarantee of honor. So it's not necessary, because their unlimited liability allow attachment of the personal asset. So but wait, there is more to it. Let's dive deeper into when personal guarantee plays a key role in the credit delivery. So let's look at the next slide. Should a personal guarantee be required for credit delivery? So friends, see, there is a point. There is something called closely held company. Try to understand. Closely held company. Personal guarantee, it help ensure continuity in management and act like a cushion to protect the bank interest. So for closely held company, yes, personal guarantee is required. For delays in asset charge. So what happens, sometimes asset charge may get delayed. Personal guarantee provide a temporary layer of security to the lender during this delay, because I told you now that asset has to be registered, has to be charged has to be created over asset, and to whom charge is to be created, I just told you. For mortgage, there's a different, for Sarsai, right? For mortgage, Sarsai is there. For different kinds of asset category, different charges have to be registered, right? But suppose delays happen, then what to do? Then this personal guarantee will help you, right? And then the public company with weak financial, right? This is the case. So when a company financial strength is questionable or cash flow is unstable, personal guarantee act like a critical risk mitigator, right? So there we have to do it. And finally we have subsidiary with weak financial. For subsidiary that are financially vulnerable, guarantee safeguard against unexpected default. So while personal guarantee are not always mandatory, they are a vital tool when risk factor arise. So that is the point which I have answered, which I have raised, explained through this particular diagram. Now let's shift to our focus to the next diagram, which is, should exception to the prohibition or remuneration for guarantee be allowed? So let's try to uncover it. So friends, let's tackle a tricky question now. Should exception be allowed to rule that prohibit remuneration for guarantee? Should exception be allowed to that rule? There is a rule that prohibit remuneration for guarantee. Should exception be allowed to this rule? So it's like standing at a crossroad, two path, two perspective. So the first says that allow exception. You can see on the left side it says that yes, allow exception. So in some cases, exceptions are permitted. Imagine a situation where the guarantor are no longer part of the management, yet their personal guarantee still protect the bank. In such scenario, allowing remuneration can make sense, as it compensates for the ongoing risk they bear even without having active role.
And second case, do not allow exception. On the flip side, many believe that we should stick strictly to the rule. Why? To avoid any potential misuse or ethical concern that could arise if exception become too common. So this strict approach ensures integrity of the prohibition is maintained. So what do you think? Should flexibility be allowed, or should we stay firm on policy? So this is a classic debate between pragmatism and discipline, both having valid reasoning depending on the context. So on one side you say that yes, allow exception, right? Means rules that prohibit, there is a rule, right, that prohibit remuneration for guarantee. So but sometimes you can allow, right? For example, I've given you the situation, right? Suppose a situation where the guarantor are no longer part of the management, so yet their personal guarantee still protect the bank, right? So this situation I have told you, this is an exception which is allowed. Now let's shift our focus to our next slide, and in the next slide we are talking about managing working capital in sole banking arrangement. Very very important discussion we are going to do. So friends, how working capital is managed under a sole banking arrangement. First of all, everything initiate sole banking arrangement. So this is the first point. Initiate sole banking arrangement means the business manages working capital through a single cash credit account. So there is a single cash credit account through which the business manages working capital with one bank. So business has a cash credit account, or we call it CC account, with a bank, and through which this working capital is managed. Simple and centralized. Then route transaction through bank, which means not all your business transaction, inflow and outflow, are route. Sorry. Next point is that all your business transaction, whether inflow, whether outflow, are routed exclusively through this bank. This gives the bank full visibility of your cash flow. Then open account with other bank. So but wait, what if you need another account? You will need formal approval from your sole banker before opening account elsewhere. It keeps the bank in the loop. And then you have to obtain periodic statement. So then regular financial statement comes into play. So these report help the bank monitor your drawing power, right? So they can monitor your DP is called drawing power, ensuring that your cash credit usage stay within the sanction limit. For every cash credit account there is a sanction limit, and to ensure that your utilization, your cash credit usage stay with that limit, DP is used. DP is called drawing power, and for that you have to give the periodic statement, right? So based on your periodic statement, your DP is decided. This is very very important point. And regulate cash credit utilization. Basically it's all about discipline. Maintaining credit usage strictly within the approved limit is the key to maintaining a healthy financial profile. And finally, how do we derive the DP? I will tell you the formula to calculate DP. Just right now listen to me carefully. How is this DP calculated? So basically bank assess your current asset, current liability, using monthly stock statement. So you submit your monthly stock statement, then bank assess what is your current asset, what is your current liability, right? Based on your monthly stock statement, based on your book debt, based on your sundry creditor. So applying margin to figure out your drawing power. So on all these things, your monthly statement, book debt, sundry creditor, some margin is applied, and then drawing power is derived. So at the end of this video, I will tell you a numerical based calculation based on the drawing power. So stay tuned till the end, and I will explain how to solve question based on drawing power. This is most frequently asked in numerical type. Now let's focus our attention to our next topic, that how should working capital be allocated to stabilize funding use. This is a very important discussion we are going to do. So let's explore two common approach. The first approach, we have the cash credit focus. On the left side we have the cash credit focus. So the question is how working capital be allocated to stabilize fund use. So this method offer flexibility. When I say cash credit focus, it offer flexibility. Borrower can dip in and out of fund as needed, but there is a catch. It may result in fluctuating utilization and unpredictable cost, right? So borrower can dip in and dip out fund as needed, right? They can withdraw, and they can deposit the fund as and when required, but it may result in fluctuating utilization, right? It may result in fluctuating utilization, right? Of what? For fluctuating utilization and unpredictable cost. So during period of tight liquidity, borrower might max out their limit, causing bank to face high short-term borrowing cost. But during slack period, low utilization leave idle fund lying around, a double-edged sword, right? So basically what is happening? So there are two periods, right? So there is a period called tight liquidity, right? So there is a period of tight. So depending on which kind of situation is it, let me explain. So depending on which kind of situation it is, imagine a bank give loan to business through something called credit limit, like a credit card, but for a company, right? So there is a period called tight liquidity period. Try to understand, this question was asked.
So suppose there is a tight liquidity period. So tight liquidity period means, money crunch time. When the market is short on money, that is called tight liquidity. Company will quickly use up all the money available to them under their limit to survive the crunch. Now the bank suddenly need more cash to meet this high withdrawal, so it may have to borrow extra money at higher interest rate, increasing their short-term borrowing cost, and this eats into bank profit. And sometimes, there is a slack period. Slack period means what? Try to understand. Slack period means when the market is flush with the cash. This is called slack period. So company don't need to borrow much. So the bank fund are just sitting idle, earning little or no return, while the bank is still paying interest to depositor, is still paying interest to depositor or other obligation. So in tight time, higher cost due to borrowing. See what is happening in the tight liquidity time, higher cost because the bank has to borrow the money, right, at higher interest rate, and the slack time, the lower income because the money is idle, right. So the bank is stuck both the way. That is called double-edged sword. It struggle either with higher cost or with low return depending on the market condition. So that is the cash credit focus. That is the point of understanding the cash credit focus. I hope that makes sense to you, right. So that is the point of understanding cash credit focus. Now let's look at the other side. There is a fixed term loan allocation, right. So you can see then the point of cash credit focus, what we have learned, that during period of tight liquidity, borrower might max out their limit, causing bank to face higher short-term borrowing cost, and during slack period, low utilization leaves idle fund lying around and double-edged sword, because fund is lying idle, and from where the fund are coming to bank? Obviously from the depositor, and bank is paying interest to the depositor. So this is called double-edged sword. This question was asked last time. Then there is something called fixed term loan allocation. So this strategy brings stability. Yes, it brings flexibility, right. This cash credit focus brings flexibility, but this fixed term loan allocation, it brings stability. Why it brings stability? Let's try to understand. Because by combining both fixed and flexible funding component, business can smooth out cash flow ups and down. The result is that lower idle fund reduce borrowing cost also reduce, and much and more predictable fund uses. So which part should you choose, the flexibility of cash credit or the stability of fixed term loan? Because whenever bank offer fixed term loan, then by combining both the fixed and flexibility, right, it combine both fixed and flexible component. That is the point, right. So this is the point which I want to raise through this particular. So the question was, how should working capital be allocated to stabilize fund uses? By using this fixed term loan allocation, right. Now the next question is how to structure working capital limit for borrower. So when it comes to managing borrower, a crucial question arises, that how do we structure working capital limit effectively? So let's break it down step by step. There is something called loan component. So remember, for large borrower with working capital limit of 150 crore and above, right, it is essential at least 60% of this limit is structured as loan, and yes, there is a flexibility to increase it further, right. Again I'm repeating, for large borrower means those who have working capital limits of 150 crore and more, right. These are called large borrower. So it is essential that at least 60% of this limit, suppose the limit is say 200 crore. What is 60%? 60% is 120 crore. At least 120 crore should be as loan, right. At least 120 crore should be as loan, right. So basically and it can be extended further, it can be increased further. A second way to structure working capital limit for borrower is to include commercial paper. So if commercial paper are sanctioned, they must be counted as a part of loan component, right. They must be counted as part of loan component. It ensures proper integration within the borrower working capital, and you have to exclude certain credit. So but don't forget, export credit and inland sales bill limit are excluded from the loan component calculation. So basically what we talk about the loan component calculation, the first thing that loan component should include for borrower having working capital limit of 150 crore and more, they should have 60%, at least 60% should be the loan component. Second point, any commercial paper should be part of the loan component, and we have to exclude some kind of credit like export credit, inland sales bill limit outside of the loan component. So that is the point which I have explained, how to structure the working capital limit for borrower. Now let's shift our focus. So friends, now let's walk through the loan structuring and management process step by step. So determine loan amount and tenor. So start with consultation, right. First start with the consultation, right. Finalize the loan amount and the tenor, which must be at least 7 days. So this should take at least 7 days. Loan amount and tenor, with you consult with the borrower to set loan parameter, loan amount and tenor. Then you structure the multiple loan, which means design loan with varying maturity to balance flexibility and repayment timeline. Now you ensure the RBI compliance. All consortium lenders. So basically this point is about the consortium. You know about this consortium thing,
right? So how consortium works, that is the point I'm talking about. So basically all consortium lenders must stay in sync with RBI guideline. Then individual bank responsibility. Basically what happen, whenever multiple bank arrangement is there, MBM is multiple bank arrangement. So whenever multiple bank arrangement is there, each bank within this MBA is responsible for managing it on compliance independently. Then you set the repayment terms, means fixed repayment schedule, whether it is via installment or bullet payment based on borrower need. You know what is the meaning of bullet payment? It means the entire payment will be paid at the end of the repayment terms. And finally apply rollover option. So consider rollover option, ensuring they comply with the IRAC norms, so income recognition and asset classification norms. So a systematic approach like this helps stabilize the borrower cash flow while keeping the lender risk in check, right? So that is the point. So this is how loan structuring and management process is done. Now let's look at the term loan disbursement process. So friends, let's explore the term loan disbursement process step by step. First of all, it all begins with the borrower contributing their share upfront, which is called margin, right? So borrower deposit margin, right? So this margin ensures the borrower has a skin in the game before the bank move forward. Then bank debit the loan amount. So it means once the margin is secured, the bank debit the full loan amount from its own account to get ready for the next action. Then bank remit payment to the seller. So next the bank take charges and directly transfer the fund to the seller on the behalf of the borrower, ensuring a smooth and secure transaction. Then there is a proof of partial payment, which means in certain cases if the borrower has already made partial payment to the seller, the bank will require proper documentation as proof before disbursing the remaining amount. And then you have direct credit for personal loan. So and if it is a personal loan, the process is simple. The sanctioned loan amount is directly credited to the borrower account. So whether it is a business transaction or a personal need, this process ensures that disbursement is secured, systematic and hassle-free for both borrower and the lender. So this is how the term loan disbursement is done, a step-by-step process I have told you. Now let's shift our focus to the next topic, which is the project loan disbursement. How project loan is disbursed? Let's look at it. So let's decode the project loan disbursement and equity infusion process. So it all kicks off with when the bank decide to disburse the project loan, right? Setting the wheels in motion for the funding the project. It's called initiation. Then we have step number 2, that is promoter equity infusion. What it means? So basically promoter now steps in and select an equity infusion strategy. So there are some methods. Either they can opt for full upfront contribution, or they can opt for partial initial contribution, or they can opt for proportional infusion alongside the loan, right? So what is the meaning of this full upfront partial? Let's understand. So if it is full upfront contribution, it means promoter contribute the entire equity amount at the very start of the project. This shows a strong promoter commitment and boosts lender confidence, right? So basically promoter, in this case full upfront contribution, promoter contribute the entire equity amount at the start. And then if it is a partial initial contribution, so promoter contribute 40 to 50% of the equity initially upfront, with the balance infused as the project progress. So as the project progress, balance amount is infused. And if it is a promotional infusion, it means that this is a balanced approach where the promoter inject equity in phases. So this is called phase-wise injection of equity, right? So basically what happened in proportional infusion, that it match with the bank financial throughout the process timeline. And there is something called debt equity ratio policy. Try to understand what is the meaning of this debt equity ratio policy. So friends, that bank apply a strict DER policy. This is called debt equity ratio policy, right? This policy is strictly applied especially in the project loan, ensuring the right balance between borrowed fund and the promoter equity, right? And it ensures compliance. So finally bank actively monitor and make sure that promoters contribution align within the agreed DER at every stage of the project. So this process ensures transparency, discipline and sound financial health for both the bank and the promoter, right? So that is the point which I make to understand using this particular diagram. Now let's shift our focus to the next diagram, that which banking arrangement should be chosen for financing. So confused about which banking arrangement to choose for financing? Let's simplify it for you with these 3 common approach. The first approach is called sole banking. So basically if your funding need fall within the limit of a single bank, every bank has a limit on how much they can lend to a single corporate borrower. So if it fall between the single bank limit, then it is straightforward. Sole banking is the way to go. It is straightforward and ideal for a smaller project that don't require multiple lender. Second option you have is consortium banking. Basically when the financial requirement is larger, you will need multiple bank to pitch in. Here one bank act like a lead bank. So basically this is the concept of lead bank, right?
and they lead to coordinate the entire loan structure. This is called consortium banking, perfect for large scale project where teamwork among the bank is the key. And the last thing we have is multiple banking. So basically, if you want more freedom, multiple banking offer flexibility. No formal coordination between bank, but you can tap into several banks separately, managing each loan individually. So it all depends on your project size, risk appetite, and how much coordination you are ready to handle. The types of banking arrangement you have to choose, right? So sole banking, either you have consortium banking you have, or multiple banking you have. Now let's shift our focus to the next topic, which is loan syndication process. Very very important topic. So ever wondered how loan syndication really work? Let me walk you through this step by step journey. So it all starts with the borrower select a trusted lead bank to arrange the loan. So there is a lead bank. Borrower trusts them to arrange the loan, right? So think of this as the bank as the captain of the ship. Now the lead bank reaches out to other bank to form a syndicate, right? This is the second step, because big loan often need multiple player working together. Then what the bank do? Bank assess proposal, which means each bank in the syndicate review the loan proposal according to their own credit policy. Every bank has their own credit policy, you know it, right? And since bank has their own credit policy, so what happened, each bank in the syndicate review the loan proposal. This is where they decide how much they are willing to contribute. And then lead bank coordinate the process. So basically, once commitment are in, the lead bank takes charge and manage the entire syndication process and negotiate terms with all the parties. And finally, meeting organized among banks. So the lead bank organize formal meeting with all participant bank to finalize agreement and iron on any detail. And finally, syndicate fee is charged. So for all this coordination, the lead bank charges syndication fee for its service. So it is all about collaboration, coordination, and confidence, right? So this is how it is done. So I step by step process I have told you: a lead bank, a syndicate bank, how it works, every aspect we have covered. Now there is something very very important. So friends, with the rise of STP, you know what is the meaning of STP? STP is called straight through processing. Remember it. This is called straight through processing. So with the rise of STP, right, and CUE, that is called credit underwriting engine, the entire loan cycle from application to disbursement is now highly automated and cutting down manual work and boosting speed and efficiency. So how it works. So so basically, let me tell you what automation of the loan processing. In this slide you can understand it, right? How it automated, how it get automated. First thing is that loan application is received, right? Which means this journey begins as soon as the loan application is received. Then automated processing initiated. No waiting around. The system automatically starts processing the application in real time. Then compliance check performed. So basically, automated tool jump in to conduct regulatory check, ensuring everything complies with the rule. Then decision making process. So basically, the system now evaluate the application, make decision based on the preset logic and credit rules, fast and objective. Then loan is sanctioned. Basically, once cleared, the loan gets sanctioned through automated approval workflow, and disbursement process begin. Funds are ready to flow. The system initiate the disbursement process efficiently, and minimum manual intervention. So the best part is that human involvement is very minimal. Only a few essential tasks are left for manual handling. So what is used to take days or weeks can now happen in hour thanks to automation. So you can see, using automation, the entire process of loan disbursement, loan sanctioning process, everything is getting automated, right? And this is thanks to STP, that is straight through processing, and CUE. This process has now is automated. Now so friends, let's look at the credit risk mitigation process. So friends, that now that we have automated loan processing, so let's talk about something equally critical, which is mitigating credit risk. With loan expanding beyond personal finance into MSME, commercial sector, managing risk has become more sophisticated. Here is how banks are stepping up their game with technology. First thing they do is the data integration, which means that this comes with the power of first all borrower information is gathered and consolidated into one unified system, no more silos. Then we have AI analysis, which means this is the power of artificial intelligence. AI drive deep into borrower behavior, analyzing pattern that a human eye might miss. Then anomaly detection. So means automated tools detect any kind of irregularity in the data, like red flag, before they become real issue. Then we have risk assessment. With insight in hand, the system now evaluate potential risk linked to each loan, whether it is personal loan or a business facility. Every file is put under the risk radar. That is called risk assessment. And then step 5 is to inform decision making, which means finally bank based on all this data and analysis, bank can make a smart confident lending decision. So from data collection to risk informed approval, thus funnel ensure that lending is safer, faster, and smarter. right? So this is how. Now let me show you the next slide, and I will tell you how to calculate the drawing power. This is very very important. Drawing power, let's break down how bank calculate drawing power for a business under cash credit limit. So this is the topic from where numerical question is asked in every examination. So friends, imagine a business had been sanctioned a loan limit of 500 lakh. Suppose sanction limit is 500 lakh. Okay, but wait, the bank won't just hand over the full 500 lakh immediately. Bank first check two key things. The first thing that bank check is the stock the business has. What is the stock value of the business? In this case, it is worth 400 lakh. And also the bank checks the book debt. What is the meaning of book debt? You know the meaning of book debt. Book debt means the business unpaid customer invoice. So some invoices had not been paid by the customer. So this is called book debt. Business unpaid customer invoice. So which is left pending of the customer payment amount. So which is how much? 300 lakh, right? But there is a twist. Bank apply a margin that is like a safety buffer, right? So on stock, the bank apply margin of 25%, and on the book debt, bank apply margin of 30%. So more margin on book debt because risk is higher there, right? So basically, first of all, step number one. So such type of thing will be given into the question. You will be given sanction limit, you will be given stock value, you will be given book debt, right? And obviously margin on stock and margin on book debt, right? And the business has a stock worth 400 lakh, but it also owes rupees 100 lakh to creditor. Yes, it owes something 100 lakh to the creditor, means it has borrowed money from creditor and is not paid yet. It is still remaining to be paid, right, for this stock. So the paid stock, so how much he had paid? Tell me, out of the 400 lakh, how much he had paid? The 300 lakh he have paid, right? So it is clear. Let's try to understand. Let's see the next step. So total stock is how much? Total stock is 400 lakh. Creditor is how much? Creditor is how much? 100 lakh, right? So creditor means the amount which is still to be paid. So what is the paid stock? How much is the paid stock? It is nothing but the 300 lakh. Now you have to apply the 25% margin. I think why I have taken 25% margin, because margin on stock is 25%, right? So margin on the stock value. So I have subtracted 400 lakh minus 100 lakh. That is the paid value. On paid value only I am taking this 25%, right? Bank will not care about this creditor part, right? Bank will pay, margin will be taken only on the paid stock, that is 300 lakh. So what is the 25% of 300 lakh? So 1/4 of 300, which will give you 75 lakh. So this 75 lakh is the margin, which is the borrower contribution, right? And then remove it. So after removing this 75 lakh, bank will pay 225 lakh. This is the drawing power, right, from the stock. And now let's look at the book debt. I told you there is a two type of thing. One is the stock and other is a book debt, which means book debt means that this is still मतलब कि ये उधार लिया गया था, इसको वापस लेना है कंपनी को, right? Company has given some amount, some goods or some services to the customer on credit, and later they will accumulate, later they will collect payment from them, and it is it has not been collected. How much amount has not been collected? So amount 300 lakh has not been collected, means 3 crore has not been collected, right? So basically the unpaid invoice, also you call it unpaid invoice, are 300 crore. And what is the margin on that? Margin on is 30%. So just calculate 30% of 300 lakh, which is how much? 90 lakh. So this is the borrower contribution. This bank will not give, borrower has to contribute it. So bank will subtract it, and the drawing power will be 210 lakh, which is 2.11 crore. So final drawing power is 225 lakh here and 210 lakh here, so which is nothing but 435 lakh. So although the bank sanctioned, how much the bank has sanctioned? See, the bank has sanctioned, bank has sanctioned 500 lakh. This is the sanction limit. Although the bank has sanctioned 500 lakh based on the business stock and receivable, the company can actually draw 4.35 crore at this point, right? It is how banks stay cautious and protect themselves while still helping business run smoothly. This is the how. This is done on every monthly basis. Whenever you submit the stock statement, bank see the stock, bank see their stock, bank see their book debt, and do this calculation and decide their drawing power, and they ensure that the maximum credit which is allowed to them stay within the drawing power, right? Now let us look at one more question. This will clear up your concept more. So let's look at this particular calculation. So friends, we are asked to find the drawing power. Some information given you. Sanction limit is 20 lakh, security value is 30 lakh, margin is 25%, right? Margin is 25%. So basically when I say stock, what is stock basically? So stock is a kind of fixed asset, right? Stock is a kind of fixed asset. So based on which the bank give this particular loan. This is called the security value. So its value is 30 lakh, margin is 25%. So the formula is quite simple. DP is how much? So DP is the security value minus margin, right? Like in the previous case, that is what we have done. So we have taken stock, we have taken book debt, and we have applied margin on them, and that is how we have calculated the drawing power, right? So this is all decided on basis of the security value. So security value here is how much, 30 lakh, and how much margin is there, 25%. So just what is 25% of 30 lakh? So this is 1/4 of 30 lakh. So 1/4 of 30 lakh, 7.50 lakh, 7.5 lakh. 7.5 lakh is your margin. Just subtract this from 30 lakh, you will get 22.5 lakh, right? Yes, but here is the twist. So DP we are getting how much, 22.5 lakh, and sanction limit is just 20 lakh. How can you DP greater than sanction limit? Your DP cannot exceed the sanction limit, which is 20 lakh. So even though we calculated 22.5 lakh, the bank will restrict DP to the sanction limit. So the final drawing power will be how much, 20 lakh. This is how bank protect their risk, by capping DP within their sanction limit, right? So I hope that makes sense to you. And this was same thing which I want to explain to you here. Just let me come back to this particular point where I told you, right, that we will discuss it later. Here you can see calculating drawing power from current asset and liability, right, and on monthly statement of the stock, book debt, and sundry creditor. And I just now I have seen how to apply this creditor. First of all, we subtracted the creditor amount from the stock statement, right, because that is the paid amount, and on paid amount we apply the margin. Similarly, on book debt we apply the margin, right, and then we calculated this particular DP, right, and margin are applied to this to determine DP, right. And I told you drawing power regulate cash credit utilization within the sanction limit. So drawing power should always be less than or equal to the sanction limit, right. You cannot utilize more cash credit than drawing power. Even though in this question what I see that the sanction limit was how much, sanction limit was it was 500 lakh, which was 5 crore, but still bank cannot company can actually draw maximum 4.35 crore at this point. So when it comes to banking, monitoring credit risk is not just a routine task, it is a critical safeguard. So but the question is, how should bank monitor credit risk effectively? So let's break it down into 4 powerful strategy. The first strategy is to account conduct assessment. The first thing to do is to conduct account conduct assessment. By carefully analyzing how an account behave, like suppose you spot the frequent overdraft, or you spot the low turnover, right? By spotting the low turnover, by spotting the check return, bounce check, or delayed payment, right? So these are bank can detect early sign of financial stress. It's like reading the warning signal, right? So it's like reading the warning signal of that before the things goes out of control. So these are the warning signal: frequent overdrawing, check return, low turnover, delayed payment. So it indicates financial stress. So this is called conduct assessment. Second step is to conduct the legal recourse. What does it mean? So basically it is a process of monitoring credit risk effectively. So if a borrower submit incorrect certification, bank must act swiftly, either by withdrawing credit facility or by taking legal action. Sometimes what happen, borrower submit incorrect certification, right? So suppose he have to submit stock statement and he submit incorrect certification. So bank there can take legal action or withdraw facility, right? Being proactive here protect the bank interest and send a clear message about accountability. And third point is that increase inspection, right? This is very important, that sometimes just surface level check are not enough. Banks should step up and conduct more in-depth inspection. This helps them uncover hidden risk and gain a deeper understanding of the borrower actual financial behavior. And lastly, shift to a stock pledging, which means switching to a stock pledging. So there is a term which we call stock pledging, right? So switching to a stock pledging, it allows bank to secure asset more effectively. It is a smart move to reduce unsecured exposure and safeguard the lending process. So to manage credit risk smartly, bank need a combination of data analysis, a strong enforcement, deeper inspection, and asset backed lending. That is how you stay ahead and protect the financial ecosystem, right? So these are the 4 steps which you must keep in your mind, right? Question may be asked. Now let's move to the next question: financial discipline process. So friends, let's talk about something that is backbone of the healthy financial relationship, which we call financial discipline. So, but what does the process looks like in action? So here is a step-by-step journey every borrower should follow to stay on the right financial track. First of all, to identify the need for periodic submission. Basically, the first move is recognizing the importance of regularly submitting financial update, like stock statement, like receivable data. Every data should be submitted periodically. Staying consistent with reporting build transparency and trust. Second thing is to submit a stock, receivable, and a statement. Now it's time to provide detailed report on your stock level and receivable. This help bank get a clear picture of your actual financial standing. What is the meaning of receivable? Receivable are basically the credit funding. Sometimes what happened, that particular business
or company has given some goods and service on credit, and some amount is still it has not collected from them. So this is called receivable. So they have to submit the data, how much receivable they have, how much stock they have, inventory item, every data has to be submitted periodically. The third step is to calculate the drawing power. How to calculate drawing power? I have already explained in the previous video, right? I have given you a numerical question where I have explained calculating drawing power. So then based on your data, based on the data which is provided by the business, bank assess how much financial capacity you truly have, because it changes, it varies based on your stock statement, based on your book debt, right? So basically this is a critical in determining the limits of your borrowing power, right? And then after you scrutinize stock and receivable, which means bank then dive deeper, analyzing inventory, analyzing receivable for any discrepancy. Is there any discrepancy? Bank analyze that. So this step help spot risk before they escalate. Before the risk could escalate, this help spot the risk. And finally, to detect non-moving stock and old receivable. This is very important. So bank what do that attention shift to identifying items that are stagnant or outdated. Old stock and receivable can tie up cash flow and signal financial inefficiency. And step number 6 is to maintain the financial discipline. So goal is simple: stay disciplined by following financial best practice and being vigilant. Both borrower and bank can ensure a smoother, right? So both borrower and the bank can ensure a smoother operation and a strong partnership. So remember, financial discipline is not just a process; it is a habit, and in this habit that build resilience and long-term success. So these are the steps. I hope that makes sense to you. I hope every step is clear, right? So remember this thing. What are the steps which are involved? How to bring financial discipline? Now let's look at the component of the stock. So friends, ever wondered what keep a lender confident about your credit worthiness? So it's all about credit control and monitoring, right? So lender is confident about your credit worthiness because it's all about credit control and monitoring. So it is a process that ensures that funds are safe and business stay financially sound. So the first thing they do is called stock audit. You know what is the meaning of a stock audit? So for medium and large account, a stock audit is very crucial. It helps verify if the stock details shared by borrower are accurate. So it helps you identify whether the stock details shared by borrower, right? So stock audit means what? Whether the stock detail, right? Whether the stock detail which is shared by borrower share the stock detail, right? So whether the stock detail is accurate. So basically it prevent inflated or misleading report. This is called stock audit. So this is for medium and large account. Remember, this is conducted for medium and large account. Remember it, right? So it tells you whether the stock detail is accurate. If the stock details shared by borrower are accurate, so this is helpful. Then second thing is called receivable audit. What is the meaning of receivable audit? So basically receivable can make or break financial health. That is why bank ensure borrower statement are reliable by conducting receivable audit. It helps assess how much money is genuinely expected to come in. Then we have financial statement. So no credit control is complete without diving into financial statement. This gives banks a snapshot of your business financial health, income, expenses, profit, loss, everything on the table. Then we have the auditor's report. What it means? That an independent lens is a must. Auditor report gives a neutral third-party assessment of your financial status, adding credibility to the number that you present. And finally, we have working capital analysis. Means to keep the wheel turning, bank assess your working capital. This step is integral when it comes to renewing capital limit and ensuring your business can meet day-to-day expense. So together, these components form a robust system of check and balance, protecting both the lender and borrower and paving the way for sustainable credit management. Friends, if you are looking for any study material related to CAIIB, you can WhatsApp me on this particular number, right? Please save this number and you can WhatsApp me for a study material. We have app called JIB and CIB Made Simple. App link is provided in the description section. And also, we have a Telegram channel for CIIB in which I daily conduct free quizzes on daily basis, where you can check your progress on daily basis. So please join this Telegram channel. Link is provided in the description section of this particular video. You can also search CIB Made Simple on the Telegram. You will get the particular link of the group. Now let's look at how this process is done. So friends, now that we know the component of credit control, let's explore how credit control and monitoring process actually work step by step. So picture this process as climbing a staircase. Each step takes you closer to effective risk management and financial discipline. First thing is the periodic visit. Right. What is the meaning of periodic visit? That lender frequently assess operation on the ground, verifying asset, checking business activity level, and ensuring that what is on paper matches reality. Second thing is interaction with creditor and debtor. No business exists in a bubble. Bank interact with key financial stakeholder like creditor, like debtor, to get a broader picture of your business financial health and cash flow pattern.
Then the scrutiny of the borrower account. Scrutiny of the borrower account means that they dive deeper into borrower account. Bank analyze your account activity, not just internally, but across multiple banks for a more holistic understanding of your financial habit. Right, that is called scrutiny of the borrower account. Right, then you have the market intelligence. What is the meaning of market intelligence? So bank also gather valuable insight from the market, like industry body, like association, agency, to help bank stay ahead of the trend. Then we have nominee director appointment. This is very very important. So basically, in special or high risk cases, bank may go a step further by appointing a nominee director. This ensures direct oversight and tighter control over the borrower operation. Then we have credit audit. So bank check, no process is complete without a thorough credit audit. So in credit audit, bank checks for compliance with RBI guideline and review internal procedure, making sure everything run by the book. So whatever RBI has given the guideline, so it makes sure that its current policy align with that. And finally, we have customization of audit framework. So finally, one size does not fit all, right? So bank tailor the audit framework based on the unique risk profile of each borrower. So what bank does? Bank tailor the audit framework. So this audit framework is tailored by bank based on unique risk profile of each borrower. Each borrower, they have a unique risk profile, right? Each borrower risk profile is unique, and bank tailor the audit framework based on that. So there you have it. Step by step, bank ensure that credit stays safe, transparent, and well monitored. Right? Remember, these are the steps which you must keep in your mind. Now let's move forward and let's see the next part, which is regarding credit audit cycle. So friends, let's now zoom into the credit audit cycle, the engine that keep credit risk management running smoothly. Think of it like a continuous loop of improvement and vigilance, designed to protect financial institutions and sharpen their credit control system. So let's break it down step by step. The first step is to review the sanction process. It's called reviewing the sanction process. It means it all begins with reviewing how credit is sanctioned. Is the loan approval process solid? Are policy being followed correctly? So this review set the foundation for the entire cycle. That is called review the sanction process, right? So is the loan approval process solid or not? Then we have to assess the credit risk, which means that bank evaluate how risky the borrower is, looking at the financial, market condition, business performance to estimate the probability of default. So basically they estimate something called PD. What is PD? Probability of default. Then to detect the EWS. What is the meaning of EWS? Early warning signal. So, but we don't stop there. Early warning signal like delayed payment, operational red flag are closely monitored to catch risk before they snowball into bigger issue. And then we have to recommend the corrective measure, which means if any gaps or risk are found, if any red flag is found, corrective measures are recommended. This could mean tightening the credit terms, restructuring the loans, or improving the borrowing monitoring. And then we have strengthened the administration. A stronger process means fewer mistakes. So bank focus on strengthening internal administration to enhance overall governance and risk control. And finally, to improve staff competency. So this is a key ingredient, which is people. Continuous staff training ensures that team is well equipped to spot risk, take decisive action, and maintain robust credit practice. And just like that, the credit audit cycle complete, only to begin again. Right? So this is how it works. Now let's look at the next slide, and everything in the slide is presented in the form of pictorial format so that you can easily retain it. Right. Let's look at the audit function overview. Now let's explore the core engine behind the robust governance, that is called the audit function. In every successful organization, the audit function a very pivotal role in ensuring transparency, compliance, and continuous improvement. Let's break it down. First of all, what they do, they process the audit report, which means it all starts here. The audit team diligently handle and organize vast amount of audit data. So they handle and organize vast amount of audit data, right? So basically this information flows seamlessly into the inspection and audit department, ready for the action. Then we have following up with authority, which means the team work closely with the authority to close any gap and uphold the standard. Then we have addressing the audit responses. So it's not just about finding issues, it's about fixing them. Responding to audit feedback swiftly and effectively help build a culture of accountability. And then we have something called advising department. So basically they guide department, ensuring everyone aligning with the best practice and audit finding. And then we have updating management, which means management stay in the loop at every step. Regular update ensure that leadership is equipped to make informed decision based on audit insight. And finally we have to maintain the database. And of course every audit need a strong record. Maintaining a detailed and organized audit database safeguard institution memory and support future audit. So in short, audit function is not just about checking box, it's about driving excellence, compliance, and trust across the organization. So this is called audit function overview, right? So these are the basic functions done in audit. Now let's look at the credit review frequency and compliance timeline. So friends, let's simplify something crucial, that is called credit review frequency. To safeguard financial health and ensure regulatory compliance, organization must conduct timely credit review based on the risk profile of account. So first thing is every 3 months. So every 3 months, which kind of account is done? So for high risk account, high risk account reviews are done quarterly, because these account demand extra attention to prevent potential default or compliance breaches. So constant vigilance help mitigate major risk before they escalate. And for every 6 months is for average risk account review. So these account may not ring alarm bell like high risk one, but they still require regular monitoring to maintain balance and stability. And finally, for low risk account, annually it is done. So these account, they get reviewed once a year. So these account carry minimal risk but still require a yearly checkup to stay aligned with compliance standard. So in short, frequency is tailored to risk. The higher the risk, the more frequent the review. This layered approach ensure proactive risk management and protect the financial system from surprises. Right, so that's it. Now let's look at the next point. The next point is legal audit process for large loan. Very, very important. So friends, that let's dive into the legal audit process for large loan, a critical safeguard in the banking system. So first of all, what you have to do, you have to identify the large value loan. You have to identify the large value of loan. So it all starts with spotting the big ticket item. Big ticket item is loan of 5 crore and above, right? So these large exposure carry more risk and demand heightened security. Then we have to maintain the legal audit. So next the RBI steps in with a mandate. The legal audit of the title document become essential. So this is very, very important. Legal audit of the title document. This is called legal audit. Then why it is done? Because to ensure that security backing this loan is legally sound and enforceable. So every loan there is a security backing, and the security backing is legal and enforceable. So remember, for every loan of 5 crore and above, we have to identify such kind of loan. We have to mandate the legal audit, right, to ensure that security backing these loans are legally sound and enforceable, right? And then we have periodic title deed verification, which means that the journey does not end there. Banks are required to periodically verify title deed all the way up to the final repayment. This is like keeping your seat belt fastened for the entire ride. And then you have to ensure the document authenticity. To avoid any surprise, concurrent auditor are tasked with cross-checking document authenticity. No room for forgery or tampering paper here. And then we have to submit quarterly review note. So banks submit quarterly report to the board or audit committee, presenting their finding and red flag if any. So this regular feedback loop ensure that transparency and keep everyone accountable. So in short, we can say that the topic which we are talking about, legal audit process, is a step-by-step process that fortifies system, making sure every large loan is backed by solid verifiable documentation. So for 5 crore and above loan, mandate legal audit, periodic title verification, ensure document authenticity, and submit quarterly review note. So bank report audit finding into the board and audit committee every quarterly. This is done. Now then we have comprehensive credit audit. So friends, let's now unlock the world of comprehensive credit audit, the key to maintaining a solid credit environment. At the heart of the audit lies the credit audit scope. So at the heart you can see it is nothing but the credit audit scope. So which revolve around three essential pillars. The first pillar is the portfolio review. So this portfolio review, the portfolio is thoroughly reviewed to evaluate not just its quality but also how well it aligns with the institutional credit policy. So basically quality is reviewed, right? Quality review is done. Not only quality review is done, but also how will this quality align with institutional credit policy, right? How will the quality align with the institutional credit policy? Is the portfolio balanced? Are the risks well diversified? So this step gives the answer. That is called portfolio review. Then we have sectoral exposure. So basically here we zoom into sectoral exposure to ensure they fully comply with the loan policy and RBI norm. So sectoral exposure, we zoom in into sectoral exposure to ensure that they fully comply with the loan policy. They fully comply with the loan policy plus RBI norms. That is called sectoral exposure, right? So no sector should be overexposed, and this check ensure that we stay within the safe boundary. First of all, portfolio review is done. The portfolio is thoroughly reviewed to evaluate not just its quality but also how will it align with the institutional credit policy. And the third key is the compliance with the norms, which means every move is cross-checked with the RBI prudential norm and regulatory standards. It's all about playing by the rule and safeguarding the bank from compliance, right? So you can think of it like holding a bunch of keys, each unlocking a critical aspect of credit health. Together they help bank ensure sound legal lending practice and regulatory compliance. Portfolio review, sectoral exposure, and compliance with the norms. So what is the meaning of sectoral exposure? Just now I told you that no sector should be overexposed. That is what we ensure by sectoral exposure. And the final thing is loan review process. How it is done? Let's see. So let's now take a journey through the loan review process. Each step on the road is crucial for maintaining a healthy credit portfolio. First of all, you have to identify which are the account which you have to review. Identify the account for review. Right. First of all, identify the account for review. It all begins with a carefully selecting account based on set criteria. Not every account makes it there. Only those flagged as important or high risk. Then you have to review the fresh proposal and renewal. We dive into fresh proposal and recently renewed note loans, which usually within 3 to 6 months of sanction. So suppose some loans have been renewed within 3 to 6 months of sanction. So that is what we do. So this ensures that no fresh sanctions slip through the crack without proper scrutiny. Then we have to review the existing account above, which means focus shift to big ticket loan, right? That is called high limit loan. Big ticket loan, high limit loan need extra attention to ensure they continue performing well and remain within the acceptable risk parameter. That is called high limit loan. And then there is something called random sample review, which means but we don't just stop at the big account. A random 5 to 10% of the other account are reviewed as well. This keeps the review process fair and comprehensive across the board. And finally, we have to address the related group concern. So we zoom out and check for any group level concern. Are there interconnected account within the same corporate group that could trigger bigger risk? So this step makes sure that we catch them. So there you have it, our roadmap to solid loan review. It's systematic, thorough, and designed to keep the portfolio safe and sound. Right. So basically, what is the process? First of all, you carefully select account based on set criteria. You review. We dive into the phase proposal and recently reviewed loan, usually within 3 to 6 months of sanction. And then you have to review the existing account above the limit, which is called big ticket loan. Some random sample review is also done. 5 to 10% of other account is reviewed as well, and you have to address related group concern chapter. And obviously it is very short chapter, so we will go through the key points of this particular chapter. So let's get started with our first topic. First of all, let's talk about a key concept in banking and finance, right? So the first thing is the credit risk. And your credit risk, so you can imagine this credit risk like a keychain holding several keys that unlock the reason behind potential financial trouble. So what is the meaning of credit risk? The meaning of credit risk, it simply means that possibility that a borrower may fail to meet their financial obligation. But what really drive this risk? First, we have something called external factor. So basically, forces from outside the bank control. External factor are those forces which are outside from the bank control, and these include some factors like economic shift, exchange rate, interest movement in the exchange rate, movement in the interest rate, political instability, right? So these are some of the reason behind this external factor. For example, if a government suddenly changes its policy or a major currency devalue, so borrower might struggle to repay loan, raising the credit risk, right? And the second factor is called internal risk. So these are within the bank control. So external risk means outside the bank control, which bank cannot control, right? Outside bank control. And if we talk about the internal factor which is within the bank control, right? Like example, poor credit appraisal, right? Suppose the bank has done poor loan structuring, inadequate credit appraisal, right? Excessive exposure to a specific industry, or a weak loan monitoring system, all highlighting the risk. So even lending too heavily to one sector or region without diversification can be dangerous. So mastering credit risk means understanding both the external storm and the internal crack. Only then a bank can safeguard itself and its client, right? So these are the two kinds of credit risk: external risk and internal risk. External factor, internal factor. Now let's let's see the classification of how this external environment and internal environment goes about. So friends, when we break down credit risk, it is split into two broad categories, like two distinct branch of the same tree. First form the external environment, and the second form the internal environment. So external environment here is what we call portfolio risk. This is about the bigger picture, and two major type stands out here. Concentration risk, which means when too much credit is concentrated in one particular sector or borrower, making the portfolio vulnerable. Or industry risk, suppose in when which depends on how industry perform. If industry face a downturn, all loan linked to it might be at risk. On the other hand, there is something called internal environment, the bank on operation, right? And here we face the transaction risk. So this is more deal specific and includes several risks like default risk, which means when a borrower fail to repay, or spread risk, which relate to the change in the pricing of the loan, or downgrade risk, which means when the borrower credit rating fall. What is the meaning of downgrade? So suppose the borrower credit rating it falls, this is called downgrade risk. Obviously it increase the risk. And finally we have recovery risk. What is the meaning of recovery risk? So basically it is about how much can actually be recovered if things goes wrong. So while portfolio risk shape the broader credit landscape, transaction risk emerge right at the deal table. Both demand sharp attention to keep credit risk under control. So either it is portfolio risk or transaction risk, both demand sharp control, right? Close monitoring. Now let's switch our focus to our next topic, which is credit rating agencies and RBI regulation. So the peculiarity of this crash course is that in this crash course you get everything in pictorial format. So at the time of revising this particular chapter, you only go through this picture and everything is clear. No need to go through that book, because this is a kind of mind map. It remain in your mind for a longer time, and this is what we provide in this crash course. For more detail regarding the crash course, you can WhatsApp me on this particular number, right? So now let's discuss this RBI regulation on credit rating. So friends, let's dive into the world of credit rating agency and how the RBI keeps them in check. Credit rating is very vital in assessing the financial health of a borrower. But who gives this rating? So there is something called domestic agency. Last time question was asked, which of the following is not a domestic agency? So these domestic agency operate within India. So this includes CAIIB, CRISIL, Indian Rating, ICRA, Brickwork and Acute. They focus on evaluating Indian company and their credit worthiness. And then we have some global player, right? Like Fitch, Moody's, S&P, right? So these giant assess companies and sovereign worldwide. So all these agencies work under the umbrella of the RBI regulation on credit rating, right? So the RBI ensure that these agencies follow guidelines to maintain transparency and reliability, especially domestic agency we are talking about. And what about the banks? So they rely on these rating to estimate the probability of default, PED, right? The chance that a borrower might fail to repay. Additionally, under RBI AIRB. What is AIRB? AIRB full form is Advanced Internal Rating Based Approach. I think you know about it. Operational risk measurement, there is an approach called Advanced Internal Rating Based Approach. So under RBI AIRB, bank refine their risk model to make lending decision smarter and safer. So I hope that makes sense to you. What is credit rating agency and what is the RBI regulation? Now let's shift our focus to our next topic, which is none but overview of the CRILC. CRILC is a very important topic, and let me explain each and every part of it. So let's break down the CRILC reporting system, which is a very critical tool for managing large borrower risk. First of all, large borrower risk is involved. So first thing, what is CRILC? The full form is, let me write down the full form. It stands for Central Repository, Central Repository of Information on Large Credit. So it stands for Central Repository of Information on Large Credit. So and its reporting system is mandated by RBI, right? So basically what happened, first thing is the reporting requirement. See, bank must report data for all borrower who have exposure, whether fund based or non fund based, of 5 crore and above. So whoever has exposure of 5 crore and above, whether it is fund based or whether it is non fund based, does not matter, bank must report data for all borrower, right? So this include account classified under because this include account classified under SMA. What is SMA? SMA means special mention account. But note, crop loan are excluded. Crop loan is not included, right? Although other agriculture loan still need to be reported, right? So what I am saying you, that bank must report data for all borrower who have exposure, whether fund based or non fund based, of 5 crore and above. This include account classified as SMA. SMA is also included, a special mention account. But note, crop loan are not included, right? Although other agriculture loan still needs to be reported. So agriculture loan is also various type. So especially crop loan is excluding, and other reports, other loans should be including. Exemptions are there. What exemptions are there? So not everything goes into CRILC. Exposure to institute like NABARD, SIDBI, Exim Bank, NHB, these are exempted. Now there is something called PAN master record. Please try to understand what is the meaning of this PAN master record. So let me explain what it is saying. That here it is written that it says that even if there is no exposure, bank must still report outstanding current account balance of 1 crore and above based on the PAN master record. So you can say bank must report outstanding current account balance of 1 crore and above even if no exposure exists, right? So based on the PAN master record as per the RBI guideline rolled out in February and May 2024. So in short, you can think of the CRILC as an umbrella protecting the financial system by identifying early sign of stress among large borrower. So basically it deals with a large borrower because the full form itself says, right? But okay, so what is the full form of CRILC? I already told you that basically it stands for Central Repository of Information on Large Credit. So LC means large credit. So that is why it deals with the large credit only. Now let's go through the history of this establishment and regulation of CICs in India. So friends, let's walk through the journey of how CIC, how credit information got organized and regulated in India. It all started back in 1999, right? So when RBI formed a working group, so there is a WG which is called working group, which is formed by RBI. Why? So why this working group was formed? So this working group was formed to study the credit information system in India. So basically, the main purpose was to study the credit information system in India, how it works. So this group does not stop at the research. They went ahead and recommended the creation of a formal credit bureau. They recommended the formation of a formal credit bureau to strengthen the financial transparency, right? Then comes civil, right? Then civil was established. You know what is the meaning of civil, right? So basically, civil was the India's first credit bureau, which was set up by SBI and SDFC in 2001. But that was not the end. Soon after, India saw the creation of three more CIC. The first civil was established, remember, civil and as SBI and SDFC, and three additional CIC were established, right, to widen the credit information network. Fast forward to 2005, right, the RBI introduced a landmark regulation mandating that all financial institutions must be the member of at least one CIC under the Credit Information Companies Act. So basically, there was an act which says that every financial institution should be a member of at least one CIC. Now, RBI did not stop there. They also issued a directive asking bank and financial institutions to join all CIC to ensure seamless data sharing. To join all CIC further. Earlier they say only one CIC, later they say all CIC. Now, lastly, speaking of membership, RBI put a cap on fee, which is rupees 10,000 for joining and 5,000 annually for reporting, making it affordable and consistent. Lastly, bank and financial institutions were instructed to actively report defaulter with exposure of 25 lakh and above. Right. So these are the points as per RBI directive. Now let's understand the credit default swap. So friends, let's decode the concept of CDS, which is called credit default swap. It's like an insurance policy for lender. First we have the protection buyer. The first we have is the PB. In short, we call it the protection buyer. Basically, this is typically a lender or an investor worried about a borrower defaulting on a loan. He is worried that a borrower will default on the loan, right? So this is an investor or a lender. So they seek protection against this risk. On the other hand, we have the protection seller. So basically, usually an insurance company or a financial institution that agree to provide coverage if the default happen. So this will provide the coverage. To whom? To the buyer if the default happen. So this brings us to the premium payment, right? A regular fee paid by the buyer to the seller, like just you pay premium on insurance policy. Now, question is who or what is this protection about? So what is this protection about? So that is where the reference entity comes in. It could be a company, it could be government whose bond or loan are at risk of default, right? It could be a company whose bond is at risk of default. It could be government whose bond is at the risk of default. So basically, if the reference entity default, the protection seller compensate the buyer, which means underlying asset which is under default condition, right? Who protect the buyer? Protection seller protect the buyer. And tying it all together are the ISDA terms, basically, which are a standardized rule and agreement that govern how this swap work, ensuring clarity and consistency globally. So you can think of this CDS as the key financial tool that unlock risk management option in the lending world. I hope that makes sense to you. Please hit that like button if you think that this information is really useful and it is presented in such a lucid way that you can easily revise at the time of examination. Now the next point we have is called CLN, credit link note. So let's take a walk through the fascinating world of the credit link note cycle, a powerful risk management tool in finance. First of all, it all begins with risk seller paying the premium. You see, risk seller paying the premium. So the entity exposed to the credit risk, right? Let's them call risk seller. He pay the premium to a special purpose vehicle or SPV, right, to transfer that risk. Then step number 2, SPV issues CLN. SPV, special purpose vehicle. So basically, credit linked notes are issued by SPV, and these notes are directly linked to the credit risk that the seller want to manage. So these notes are linked to the credit risk that the seller want to manage. And then what happened? Then step number 3 comes. Then comes the investor who purchased CLN, hoping for attractive return in exchange for taking on the credit risk. So these investors take the credit risk. In exchange for that credit risk, they hope the return. And then what happened? Step number 4, what SPV do with this money? SPV, so whatever investor have invested money, what SPV do with this money? So SPV invest proceed wisely, used usually in safe high quality security to balance the risk, right? So invest the proceed in a high quality security to balance the risk. But wait, if there is in trouble brewing, we check the default occur. So if yes, the next step is trigger. What is the next step? That in case of default, the SPV steps in to liquidate the security which is bought, right, from the payment is received from investor. SPV liquidate it, right, and then the funds from this liquidation are used to compensate the risk seller. But if all goes well and there is no default, SPV will simply return proceed to the investor, right? If all goes, because this investor take the risk, right? They take the credit risk, and if everything goes well, right, return proceed to the investor along with their return. So that is how it happened. And just like that, the CLN cycle is complete, a smart way to transfer and manage credit risk in the financial market. So depending on default happen or not, the next step is taken. So this is all you need to know about this credit risk policy, CLN, credit link note. Let's now dive into the credit risk management guideline, the backbone of sound lending practice in bank. So first of all, let's talk about infrastructure project analysis. Banks are advised to conduct thorough due diligence through, first thing, the method is called sensitivity analysis. You know what it is? Means it is used to assess how change in key variable affect the project. So there, a project depends on many various factor, and if you change each and every factor, how it affect overall project. This is called sensitivity analysis. Second is called scenario analysis. It helps us prepare for multiple possible outcome, right? There are multiple possible outcome. So multiple outcome, it helps us to prepare for multiple outcomes. Then we have the risk of delays and the cost overrun. Basically these two things, basically evaluating these two things, let's be honest, in infrastructure surprises are common. So risk of delays are there and cost overrun is also there. Cost overrun means what? That sometimes we expect only 10 crore and the actual cost become 11 crore. This is called cost overrun. Next we have independent credit appraisal. So RBI suggests avoiding external consultant and promoting objective in-house assessment. Why? Because independent eye ensure a sharper focus on the actual credit worthiness. And the third is promoter equity verification. Bank must verify the source of equity. RBI here is crystal clear. Watch out for disguised debt. Watch out for disguised debt. RBI is crystal clear here that watch out for disguised debt where parent company loan are camouflaged on equity in subsidiary or SPV. So basically no parent company is disguised as equity in the subsidiary or SPV, right? So that is the point. So this is called disguised debt where parent company loans are camouflaged as equity in the subsidiary or SPV. Now you may ask me, how should bank actually manage credit risk and monitor fund in real time? So how should bank actually manage the credit risk and monitor fund in real time? So that is where this point come. DIN is used for identification. This help ensure director are properly identified, avoiding any wrongful credit denial. Then we have, you have to cross check the name, which means a bank should match director name against defaulter list to reduce the chance of risk exposure, and also to engage auditor directly, which means bringing in independent auditor allow bank to closely track how funds are used. And finally including covenant. What is covenant? Basically adding a smart clause in the loan agreement ensure tighter control over fund utilization. So in short, the RBI guideline help banks stay vigilant, make informed lending decision, and protect themselves from the hidden risk. So that is the point all about it. Now let's talk about the last slide, that is the credit risk management cycle. So friends, let's explore the credit risk management cycle, a continuous loop that safeguard a bank's financial health and promote responsible lending. First thing is called strengthening risk management. So at the heart of it all, the bank must constantly refine and enhance their credit risk management framework and policy. A stronger system means fewer surprise down the line. Then the second thing is improve the asset quality, right? Which means next focus shift to building a portfolio of high quality asset. HQLA, high quality asset, right? HQA. So remember, healthy asset means healthy balance sheet. The next thing timely recognize stress. So here is the third point, that the timely recognize stress asset. So basically what happened when asset starts showing sign of stress? So bank must quickly identify and address stress asset to prevent deterioration. And then regular CRILC reporting. I told you about this CRILC, right? So basically transparency is the key. Bank are required to consistently report to central repository of information on large credit, keeping regulators in loop, right? And finally review borrower classification. So banks should regularly assess the classification of borrower. Are they performing? Are they slipping into default territory? Are they in SMA1? Are they in SMA2? Whatever it is. Or who have the money still manage to escape payment? So let's break down the sequence of willful default, right? This is called willful default action that lead to massive financial loss. So step number 1 is the capacity to pay. The borrower has the capacity to pay, right? So what it means, that the borrower has enough money to repay but choose a different path. This is called intentional default. This is called intentional default. Means instead of fulfilling obligation, the borrower deliberately stop making payment. Why? Because they have other plan, or they can. This is called the misuse of fund. The money meant for repayment is redirected to unauthorized purposes, maybe luxury, maybe risky investment. That is called misuse of fund. And the next is siphoning of fund, which means that now things get serious. Fund are moved away from their intended use. So basically, there is something called intended use of the fund, like this is called hidden, or we call it transferred. So fund has, so when I say siphoning of fund, what it means, that fund are moved from their intended use. So every fund has their intended use, but where it is used, somewhere else, right? Like hidden, transferred, or funneled somewhere. And step number 5 is the disposal of secured asset, which means the borrower sells secured asset. What is the meaning of secured asset? You know the meaning of secured asset? Secured asset means which were collateral for the loan. So secured asset just means the collateral for the loan, right? So borrower sells secured asset without even informing the lender, right? So this is called disposal of the secured assets. So borrower, once who had availed the loan, they sell secured asset without informing the lender. So he has total breach of trust. So these are the effect of this willful defaulting. So it may be intentional default, it may be the misuse of fund, it may be the siphoning of the fund, or it may be the disposal of the secured asset. And just like that, the bank suffer huge loss while the borrower walk away scot free. So friends, if you want to know how bank tackle and track this willful defaulter, right? So let's stay tuned. Let's move to the next slide. And in the next slide, we are just going to discuss the same. So there is something called financial management, diversion and siphoning of fund. So ever wondered how companies secretly misuse fund? So let's uncover the two biggest trick in financial mismanagement. The first is called diversion of fund. What is the meaning of diversion? See, money meant for one purpose is redirected elsewhere. How? So for example, using short-term capital, you are using short-term fund for long-term need. This is one way. You are using short-term fund for long-term need, or you are transferring money to a group company, or you are sending fund to unauthorized bank, or you are making investment without approval, and finally, and worst of all, failing to account for the money. So these are the different way of diversion of funds. So question may be asked, which of the following represent the diversion of fund? So you must know that these are the diversion of fund example. Like again I am repeating that you are using short term fund for long term need, or you are transferring money to group company, or you are unauthorized, or you are, so suppose you are sending fund to unauthorized bank, or you are investing without approval, and worst of all is failing to account for the money. So these are called diversion of fund. And the second part is the siphoning of fund. What it means? So this is where things get shady. So when I say siphoning of fund, this is where things get shady. So fund go into unauthorized activity, right? Fund goes into unauthorized activity. The company financial health takes a hit, and even lender assessment get manipulated. Lender assessment get manipulated. This is called siphoning of fund. So siphoning of fund, under siphoning of fund, things get shady. Fund goes into unauthorized activity, right? The company financial health takes a hit. Even lender assessment get manipulated, and just like that, investor and bank suffer massive loss, while the culprit walk away free. So understand the difference between diversion and siphoning, right? So friends, question may be asked that which of the following represent the siphoning of fund. So suppose fund goes into unauthorized activity, the company financial health takes a hit, lender assessment get manipulated. So these are the cases of siphoning of fund. I hope that makes sense to you. So how this diversion and siphoning works, so this can be clearly understood from this particular slide. And this is how we represent the data in our entire crash course, right? So if you want data, if you want to revise the content very shortly, very effectively, if you want to remove the scrap and only remember the important point, you can enroll in our CAIIB crash course program. For more detail, you can WhatsApp me on this particular number to get detail regarding this particular crash course program, right? So this is a sample PDF, just I am showing you. You will get PDF for every unit like this. Only important thing that matters from examination point of view has been represented in the pictorial format, so that you can remember them for a longer amount of time. So now let's shift our focus to our next slide, and the next slide you can see is a very good important question. Let's answer this question. Imagine a borrower. So the question is, when is a borrower considered non-cooperative, right? Imagine a borrower deliberately blocking the recovery process. So should they be labeled non-cooperative? Let's find out. So first thing is that withholding information. Try to understand withholding information. What it means, that that some borrower refuse to share crucial financial data, making it harder for bank to recover dues. So no transparency, no trust. First point, the second point is denying the asset access. What is the meaning of denying asset access? So when lender try to recover financial asset, these borrower restrict access, so obstructing the process. And obviously, is this a red flag activity? Absolutely, this is a red flag activity. Means when lender try to recover finance asset, these borrower restrict the access, obstructing the process, and obviously this is a red flag activity. And the second thing is obstructing the security sale, which means the borrower goes a step further and block the sale of security, delaying financial recovery. But banks are prepared. If the total exposure exceeds 25 crore, you must note it down. If the total exposure exceeds 25 crore, right, the borrower and even promoter or key manager can be classified as non-cooperative, right. So these are the conditions under which a borrower can be called non-cooperative: if he is withholding information, if he is denying asset access, and if he is obstructing the security sale, right. So under this case he can be called non-cooperative, and once that happen, strict action will follow, right. So bank must protect their fund, but what more they can do to prevent such cases, let's find out, right. So friends, now let's move over to the not every borrower. So the question is, how is the borrower status evaluated? Not every borrower is the same, and bank follow a structured process to decide if a borrower should be classified as non-cooperative or given another chance. Let's break it down. First of all, they issue something we call show cause notice. So a formal notice is sent to the borrower, giving them a chance to explain why they defaulted. Why they defaulted, right. So this is the chance, they give it a chance to explain why they defaulted. So a formal notice is sent to the borrower, giving them a chance to explain that why they defaulted. Then comes personal hearing, right. So if needed, the borrower can present their case to the authority. A fair chance is given before taking on any strict action. The next thing is the committee review. So a higher committee led by the chairman or CEO and two independent directors review the case and decide if the borrower should be classified as non-cooperative. And then reporting to CRILC. I think you are familiar with this CRILC. We have talked about it in the previous lecture. So what is reporting to CRILC means? So once a borrower is declared non-cooperative, bank must report them to CRILC. What is CRILC? CRILC stands for Central Repository of Information on Large Credit. What is the full form of CRILC? Central Repository of Information on Large Credit. So this is called CRILC, right. Central Repository of Information on Large Credit. So once a borrower is declared non-cooperative, bank must report them to CRILC within 21 days. How many time period is there? 21 days time period is there. So their status is reviewed every 6 months for possible declassification. A status is reviewed every 6 months for possible declassification. And the final step is a risk assessment, which means bank assess the risk involved and make necessary provision to protect their financial stability. So assessment of risk is done and provisioning is done. Means necessary provision is made to protect their financial stability. So a well-defined process ensures that genuine borrower get a fair chance while the willful defaulter face a strict action. Right. So the question is answered now. So what was the question? That how the borrower status evaluation process is done. So cause notice issued, personal hearing, committee review, report to CRILC, and risk assessment. Now let's switch gear and let's talk about bank account rectification. So now the topic name is restructuring, rectification and recovery. Now let's look at rectification. How rectification is done? So when borrower struggle with repayment, bank don't take immediate strict action. Instead, they follow a well-structured rectification process to help both parties. The first thing is that bank identify the stressed account, which means bank first identify account that need rectification to prevent further financial distress. Then they persuade the borrower, which means rather than enforcing penalty right away, bank try to encourage borrower to clear their dues and regain financial stability, or transfer to other bank, which means if necessary, bank facilitate account transfer to other financial institution that may offer better terms, or consortium lending action. In some cases, multiple banks step in. One bank may take over the share of the loan, spreading the risk. Or in the next step, there is something called sole banking challenge. What is the meaning of this so-called sole banking challenge? Sole banking challenge means exiting sole banking arrangement can be difficult, right? So adding complexity to the rectification process, or obviously withdraw concession. If no resolution is found, bank may remove financial benefit previously granted to the borrower, or enforcing covenant, which means at this stage strict financial agreement are implemented to ensure compliance and recovery. And finally is the reducing the limit. So bank may reduce the limit, right? So this is another step that is called reduction of limit, right? Restricting further borrowing until the borrower situation improve. So these are the steps that the bank can take, right? Reducing further limits. So this multi-step approach ensure that borrower get opportunity to rectify their financial position while bank protect their asset, a win-win strategy. This is called the rectification stage. So let me summarize the fact. The first is transfer to other bank or identify stress account, persuade borrower, consortium lending action, sole banking challenges. These are the main points which you have to go through. Now let's look at the restructuring. What are the steps to restructuring? So ever wondered how a struggling business get back on track? So financial restructuring is the answer. Let's explore its 6-step process that help business regain stability. First of all, you have to identify the viability. What is the meaning of viability? Means is to assess whether the business has the potential to bounce back. If it is viable, restructuring can begin. So first of all, you must check that yes, if it has potential to bounce back, then only you begin this restructuring process. If it is not, don't begin. Then you have to demonstrate the commitment, which means the borrower must show seriousness toward repaying the loan and cooperating with the restructuring process. Then extend repayment. So to ease the financial burden, bank increase the repayment period. What bank do? Bank increase the repayment period. So this is one way of restructuring, that you increase the so suppose repayment period initially was 20 year, they may increase to 25 or 30 year, right? To ease the financial burden, bank increase the repayment period or to reduce the installment amount. So two things can be done, either increase repayment or to reduce the installment. So what is the meaning of reduction in installment? So lowering the amount in each installment to make repayment more manageable. So this make repayment manageable. And lower interest rate. Obviously interest rate is lowered, which means restructuring offer include reducing interest rate, making borrowing more affordable, and or to convert the dues. Means finally bank converts short-term debt into long-term loan, ensuring a smoother repayment and business continuity. So following this step-by-step process, business get a second chance and bank protect their asset, a well-structured win-win strategy, right? So this is how restructuring is done, right? Let me again show you the step. Viability, commitment, extend repayment, reduce installment, lower interest rate, or to convert the dues. That means convert debt into long-term loan. These are the steps that the bank can take for restructuring. Now look at the loan recovery. So now let's shift our focus to the recovery part. So friends, ever wondered what happened when borrower failed to repay their loan? So bank and NBFC, non-banking financial company. So bank and NBFC, they have a structured legal recovery process. They have a structured legal recovery process to ensure that their dues are collected. So first step is to initiate the legal proceeding. What it means, that if a borrower does not clear their dues despite multiple chance, bank initiate legal recovery. What I'm telling you, that suppose borrower does not clear their dues despite multiple chances, right? Multiple chance were given to the borrower, but they did not clear their dues, so bank initiate legal recovery. This is the first point. Second point is to civil court suit for amount below 20 lakh, which means for a smaller amount bank filed suit in civil court to get the money back, right, up to below 20 lakh. So if the amount is below 20 lakh, bank filed suit in the civil court. Now the third step is the preliminary decree and the repayment period, which means once the court acknowledges the case, borrower may get 6 months to repay before further action. So this is called preliminary decree. 6 month timing is given to the borrower for repayment after preliminary decree, right? So if it is below 20 crore, then 20 lakh, then only. Then we have final degree for execution. Which means if the repayment does not happen, a final decree is issued allowing recovery within 12-year execution limit, right? And DRT process, if the repayment does not happen, and for larger amount above 20 lakh, below 20 lakh, the court, they can go to the civil court, but for larger loan cases are taken to a DRT for a faster resolution, which is called debt recovery tribunal. Even NBFC with asset over 100 crore, right, can approach DRT to recover their dues. So this legal framework help bank and NBFC recover loan systematically, ensuring financial stability. So these are called recovery process, right? Now let's look at the Lok Adalat. Lok Adalat is another way. Let me show you the importance of Lok Adalat here. So in this slide you will understand the overview of the Lok Adalat function. So friends, ever wondered if there is a faster, easier and cost effective way to resolve dispute without getting stuck in lengthy court cases? So well, Lok Adalat is a solution. So it is a unique dispute resolution mechanism under the LSAL, right? That is called Legal Service Authority Act 1987, right? Designed to settle the case amicably, right? It is designed to settle the case amicably. So it handle judiciary cases. It handle judiciary, civil judiciary cases. So Lok Adalat can resolve civil case up to 20 lakh, right? Making justice accessible and efficient. And there is something called dispute resolution platform. So it provide an alternative to the traditional court where both parties reach a mutual agreement, avoiding expensive legal battles. DRT and DRAT cases. So for some cases there is no monetary limit. This means high value dispute can also be settled through this mechanism, right? So Lok Adalat promote speedy justice without the hassle of prolonged litigation, no court fee, no delay, just fair resolution, right? So this is the advantages of the Lok Adalat. Up to 20 lakh cases are handled in the Lok Adalat. Now the next point we have to discuss is the SARFAESI Act. Very very important. So ever wondered what happened when a borrower default on a loan? So bank don't always have to go to court. Thanks to the SARFAESI Act 2002, lender have a structured way to recover their dues efficiently. So first step is to lender identify the default, which means when a borrower fails to repay, lender makes the account as default. Then we have to enforce the security interest. Unlike regular legal battle, bank can seize asset without court intervention. This is called enforcing the security interest. Then they sell the asset to ARC, asset reconstruction company. So to recover their money, bank can sell their asset to ARC, which is a smart way to manage the bad loan. Or we can say the borrower appeal to DRT. What is the meaning of DRT? Debt Recovery Tribunal. So if the borrower disagree with the bank action, they can approach the DRT without needing to pay upfront fee. And the appeal process, this case must be resolved within 60 days, ensuring the speedy justice, right? So this case must be resolved within 60 days, ensuring the speedy justice. And then we have aggrieved party appeal to DRAT. If unsatisfied, the borrower can further appeal to DRAT, that is the Debt Recovery Appellate Tribunal, for another review, right? And finally it is called magistrate assistance. So if required, bank can seek help from the chief or district magistrate to check position of the secured asset. So this entire process ensure bank can recover loan efficiently while borrower still have the right to appeal. A win-win for all, right? So this is how the SARFAESI Act work. I've just given you the preview of it. Very very important points. DRT, DRAT, how many days appeal process to take? 60 days. So remember these key points, right? So appeal process with case disposal within 16 days. Next 45 days it has to deposit half of the fine, right? Half of the asset. Okay, so that has to be deposited for DRAT, right? For appeal to the DRAT. Then we have the write-off process in banking. So have you ever wondered what happened when a bank failed to recover a loan? Does the bank just forget about it? Not really. This is where the write-off process comes into play. So let's break it down step by step. First of all, this is called initiate write-off, which means when recovery effort fail, the bank decide to write off the debt, right? So first of all, this recovery effort. So whenever this recovery effort fail, what happens? What the bank decide? So bank decide to write off. Bank decide to write off the debt. But wait, this does not mean that borrower is off the hook. So they use something called provision, right? The outstanding amount is offset against provision. And what is provision? Provision is like a financial buffer that bank maintain to cover the bad debt. This is called provision. Or they debit the profit and loss account, right? So when the recovery effort fail, then bank write off the asset. Or they use provision, or they debit the profit and loss account. Any shortfall is recorded in the profit and loss account, impacting the bank financial. And borrower's liability remain even after the write off. The borrower is still liable for the debt, right? Bank can still take action to recover their money. Or the claim future receivable, future recovery. So what it means, that the write off does not mean that bank give up. If the recovery become possible in the future, the bank can still claim it. Or clear NPA. This is very important, that a technical write-off help clear non-performing asset from the bank book, making financial report look healthier. And debit non-recoverable asset. In some cases, the debt is classified as non-recoverable and permanently debited. And sometimes preserve value. Timely write-off help bank preserve the value of money and keep their financial stable. So the next time you hear that bank has written off a loan, remember it is a financial adjustment, not a free pass for borrower, right? So this is what is done. It is recorded in the profit and loss. MSME are the backbone of our economy, but sometimes financial stress hits hard. So what happened when an MSME struggle to repay loan? So the banking system has a structured process to resolve such case. First of all, what they do, let me explain step by step. The first step is to form a committee, right? As you can see here. So a team of expert, including bank official, MSME representative, and government officer, is assembled to oversee the resolution process. So the regional or zonal head acts like convener. Then they have to refer the account. What is the meaning of referring account? Basically, if an MSME has loan above 10 lakh, right? Suppose MSME has loan above 10 lakh, the account is referred to the committee within 5 days for a resolution plan, that is called RP, right? So basically, first they form a committee, and if the MSME has loan above 10 lakh, then account is referred to the committee within 5 days. Within 5 days, they have to refer the committee to assess whether a resolution plan is needed. So the assessment is done that whether RP is needed or not. Then what they do, they approve the recovery process, right? Next step, as you can see, is the approving the recovery process. Means this committee, right? I told about the committee. So this committee evaluate different recovery and restructuring option and grant approval for the best possible solution. This is the third step. And step number 4, for large exposure, a techno-economic viability, that is called TEV. What is the meaning of TEV? TEV stands for techno economic viability, right? So for large exposure, this techno economic viability, it is conducted to check whether the MSME has the potential to recover and sustain. And finally they approve the resolution plan. So the resolution plan is finalized and approved, including necessary provision to help the MSME get back on track. So why this process important? Because it ensures that MSME get a fair chance to revive, while the bank mitigate risk and recover their fund. So what do you think? Should more MSME be given a structured resolution plan? Drop your thought in the comment. Now let's look at the next point. So friends, when a bank restructure a large loan or changes ownership, an independent credit evaluation, that is called ICE, right? So whenever, two things I'm telling you, whenever whenever bank restructure a large loan, so either they are restructuring a large loan or they are changing the ownership, or they are changing ownership, an independent credit evaluation is mandatory. But how many IC are actually needed? How many independent credit evaluator are actually needed? Let's simplify it. So question is, how many credit evaluation are needed for large loan restructuring? So again I am telling you, for large loan restructuring we are talking about. So suppose for the loan that is less than 100 crore, right, just one IC rated RP4 or better is required. For loan of 100 crore or more, right, one IC with at least require one IC rated RP4 or better is mandatory, right? And for massive exposure of 500 crore and or more, two IC are needed and both are rated RP4 or better, right? So this is the point you must keep in mind, right? So basically why this is important? Because these evaluation ensure that restructuring decisions are based on expert opinion, reducing risk for both the bank and the borrower. So ICE full form, independent credit evaluation, this is called ICE. So you must know how many ICE are required for the resolution process involving restructuring or ownership change with 100 crore or more. You must know it. Now let's talk about achieving restructuring plan implementation. So friends, a successful restructuring plan is not just about approval, it's about execution. Let's walk through the 5 crucial steps to ensure smooth implementation. So the first thing is that the borrower must not be in default with any lender by the 180th day after the review period. This is the first major checkpoint in the process. So there is something called review period. After review period, within the 180 days, borrower must not be in default with any lender. Second thing is to complete the documentation. Means all necessary document must be prepared, signed and recorded to reflect the restructuring term in both lender and borrower record. Third thing is the security creation. Any collateral, any security requirement must be finalized as a part of restructuring process to ensure financial protection for lender. And finally the loan term modification, which means all agreed change in the loan term like interest rate, tenor must be properly documented and accepted by all party. And finally we have no default post implementation, which means even after restructuring is complete, the borrower must stay compliant with all lender to avoid falling back into financial trouble. So because proper restructuring can revive business, prevent bad loan and ensure a win-win for both bank and borrower. So here is a question for you: should bank allow multiple restructuring for the same borrower, or should it be one time chance? Please answer it. So this is how restructuring plan is implemented. Now let's switch our focus to lender provision timeline for a borrower default. So let's talk about it. So friends, when a borrower failed to implement a valuable resolution plan on time, so suppose a borrower is failed to implement viable RP on time, right? Lender must follow a strict provision timeline to safeguard their financial. First of all, the thing is review period end, which means the initial review of the borrower financial condition is implemented. If the issue remain unresolved, lender must set aside 20% of the total outstanding, which is the funded plus non-funded, right? as provision after the 180 day from the review period end. So suppose review period end in Jan end. So after 180 day, 180 day means Feb, March and April. After April end, right? So after ending of April, so initial review of the borrower financial is completed. If the issue remain unresolved, lender must set aside 20% of the total outstanding as provision after 180 day from the review period. So if after the 180 day of the review period, if the issue remain unresolved, then this much provision is to be done. So lender must now assess the borrower financial situation and allocate provisioning accordingly. This is the first major financial buffer to avoid potential loss. Then we have 365 day provision deadline. If the default still persists, lender must increase their provision by another 15%. So earlier it was just 20% and now it has increased to 35%, right? So this step ensures that risk is properly accounted for in the bank's book. So lender calculate the necessary provision based on the outstanding amount. So it's all these are done on the basis of outstanding amount, right? The amount set aside is capped at 100% of the total outstanding depending on the asset classification and existing provision. And then some additional provision apply. At this stage, all lender with exposure to the defaulted account must make an additional provision, reinforcing financial discipline and risk management. So this is called additional provision is applied. So basically this timeline ensures that bank remain financially stable despite borrower default. So here is a question for you. Should lender have a strict timeline or do borrower need more flexibility to avoid default? Please answer it. So these are the steps: review period ending, 180 day provision deadline, 365 day provision deadline, provision calculation. So how do you calculate the provision? So lender calculate the necessary provision based on outstanding amount, and the amount is capped at 100% of the total outstanding. Try to understand. These provisions are over and above the higher of the existing provision, and those required by the asset classification capped at maximum it can go to 100% of the total outstanding. There is a maximum provisioning can be done, right? 20% and 35% are the deadline. Now let's look at DCCO, very very important part. So friends, have you ever wondered what happened when the borrowing entity delay the commencement of operation? So bank follow a structured process for classifying such loan, ensuring financial discipline, right? So first of all, when operation begin, that is called DCCO start, right? DCCO start. So what is the meaning of DCCO? DCCO means date of commencement of commercial operation. Date of commencement of commercial operation. This is called DCCO. So the DCCO mark the official start. From here, interest capitalization stop. Interest capitalization stop. What it means? That interest capitalization stop and all expense start reflecting in the profit and loss account. All kind of expense are started reflecting in the profit and loss account, right? So this is the point. Interest capitalization, no more interest capitalization is there, and all the expense are recorded in the profit and loss account. Now the question is that is there any is there any need to defer the DCCO? At this stage, bank assess whether the project need a DCCO deferment. If yes, then the loan undergo restructuring, means leading to asset downgrading or riskier classification. And if no, if deferment is not there, the bank check whether the revised DCCO still fall within the permissible limit. So the bank check whether the revised DCCO still fall within the permissible limit, and lender allow deferment within these limit up to 2 year for infrastructure project and up to 1 year for non-infrastructure project. This is the maximum deferment that the lender can allow. And if the revised DCCO remain within these limit, the loan is classified under a standard category, right? So if the deferment was no, yes, then restructuring is done. If it is no, then it is a standard category, right? And what if it exceed this limit? So if it exceed this limit, if the deferment exceed the permissible limit for 1 year for infrastructure project or 2 year for 2 year for infrastructure project and 1 year for non-infrastructure project, if it exceed it, then then further deferment lead to additional provisioning. Then further deferment is done and additional provisioning is there. And what if it exceed this limit? If the deferment exceed the permissible limit, further deferment lead to the additional provision. Because the process ensure that bank properly classify loan and account for risk, preventing financial instability. So should bank allow more flexibility in deferment, or would that increase financial risk? Please answer. Now this is a very important chart table from where you will understand this deferment. Very very important. Case study is asked. So did you know that when a project face delay, bank don't just wait. They reclassify loan and adjust provisioning accordingly. Let's break down how deferment in DCCO work. So step number 1, as you can see, is the first deferment. For first deferment, so if it's infrastructure project, 2 years is allowed, I told you early. And if it's non-infra project, then 1 year is allowed. And these loan remain classified as a standard asset, and 0.40% provisioning will be done. Step number 2, deferment due to reason beyond promoter control. And if the infrastructure project extra 1 year is added, right, extra 1 year is added, this means t plus 3 year. And if it is non infra project, then 1 year is added, that is t plus 2. But here is the catch, the provisioning requirement jumps to 5%. Earlier it was just 0.40%, now it is 5%, right, applicable for 2 year or till revised DCCO, whichever is later. Step number 3, what if deferment due to arbitration in or court case? Suppose some court case is there, because of which deferment is happening. So if it is infra project, then additional 2 year, that means total t plus 4 year is allowed. And if it is non-infra project, it is limited to t plus 2 year only, like in this case as above. And if the deferment, if the promoter is changed, what will happen to the deferment? So it can go up to 6 year, and for non-infra project, it can deferment capped at 4 year. So bank carefully regulate project delay to balance financial stability and ensure loan don't turn into bad asset. That is why this deferment is done, right? So and that is how provisioning is done. Now let's look at the last topic of this particular chapter. So have you ever wondered what happened when the bank struggled with the bad loan? Well, RBI has a structured framework for selling financial asset, ensuring a balance between recovery and financial stability. First of all, you have to identify the financial asset. This is the first step. You have to identify the financial asset, right? So this process begins when the bank evaluates their asset. Is the asset an NPA? If yes, then bank can sell to security company or reconstruction company. And if no, the bank check if the asset is under a standard asset under consortium, right? Try to understand the step by step. Is it under NPA? Then you should either sell. If it is yes, right? So if it is the asset is an NPA, they can either sell to IC or if no, the bank check if the asset is under standard asset under consortium or not, right? Now another critical check, right? If the 75% of the asset value already classified as NPA, is the 75% value already an NPA? If it is, then then if yes, the bank can proceed with the sale to the SC and RC. And if no, then bank do not sell the asset. Now step number 4, what if the asset is not NPA? Right, what if the asset not NPA? So the asset is in SMA 2 category, which is called a special mention account 2 category. So it signals the potential stress. So the question is restructuring possible? So this is the question, is restructuring part of the plan, right? So friends, if yes, then additional financial finance is arranged to support revival. If no, the bank may reconsider a strategy. So this framework help bank make informed decision, either selling a stress asset or reviving them with additional support. So do you think that banks should have a stricter rule for asset sale, or should there be more flexibility? And the last slide here we have NPA sale and valuation process. So basically, ever wondered how bank get rid of their bad loan? Well, they don't just write them off. They follow a structured process to sell non-performing asset and recover when they can. So whenever a loan turn into NPA, the bank decide to sell it to recover some of its loss. So the buyer of the NPA must hold it for at least 12 months before taking further action, right? So the buyer retains asset for 12 months. Then there is something called public bid solicitation. To get the best price, bank invite public bid and conduct e-auction for competitive participation. And there is something called internal valuation policy. It means bank have internal system for asset valuation to ensure fair pricing before selling. And then there is external valuation for large exposure. Bankruptcy code. So friends, as we know in our crash course, what we do, I provide you the video which is the shortest form, which includes all the important points from a particular topic. No extra thing which is not examined. All the important things from examination point of view are covered. And then you go out solving the quizzes which I provide you daily in a separate folder. After quizzes, you see the score you obtain. If it is less than 60%, you reattempt the concept. You go through the concept once and reattempt the quiz. So this is how we are proceeding. It hardly takes 1 to 1.5 hours per day on daily basis to cover the unit which I am covering. Now let's get started with our topic. So when business face financial trouble, there is one team that steps in to bring order to the chaos. That is called insolvency professional. So this team, right, this is called insolvency professional. So let's break down their key role one by one. First of all, they are licensed by IBBI. Let's move from the bottom up, right? So let's move from the bottom up. They are licensed by the IBBI, right? What is IBBI? Insolvency and Bankruptcy Board of India. So every insolvency professional is registered and authorized by the Insolvency and Bankruptcy Board of India, ensuring they meet a strict regulatory standard. Then there is something called interim resolution loan. In the early stage of insolvency, they steps in as the interim resolution professional, which we call IRP, right? They steps in. Who steps in? We are just talking about we are talking about the, as you can see. So basically they are licensed by IBBI and insolvency professional, IP. So IP acts like an IRP in the initial stage, right? In the initial stage, which means that they take charge and stabilize the situation. Then we have resolution role, which means then comes the critical job of facilitating negotiation and settlement between creditor and debtor, aiming to resolve the financial distress. Then comes liquidation role. If the resolution fail, the insolvency professional shift gear to oversee the distribution of assets to creditor under the liquidation process. And finally, their role as bankruptcy trustee role, which means finally in the bankruptcy case they act like a trustee. Who act like a trustee? IP means insolvency professional. They act like a trustee, managing proceeding and conducting meeting with creditor. So you can see the various role they perform: bankruptcy trustee role, liquidation role. In liquidation, what they do? They oversee the distribution of asset to creditor under the liquidation process. Resolution role, that means the critical job of facilitating negotiation and settlement. Interim resolution role, for the time being, for to manage the initial stage, IP plays a very important role. So you can see the various role performed by IP, that is called insolvency professional. Everything in this particular slide is in pictorial format so that you can easily understand. So, and remember, behind every struggling company turnaround, there is a sharp insolvency professional making it happen. Now, friends, ever wondered who set the standards for Indian insolvency professional? Let's dive into the structure of insolvency professional agency. This is called IPA. So, till now we have discussed IP. Now, let's discuss insolvency professional agencies. So, friends, at the core we have insolvency professional agencies. So, let me show you the diagram. So this is the diagram, as you can see. So at its core you can see the core we have IPA, right? So these are the backbone institution that define and maintain the standards for all insolvency professional in the country. For all IP, they define the standards, what standards they should have to maintain, right? Right. Now the purpose. What is the purpose of this IPA? So the purpose, to ensure quality, transparency, and integrity by promoting professional standards across the insolvency system. Now, but here is the catch. The catch is that membership with an IPA is mandatory for anyone who wishes to be registered with IBBI. So for anyone who wishes to be registered with IBBI, membership with IPA is mandatory. This is very, very important, right? For IBBI registration, membership with IPA is necessary. And what is IBBI? Insolvency and Bankruptcy Board of India, right? License. I told you earlier that IPA are licensed by IBBI. Remember it. And existing IPA in India, there are 3 existing IPA. Let me zoom a little bit. So the first is ICSI, that is Institute of so who are these existing IPA? We have got 3 major one. The first one is the Institute of Company Secretary of India. Second one is the Institute of Chartered Accountant of India, and the third one is Institute of Cost Accountant of India, ICMAI, right? So together these agencies act like a pillar shaping how insolvency professionals operate under the India's legal and regulatory framework. So the next time you hear about insolvency case, remember these IPA are silently ensuring everything run by the book. These are called IPA, insolvency professional agencies, right? Now let's look at the next point: existing component and function of information utilities. So what is information utilities? So friends, let's break down a crucial piece of insolvency puzzle, that is called information utility. At the heart of this system, at the heart of this system, you can see are the information utilities, or IUs. Think of them as secure digital vault where crucial financial information is stored and verified. So first of all, let's talk about the mandatory requirement. What are these mandatory requirements? See, when a company faces insolvency, the application need an IU certificate of default. Try to understand. Whenever a company faces insolvency, the application need an IU, that is called, what is IU? In short, this information, just now I have told you, information utilities. IU means information utility. So whenever a company faces insolvency, the application need information utility certificate of default. So this information utility issued a certificate of default. This step is very key to kick starting the process. Next come the data source. See, information utility pulls information from various channels like bank, FIs, NBFCs, asset recognition company, corporate firms, and individuals. Then we have the data function. Data function, means IU handle everything from pulling, authenticating, and certifying data to make sure it is credible and trustworthy. And finally, we have the access mechanism. Thanks to the Central Application Program Interface, which we call CAIIB, Central Application Program Interface. This information is easily accessible to our shareholder. So that is the beauty of this crash course. In one single slide, you are able to understand four different things. If you go in the book, you will see number of lines which is written, and you have to filter out what is important for me and what is not important. And this crash course ensures that if you go through all the content which I am providing, this ensures that you can easily revise the main points, and this will help you in the examination to revise in the short time. So if you want to get avail of this crash course, you can enroll by getting more detail on this WhatsApp number, or in the description section of this video you will get the link to the crash course. So this is the beauty. In the short time, if you want to revise everything, this will help you. So you can see the mandatory requirement, data sources, data function, access mechanism. Thanks to SAPI. CAIIB means Central Program Interface, Central Application Program Interface. Now let's look at the next slide. Remember this 4 point, very important regarding the information utility. Now friends, but who takes decision once insolvency starts? That is where creditor and their committee, that is called COC, that is called creditor committee of creditor, right, comes into play. Here is how voting works. So quorum, right, quorum needs 33% attendance. Routine matter needs a simple majority at 51%. Critical matter needs a strong 66% by backing. And for withdrawal under section 12A, a whooping 90% agreement. So the COC is formed by the interim resolution professional. Remember, COC is formed by IRP, and it is made up of entirely of financial creditor. Its member are FCs. It is made up of financial creditors, right? Okay, what about operational creditor? They don't vote, but they plays an observer role. So this operational creditor, they don't vote, rather they play the role of observer. So together, information utility, and you can see the creditor, a financial creditor and operational creditor are there. So together, information utilities and COC ensure that insolvency proceeding stay fair, transparent, and efficient. I hope that makes sense to you. All right, let's now simplify how legal disputes are resolved in under insolvency laws in India. How legal disputes are resolved. So friends, this is where adjudicating authority, and appellate body comes into the picture. Think of this as the two separate route. One for corporate entity, as you can see, one for corporate entity, another for non-corporate entity. So corporate entity, like LLPs, like companies, these are called corporate entity, right? So their insolvency cases go straight to their insolvency case go straight to NCLT, that is called National Company Law Tribunal. And if any party is unhappy with NCLT decision, they can appeal to NCLAT, right, which is National Company Law Appellate Tribunal, simple and streamlined. And if what about non-corporate entity? So when you talk about partnership, right, when we talk about a proprietorship and individual, these are called non-corporate entity, right? So their case go to DRT, Debt Recovery Tribunal. If needed, appeal from DRT goes up to DRAT, right? So DRAT means Debt Recovery Appellate Tribunal. So friends, two parallel track, both designed to ensure speedy resolution and justice. Corporate matter to NCLT and NCLAT, and appellate tribunal is NCLAT, and non-corporate matter to DRT and DRAT. A well-organized system that keeps insolvency and debt recovery running, right? So this is all about adjudicating body. The corporate insolvency resolution process step by step. So first of all, you can see that it all start at the if a default of 1 crore or more, whether full or partial non-payment, this is a red flag. This is a red flag that kicks off the process. Then after step number 2, initiation by creditor. So who raised the hand? It could be financial creditor, it could be operational creditor, or it could be corporate debtor themselves. So all of them can raise the hand. Now step number 3 is the NCLT application. What it means? So friends, then they can file an application before the National Company Law Tribunal, the NCLT, to officially initiate the resolution journey. Then step number 4 is the IRP proposal. An interim resolution professional or IRP is proposed to steer the ship. For financial and corporate debtor, this is a must, and for OC it is optional. The IRP proposal is optional for OC. And then the next point is IRP appointment. The NCLT appoint the IRP to take charge of the resolution process and bring some order to the chaos. And the final step we have, as you can see, is the IRP takes over. Finally, the IRP assumes full control, replacing the power of the CEO and the board. The IRP ensures that corporate debtor continue as a going concern while the resolution unfold. Right. So there you have it. 6 clear steps that set the stage for saving or restructuring a struggling company. Want to know what happened next after IRP? Stay tuned for the next slide. So the next slide you will see what happened next. after IRP appointment. So what exactly happened after the initial step in the corporate insolvency resolution process? So let's take a ride along this resolution highway. So this is a resolution highway, right? First stop is the interim resolution professional or the IRP, right? So it is officially appointed. The IRP job is to take charge and manage the corporate debtor right from day one. Then moratorium is declared. So NCLT pulls the brake. A moratorium is declared, which means no fresh legal action or recovery against the debtor until this entire process is completed. A pause button for creditor. Then COC appoint RP, which means the committee of creditor. They now appoint a permanent resolution professional, also known as RP, who take over from IRP and drive the process forward. Now it's time to draw up a solid resolution plan. The plan will ensure CIRP costs are paid, and most importantly, operational creditor get at least the liquidation value. Right? Operational creditor get at least the liquidation value. Priority matters here. Finally, we have plan implementation. So we hit the execution phase. The plan is implemented and the IRP takes the wheel officially. Keep in mind, the corporate insolvency resolution process should wrap in 180 days, right? But maximum can be extended to 330 days under a specific condition. So from appointment to implementation, this roadmap help revive distressed company and protect creditor the interest. So I hope that makes sense. This was continuation of the previous slide which we have just gone through. Now let's come to the next slide and let's talk about the CIRP process and IRP appointment. Some more point. So let's climb step by step through the corporate insolvency resolution process and see how the interim resolution professional or IRP comes into play. So first of all, first step as you can see at the bottom is the applicant. I think it is at the top here. So first of all, CIRP applicant proposes IRP, which means the applicant, usually a financial creditor, proposes a name for IRP. This kick-start the process officially. Then NCLT appoint IRP, already told you. This NCLT give the green signal by appointing the IRP. Now, no ongoing investigation, but wait, it is mandatory that IRP has a clean record. No ongoing investigation or disciplinary action should be pending. Now, OC does not propose IRP. So suppose here is a key point that if the operational creditor does not propose any IRP, right, then in that case, right, if there is a confusion or there is a special circumstance, NCLT may consult with IBBI to appoint an IRP, that is insolvency resolution professional. Then NCLT appoint IRP within 14 days, right? So once appointed, the IRP steps in. The NCLT must appoint the IRP within 14 days of admitting the CIRP application admission. And once appointed, the IRP steps in, right, and takes control of the asset of the corporate debtor. No exception here. And lastly, the board of directors of the debtor company is suspended immediately from the CIRP admission date. The IRP now run the show. This marks the beginning of a structured resolution process. Now let's move ahead. Public announcement process by IRP. So friends, alright, now that IRP is on the board, what is next? It's time to take this process public. First, the IRP is officially appointed to the case. Once in charge, they need to act quickly. Within just 3 days, you can see, within just 3 days, right, IRP must make a formal public announcement. That is called public announcement, right? Now, where no delays is allowed. Now, where does this announcement go first? It goes first to the IBBI website. That is the official platform of the Insolvency and Bankruptcy Board of India. Then what happened? Corporate debtor website publication. That means this is the classic touch. The IRP must also get this announcement printed in 2 newspapers. And also, the same announcement is also published on the corporate debtor on website, which means transparency is the key. And now, the IRP must also get announcement printed in 2 newspapers, one in English, another is the local language, original language. So the question is, what is the purpose of this announcement? The goal is simple, to invite creditor to step forward and submit their claim. The resolution process starts with knowing who or what. So this multi-channel approach ensures that no stakeholder is left in the dark. It's about fairness and openness. The next point, the next step we have, as you can see on your screen, is the PIRP. Very, very important thing. Every year question is asked based on it. There are many things in between, but we are skipping those part. We are just moving to the PIRP. So ever wondered how MSME or micro, small and medium enterprise can resolve financial distress faster and smoother? Let's dive into pre-packed insolvency resolution process, which is tailor-made for MSME. It's all start here. Recognizing MSME facing financial distress or those defaulting up to 1 crore, right? You should recognize such MSME. Step 1 is spotting the trouble early. Then to submit the RPs, you have to submit the resolution plan. So the MSME proactively submit a resolution plan, a strategy to fix the distress and get back on track. Then comes educating authority approval. The plan is then sent to executing authority. They will review it and give their official approval before moving up forward. So this authority, this executing authority, review the resolution plan and give their finance approval, right? Then then they apply the PIRP criteria, right? Then they apply something called PIRP criteria. But hold on, eligibility check matter. Does the MSME meet the PIRP criteria? So if the dues exceed 1 crore, right, then CIRP or other option might come into play instead. So remember, the deadline is, the limit is 1 crore only, right? If dues should be less than 1 crore. Now what happens then? Once cleared, the PIRP kicks off, or if PIRP is not suitable, then the process move to CIRP. Either way, action start here. And one important note is that there is a cooling off period, right? Which means PIRP or CIRP cannot be reinitiated within 3 years of completion of previous one. So until and unless the previous one has been completed for 3 years, these two cannot be initiated. This ensures stability and giving breathing space. So this process is designed to give MSME a fighting choice, right, helping them resolve issue quickly without losing business momentum. Now let's switch over and let's talk about the next slide. As you can see in the next slide, we will talk about which insolvency process should be pursued. So if PIRP is filed within 14 days of CIRP, it takes precedence, right? Or if PIRP is filed after 14 days, CIRP remains in control. So suppose initially what you filed is CIRP and just within 14 days you file PIRP, then it takes precedence, PIRP takes precedence. And suppose you file CIRP and after 14 days you file PIRP, then CIRP remain in control. And PIRP model when debtor manage asset. So that is called debtor in possession. Right. Now let's switch our focus to the next slide, which we have, as you can see, a step to initiate PIRP. Right. So what are the steps to initiate PIRP? So basically, there are some steps. The first step is to get the creditor approval. Achieve 66% approval from financial creditor to initiate PIRP. How much? 66% approval. Once 75% shareholder approval, obtain this much through a special resolution, that is called shareholder approval. How much? 75% means 3/4. Then file the application with the executing authority, and then court appoint an IRP, insolvency resolution professional, and then timeline completion. Complete the process within 120 days. So you can see in that case CIRP 180 days were there. Now it is just 120 days. Now let's look at the sequence. What happened in the sequence? So friends, let's break down the step-by-step journey of the insolvency resolution sequence under PIRP. It all begins with the commencement of pre-packed insolvency resolution process. This marks the formal start. Next up comes the BRP, which is called Base Resolution Plan Submission. This is then debtor initial solution, and this is a strict deadline to meet. Then from here the ball moves to the COC, Committee of Creditor, who have a 90-day window to review and approve the plan. They have 90-day deadline. Then comes termination. But if no plan get approved within this time frame, the process is terminated, no second chance. The clause enforce discipline and quick resolution. And section 29A apply. Let's not forget section 29A. These provisions disqualify defaulting promoter and willful defaulter from participating in resolution process. Defaulting promoter and willful defaulter are disqualified from participating in resolution process. A strong safeguard to ensure only eligible players are at the table. This is how PIRP create a swift and structured pathway to recovery for the distressed company. Right? Remember the deadline, 90 days deadline for plan approval. If process terminate, and section 29A apply. Now let's compare PIRP with CIRP in this particular slide. So first of all, eligibility. So PIRP is tailor made for MSME. Let me zoom a little bit. So no, you must know that this PIRP is only tailored for MSME, right? MSME, micro, small and medium enterprise, right? With a default threshold capped at 1 crore, right? On the other hand, CIRP apply to all corporate debtor but only kicks in when default exceed 1 crore. Remember it. Initiation. Who initiated? PIRP is driven by the corporate debtor itself. Post approval from the shareholder and unrelated financial creditor. I told you 75% approval of the from the shareholder and 66% from the corporate COC, Committee of Creditor. CIRP, however, can be initiated by anyone: financial creditor, operational creditor, corporate debtor. Anyone can initiate it. So timeline wise, PIRP offer a fast track, 90 days to submit RP with a maximum of 180 days overall. But in CIRP, in the contrast, can stretch up to 330 days with extension. Now, if you look at the management control, so control matters. Under PIRP, the debtor retain possession, right? So if we talk about the control, right? So management control. So under PIRP, the debtor retain the possession. So friends, what it means that under PIRP the debtor retain possession, right? The debtor retain possession but creditor are in control. Under PIRP the debtor retain possession but creditor are in control behind the scene, and CIRP shift the control directly to the creditor, right? When it comes to the resolution plan, right, PIRP begins with the base resolution plan, right, submitted by the debtor. However, CIRP invite EOI. CIRP invite EOI. EOI means expression of interest, right? CIRP invite EOI from all prospective applicant, opening up the floor to competition. Then section 29A. Both process enforce section 29A, disqualifying defaulting promoter and willful defaulter from bidding. But here is the catch. PIRP termination can either trigger liquidation or lead to full CIRP. Right. So if termination of PIRP, it can trigger liquidation or lead to full CIRP, while CIRP termination directly leans toward liquidation. Right. That is the point. Now moratorium. A moratorium in PIRP starts from date of commencement. Right, from the very beginning. In CIRP, it activates upon filing. For termination, PIRP needs 66% COC approval, right? While CIRP follows section 12A with 90% vote to withdraw. And lastly, PIRP have some extra layer that if promoter that no parallel running with CIRP. First point, a mandatory 3-year cool-off period between PIRP or any other PIRP. And if promoter don't dilute equity as part of the resolution, the COC must record the reason for it. So whether it is speedy and flexibility under PIRP or the broader scope under CIRP, both routes are designed to tackle insolvency with precision. So that's all for this topic. Nothing extra to learn. If you cover this much, more than enough. That is sufficient to get 3 to 5 marks question, which is asked every year from this chapter. For more detail regarding the crash course, you can WhatsApp me on this particular